Supply and Sewage Board has terminated a contract worth 440 crores due to delay in execution of projects and the quality of the RO water. Power Grid has been declared as a successful bidder to establish interstate transmission system, and this project comprises of installation of STATCOMs at Khavda Pooling Station 1 and Station 3. First Source is another counter that will be in focus, and that is because its arm, First Source Solutions UK, will be acquiring 100% ownership in Ascensos for around 468 odd crores. Thangamayil Jewelry will be considering fundraising via issuance of equity shares or bonds on September 26th. And lastly, watch out for Pondy Oxides, because the company is looking to raise up to 250 crores via QIP in one or more tranches.
Thanks so much for that, Vamakshi. But finally, Nigel is joining in with us to tell us what are the important cues in the world of F&O. Nigel, good morning.
Well, morning. Getting into the monthly expiry, we're seeing rollovers pick up in this series, moving into the next one. It's a little bit higher in comparison at the same time the previous series. So just keep that in mind. Rollovers are picking up. The Nifty Financial Services Index, that has a weekly expiry contract, and that will play out today. And if you're looking at positioning the clients as well as the FI as well, they're opposite ends of the spectrum, which I'll get to in just a bit. Yesterday, you had the Nifty that ended higher. Basically, we opened up in the green and we ended a little higher than where we opened up. So we ended with a gain of around 145 points. We opened up with a gain of around 110, 120 points or thereabouts. Now, the Nifty moved up and the VIX as well moved up. Now, that's telling you that, in fact, there is some kind of caution around the corner, because normally we have an inverse relation between both of them. What about the FI positioning? Yesterday, they added 12,000 long, 12,000 short contracts. Now, the long positioning is at around 75%, while the shorts are at around 25%. But I'd mentioned positioning as the opposite ends of the spectrum, because the FIs, they're aggressively net long, the clients are aggressively net short, and both those two data points are the highest that we've seen at opposite ends of the spectrum all the way since July. So it's a 2-month high in terms of the FI net long positions, and it's a 2-month high on the short side for the client positioning as well. Moving to the PCR, then yesterday we made this point. The PCR has moved to the upper end of the range at around 1.5. It cooled off a little bit, but it's still holding at around 1.42. And the options data comes up for you on the screen. Keep in mind, these strikes, they expire in the next 2 sessions or so. So you have some bit of writing being seen at both those two call options. Plugging in the numbers, you have some kind of resistance. We get to around 26,000 on, but maybe the algo-based selling as well could come in. And the 26,050 odd mark, that appears as the first resistance zone. So expect some kind of rejection of that level, and then we'll see whether we can get past that. The options data suggests 25,700. Well, that's the first, support level that we're looking at. And you'll see the trend is up till the 20 DMA holds out as well. The Nifty Bank, that's the one that's been driving the gains. The last 1 year, it's been a relative underperformer, but it's found its mojo and it's come back in style in the last 5 sessions or thereabouts, as that screen tells you. The sector that I'm looking at in today's trading session, well, it's going to be the metal index, because of the commentary coming in from the People's Bank of China with regard to potential rate cuts. We'll keep an eye out on that. And a stock that's come out of the F&O ban is RBL Bank. So we'll keep an eye out on that one as well. Back to you.
Thank you so much for that, Nigel. But on that note, we're going to slip into a very short break. More news and updates after the break.
We've gone, since I've been here, we've gone from 6,000 employees here to 60,000. And they're across all things, data, scientists, engineering. We cover 150 companies in research and banking, 850 multinationals coming here, custody, asset management. We've just been growing with the country, and your country's been growing quite well, and I'm quite optimistic about the future of India.
Who are you supporting, if I can put it bluntly?
I'm not endorsing anyone at this time.
Okay.
I spend more of my time on policy. What's the policy we need that can really help both the world, that's foreign policy, and domestically? So I think we need to do a lot just in America to lift up our country, and as we do that, it helps the rest of the world.
Mr. Trump, in an interview, he said this, that he may tap you to be the Treasury Secretary, Mr. Dimon. I just wanted to ask you this.
He said like, the next day, definitely not. So I don't expect to be the Treasury Secretary.
मैंने दिल्ली के मुख्यमंत्री का कार्यभार संभाला है, जिम्मेदारी संभाली है। आज मेरे मन की वही व्यथा है जो भरत जी की थी जब भगवान श्री राम 14 वर्ष के लिए अयोध्या से वनवास पे गए और भरत जी को अयोध्या का शासन संभालना पड़ा। जिस तरह भरत जी ने 14 साल तक भगवान श्री राम की खड़ाऊ रखकर अयोध्या का शासन संभाला, उसी तरह से आने वाले 4 महीने के लिए मैं दिल्ली सरकार चलाऊंगी। अरविंद केजरीवाल जी की गिरफ्तारी एक दुर्भावना के तहत हुई है। शायद कोई भी और नेता होता तो मुख्यमंत्री की कुर्सी पर बैठने से पहले 2 मिनट भी नहीं सोचता, लेकिन अरविंद केजरीवाल जी ने कहा कि मैं तब तक मुख्यमंत्री की इस कुर्सी पर नहीं बैठूंगा जब तक दिल्ली के लोग उनकी ईमानदारी पर भरोसा नहीं दिखाते, और उन्होंने मुख्यमंत्री पद से इस्तीफा दे दिया। लेकिन दिल्ली के मुख्यमंत्री की कुर्सी, ये कुर्सी अरविंद केजरीवाल जी की है। मुझे पूरा भरोसा है कि फरवरी में 4 महीने में जो आने वाले चुनाव हैं, दिल्ली के लोग अपने प्यार के साथ, अपने आशीर्वाद के साथ, अपने भरोसे के साथ फिर से अरविंद केजरीवाल जी को मुख्यमंत्री की कुर्सी पर बैठाएंगे। तब तक ये कुर्सी इसी कमरे में रहेगी, अरविंद केजरीवाल जी का इंतजार करेगी।
Earnings have been the key, and that is the reason why India has rallied 660% over the last 2 decades and outperformed US, which has only rallied only 440%. And that's largely because of an earning. But FY25 have not started on a great note. First quarter earnings was lackluster, and we anticipate even second quarter earnings are going to be subdued enough. We do anticipate the comeback of earnings will happen from third quarter onward. On the small and the mid-cap side, we have seen close to 52 stocks out of 89, whereas consensus.
Welcome back. You're watching Power Breakfast on CNBC-TV18. Let's move on and talk about NTPC Green Energy, the renewable energy arm of NTPC. Now, that's expected to launch its IPO in the first week of November this year. What more are the details on this? Abhimanyu is joining in with us. Abhimanyu, good morning.
NTPC is targeting 60 gigawatts of renewable energy capacity by 2032, and as part of these plans itself, its fully owned subsidiary NTPC Green Energy a few days back had filed a DRHP with SEBI and is already in process of going the IPO route to raise more funds. The company is also in process of going for road shows across India and several other places in the world. As per sources, the IPO is likely in the first week of November, and the company has already begun its road shows. It's expected to do these road shows in Mumbai, in India, and in several other places across the world, including the US, the UK, and Singapore. It remains to be seen which other places the company is going for as far as road shows are concerned, and what is the degree of investment it is aiming to target. And based on that itself, its future plans, of course, would unfold, and the establishing of the targeted capacity would, of course, happen only on the basis of the investment it would be able to secure based on funds from India and abroad.
Thank you so much for that update there. But let's slip into a short break on that note. But after the break, we'll get to the cues in the world of commodity.
Available. We have seen earnings downgrade happen post result season. Similarly, on the small cap side, close to 40 odd name out of 79 name have seen earnings downgrade. So that's where some comfort is going away, and hence we are broadly cautiously optimistic on markets near term basis. Market is rallying so much. It is rallying because of sentiment, that is liquidity. So we need to track where this retail or this liquidity is primarily sitting in right now, and that is largely in also in SME side. So that's where some of the hit has started coming through, and we have seen close to 14 to 15% kind of a decline since end August onwards. The better idea for them would be not to chase the rally, to buy the dip, or to start looking at a weaker time movement which will come. But this will be an opportune time for the first time investors or even the foreign investor who missed the entire rally in India for the last couple of years. So when they are seeing any quality names are seeing a sizable kind of a correction, which we have witnessed last week during couple of days, that's where they can deploy the money and start making investment into the Indian equities.
We need to find companies that are going to dominate the international landscape. Now, when I say international landscape, IT services has proven the fact that they are large, they are resilient, and they are a mature industry, accounting for close to about 7 to 8% of India's GDP. One, I'm not too sure that it's an underpenetrated market anymore because apart from fuel, alcohol remains one of the biggest sources of revenue for the government. The concern on valuations, I think, will remain for a while. I've been concerned about it for the last 1 year, but it doesn't really matter. For the largest period of time, as Old Bridge Capital, we've been talking about manufacturing, we've been talking about energy, and a large part of services were not part of that entire framework. I think now, looking in hindsight, if you have to extrapolate the same trends forward, it's going to be a little bit of a challenge because some of these businesses are trading at value at the market capitalizations in a cyclical industry, which some of.
Welcome back. You're watching Power Breakfast on CNBC TV18. And like promised, we do have Manisha Gupta joining in with us to tell us what's happening in the world of commodities. Manisha, good morning.
Morning, and thank you for that, Winnie. Well, I'll start with the gold prices, which are holding near all-time highs of $26.30 an ounce. There was a report from Citi overnight suggesting and reiterating higher prices for gold. Citi's report suggests that $2,800 to $3,000 an ounce in 2025 is the kind of prices that they are looking at. Well, for this week now, it's important to watch the Switzerland and Sweden monetary policy meetings. The U.S. Fed chair himself and the members are slated to speak in this week as well, and that would move the US dollar and various other asset classes. Having said that, when you look at the net long positions from the money managers, they only have increased when it comes to gold and silver to the highest since 2020. So the bullishness here just about continues. The crude oil prices also seem to be holding well after 4% of gains in the previous week. The conflict between Israel and Hezbollah and the weak European Union business activity is something that is providing support to the market. Also, a second major hurricane in 2 weeks is forming in the Gulf of Mexico, and ahead of that, some evacuation work already is happening there, also adding premium to prices.
Okay, thank you so much for that, Manisha. But that's all we have on Power Breakfast. Bazaar Morning Call comes up next. Thank you so much for tuning in.
आज भारत का 5G मार्केट, बताऊं? बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। आप हैरान होंगे, आज भारत का 5G मार्केट, बताऊं? बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। और ये 2 साल के भीतर भीतर हुआ है। अब तो भारत मेड इन इंडिया 6G पर काम कर रहा है। ये कैसे हुआ? ये इसलिए हुआ क्योंकि हमने इस सेक्टर को आगे बढ़ाने के लिए पॉलिसीज बनाई। हमने मेड इन इंडिया टेक्नोलॉजी पर काम किया। हमने सस्ते डेटा पर मोबाइल फोन मैन्युफैक्चरिंग पर फोकस किया। आज दुनिया का करीब करीब हर बड़ा मोबाइल ब्रांड मेड इन इंडिया है। आज भारत दुनिया का दूसरा सबसे बड़ा मोबाइल मैन्युफैक्चरर है। एक जमाना था मेरे आने से पहले जब हम मोबाइल इंपोर्टर थे, आज हम मोबाइल एक्सपोर्टर बन गए हैं। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। ये तीसरे टर्म में हमें बहुत बड़े लक्ष्य साधने हैं। हमें 3 गुना ताकत और 3 गुना गति के साथ आगे बढ़ना है। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। पुष्प, और मैं पुष्प को डिफाइन करता हूं, P फॉर प्रोग्रेसिव भारत, U for unstoppable Bharat, S for spiritual Bharat, H for humanity first को समर्पित भारत, P for prosperous भारत, यानी पुष्प। पुष्प की 5 पंखुड़ियों को मिलाकर ही विकसित भारत बनाएंगे।
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Overnight, not very much. This morning in Asia, a fair bit. That's the best way, I think, to put it. We'll get on with it and we'll tell you what's important as far as markets are concerned. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. Surabhi and Nigel with me. Guys, hi, good morning.
Hi, good morning. And I guess markets are still in feel-good mode because we have more central bank action and despite everything that's happening in the Middle East, and that really was catching my attention because at a human level, things seem to be going a little haywire over there. But at a market level, I think, it's still the party going strong.
I mean, party is going absolutely strong. No two ways.
Well, that's right. And today, for the first time, we're going to go to 26,000 odd. You know, I wasn't here in 2008 and 2009. But you all would have seen 2,600 as well. And today, 26,000 odd. So it's going to be a bit of a landmark.
Absolutely. Although I would say that, anyway, I'll tell that story. It's too early in the morning to tell old stories.
I'm all yours already.
Okay, anyway, so let's rewind the clock back and tell you what you need to know as we begin today's session. You've got basically a very, very lackluster overnight day, right? Nothing. S&P was up about 0.25%. NASDAQ was up about 0.14%. So these are nothing kind of changes. Volumes were muted. So if you look at the NYSE, compared to the 20-day average trading volumes, they were down about 10%. No big directional drivers. There was lots of Fed speak, which I'll lay out in a bit. 10-year was unchanged, 3.75. The dollar index at about 101. You had the U.S. manufacturing PMI numbers, which came. They were soft, but not soft enough to invoke fresh growth concerns. Actually, services PMI, which is more sticky. Actually, services inflation is more sticky. But the services part, which is the larger part of the U.S. economy now, like most countries, that actually was much better as compared to the manufacturing side. I said lots of Fed speaks. So we had Fed's Goolsbee, who said that rates still need to come down significantly. Bostic and another gentleman said that 50 basis point is not the template for future cuts. So they kind of echoed what Powell has said, that don't take every meeting to be a 50 basis point meeting. Oil cooled down a little bit, down about 0.6%, at about 74. So that's essentially what happened, or what did not really. It was very, very quiet. Let's put it that way. And, all the headlines out of the Middle East, and Surabhi will talk more about that in just a bit. In terms of actual price movement and price action, did not amount to very much. Oil actually ended slightly lower. Just to circle back the levels for the Nifty, the question is, will 26,000 act as a bit of a psychological resistance for the market? It's possible that it does so, but logically, the next targets that you got to look at, and the way to do it, because you're in blue sky territory and the market can go anywhere, is essentially to look at, for example, 26,245 is the 100% projection of the last move that we had. So that's the first target for the Nifty, which is 26,245 once we take out the 26,000 levels. Now, on the downside, we must not break the 40-hourly exponential moving average, which is about 25,586. That must be respected. Bank Nifty has gone up for 8 trading sessions straight. So it's been a very, very strong market for the banks and financials index. It's been the underperformer, made new highs fairly recently. So there is room there. In the near term, the Nifty Bank can move to 55,615. That's the first level. Let's get there and we'll talk more. On the way down, the important support, again, like the Nifty, is the 40-hourly, which is 53,080. So these are some levels that I wanted to put out. I mean, it's looking a pretty decent kind of a day, with, of course, help coming in from China earlier today. GIFT Nifty will come up on your screen. It's indicating about a 65-watt point higher start. Surabhi.
Absolutely, Prashant. Because of China's moves, I mean, all of Asia is a nice shade of green throughout. Two major central banks that we're talking about over here. First, the PBOC. Now, the interesting aspect was that there was actually a press conference, which usually never happens with the Chinese central bank, but maybe they took a cue from the Fed. It is, of course, a season of big central bank moves. So what do we know? The PBOC has done a couple of things. One, they've lowered the reserve requirement ratio by 50 basis points. The governor in that press conference hinted that more cuts are coming on different parameters. He said that there could be another 25 to 50 basis points that they do on this RRR by the end of the year. Not just that, he also hinted that the loan prime rate, the 1 year or the 5 year, I mean, didn't indicate which one, but they could also be lowered by 0.2% to 0.25%. And that's the benchmark rate when you're talking about Chinese monetary policy. The 7-day repo was also lowered. So lots of easing from China with promise of more, and that's really powered up not just mainland Chinese markets, but Hong Kong and, like I said, the rest of the neighborhood. We'll also have the Australian Central Bank come out with its rate decision today. No change is expected over there. Quickly moving on to geopolitics. Now, you would have been watching the news overnight, and those headlines are getting more and more dire because just in terms of the human cost, we're talking about almost 500 people perhaps reportedly killed. 492 was the last figure that I checked, in various sources. Over 1,500 wounded. But none of this has actually led to a move on oil, as Prashant mentioned. Very range-bound, though there's a bit of an upbid once again this morning. Oil prices are up about 0.5%. And gold also seems to be reacting more on the stimulus and the fact that there's so much money in the market, maybe more than the tensions in West Asia. But for what it's worth, we should also bring up the price of gold because it's just moving like a rocket. 2650 has already happened on spot gold. That's how quickly the gold markets are reacting. And of course, oil continues to be in a range, but the bias is on the upside, closer to 75 on Brent. Back home, well, no problems here whatsoever. The rally continues to cruise along. However, we had another caution coming in from SEBI. Their latest report, remember the first one caused such a flutter, caught a lot of headlines on the F&O market. Well, they've come out with the latest study, and this talks about FY24 as well. And the numbers have only gone up. They're saying 91.1% of individual traders actually end up losing money in F&O. That's what happened in FY24, and 93% lost money. If you're looking at FY22, 23 and 24, all 3 years put together. And SEBI is saying only 1% of the individual traders managed a profit of more than 50 lakhs. And actually, while a lot of individual traders kept losing money, it's the institutions, people who are running their prop books and institutional investors, they are the ones who managed to end up with some gain. So anyway, let's see. That's a bit on the sentiment side. Quickly coming to the fund flow picture. We don't have a massive FII buy number like we did on Friday. Yesterday's buying was a little more measured, 400 crores. Domestic institutions were also on the buy side. Short point, the Qs are positive, whichever way you look at it, and the flows are coming in. So, Nigel, who's to say? Who's to stop this party?
Well, that's right. And the rollovers are picking up as well, getting into the monthly expiry that plays out later. And the rollovers, if you compare it to the same time of the last series, the previous month, well, it's a little bit higher than what we have seen. Today, you have the Nifty Financial Services Index that will play out its weekly expiry. And the client, as well as the FI positioning, well, they're on the opposite ends of the spectrum, which I'll get to in just a bit. The Nifty moved up yesterday, but the VIX as well is creeping up. And sometimes that indicates a bit of caution in the near term, or some kind of consolidation is what we could brace ourselves for. You could argue that the VIX is bouncing up from bombed out levels, but it's bounced close to around 15% from the recent lows or thereabouts. What do the FIs do? They added 12,000 long, 12,000 short contracts. They continue to remain net long, with close to 75% of their positions on the long side. Let's pull up both the client as well as the FI positioning. Now, the clients are net short. That's the highest we've seen in the last 2 months. The FIs are net long, and that's the highest we've seen in the last 2 months as well. And sometimes you see when this sort of a picture, plays out, you could see some consolidation or maybe a minor pullback as well. So we'll have to keep an eye out on that. The PCR I mentioned yesterday had moved to the upper end of the range. It's still hovering around 1.4 odd, which is still towards the upper end. Options data comes up for you on the screen. The call writers, they seem to be trying to protect higher levels. Let's see if they get stumped out on the wrong side, because both those two calls were fairly active in yesterday's trade. The 26,000 mark, well, that's there today, and we could see it in the first few minutes itself. But I think at around 26,050, well, that's where we could see some resistance going by the options data. Support comes in at around this 25,700 odd, but the markets are firmly in an uptrend till the near-term line in the sand, that's a 20 DMA, does hold out. Moving to a couple of other data points, the Nifty Bank, that's found its form. In the last 1 year, it's actually been a bit of an underperformer. In the last month, last week, it's actually been the outperformer. And that needs to lead from here on if the markets need to trend up. The sector that I'm looking at besides the Nifty Bank is going to be the metal index, because of the commentary coming in from the PBOC chief, as well as the other comments that come out of there. Supported for the stock market, supported for the economy. If that's the case, then the metal index is something you keep on your radar. And two stocks I'm looking at. RBL Bank, it comes out of the F&O ban, so we keep an eye on that one. And VIP Industries, influential investor Mr. Kedia has checked in out there, been a rank underperformer if you compare it with what it's done with Safari. And also they have a couple of big investor meetings that are lined up later this week. So VIP Industries, after a big underperformance, it's another way of playing the travel and tourism theme. So let's see how that goes. We'll keep an eye out on this one from here on.
Yes, that's a very interesting check-in to VIP. Nigel, thanks for putting that on the radar. So definitely a stock that we'll watch out for. Well, let's kick off the proceedings with the equity call of the morning. Herald van der Linde of HSBC believes that India continues to offer a strong and stable earnings growth story. He says demand from domestic investors provides liquidity and limits downside. But cracks are emerging. He adds banks are struggling to hold on to deposits as everybody flocks to buy stocks, and this impacts their earnings. But this will not derail the market yet. Herald says foreign funds are at a record high underweight on India.
All right. Well, there is a lot to track. So let's get the first opinion. And Neeraj Seth is CIO and head of APAC Fundamental Fixed Income at BlackRock. He's with us here in our studios. Neeraj, great to have you with us here. Thank you very much. And always good speaking face to face. So how are things looking, Neeraj? We had that big rate cut and markets have moved on. Are we starting a fresh leg higher? How would you describe it?
I think we are seeing the tailwind. And the big point here, because the markets are now in the debate of 25, 50, and we'll look back in time and say the more important point was that overall tide of the rate cycle had turned, which is very, very clear. So Fed is going to be easing from here. you still have probably another 150 basis points to go over the next 12 to 18 months. So from the overall economic perspective, if you think about it, US is moving towards a soft landing with lower rates. It's still a positive for risk assets. So I don't see a lot of risk in terms of the headwind at this point, unless something changes, whether it's geopolitics or US political standpoint. But for now, things are looking good.
There is no chatter. I mean, that is given. Soft landing is now the. I mean, it is the consensus, but there's no chatter about why there is. I mean, GDP is still expected to grow at 3%. Stock markets are at new highs. Credit spreads are tight. I mean, so why 50 basis points? There's a large cut. So there's no question about around that?
Well, first of all, if you take a step back and think about where the Fed is from a real rates perspective, it's probably the highest we have seen in a very long time. And given the economy is slowing down, the unemployment is inching higher, the Fed has to bring the balance back in their equation of dual mandate of price stability and the full employment. So from that angle, it's more of a balancing move to bring the neutral rate back in equation rather than keeping the rates at a level where the real rates are very high. So I don't think it's a panic move, just to be clear. They could have started in July, bit of a catch-up.
You know, I was exactly thinking this. You read my mind, Neeraj, because it almost sounds too good to be true, because you have markets at all-time highs. You have a central bank that's moving ahead of any major financial crisis or economic shock. Elevated markets, cost of money getting cheaper, soft landing. It's very golden Goldilocks, right? What does that mean? I mean, how much higher for markets then?
So I think markets, from an equity market perspective, maybe you don't have a huge amount of runway similar to what we had in the last few years, because the Fed is still contracting the balance sheet. So if you take the equation of the Fed fund rates and the Fed's balance sheet, that is a combination of the two tools from a monetary policy perspective. But one more thing which people sometimes miss is the fiscal side. You still have fairly high fiscal deficit in the system, which is actually still going through generating jobs to some extent, obviously increasing incomes, and the liquidity in the market is still high. So yes, the markets still have potential upside, but I don't think it's as much as what we've gotten used to in the last few years.
You want to put a range to that? I mean, maybe for the US and then for India as well, but just a rough range of how much higher, given that we're at all-time highs already.
So it's always very dangerous to put ranges on the market, because I know I'll be wrong. We'll look back. But if I have to take a view, I think rather than having 15-20% up, you're probably looking at more single-digit returns in the next 12 to 18 months, because the economy is going to slow down. I think that's also evident. Yes, the current data is showing strength, but we do need to be mindful of more medium horizon drivers of the economy, and that is gradually slowing down.
All right. Hi, Neeraj. Good to have you in the studio. What about the Chinese market? You know, the policy measures or the sound bites that are coming out of there this morning seem to be supportive for the economy as well as the stock market. That's the bombed out one. We have heard this before, but now it seems that they have some focus on there. Do you think the Chinese market from these levels could relatively outperform? Or do you think we've given them their chances, earnings visibility is not there, policy is not really played out, we'd rather stick to a market like India?
So what the Chinese regulators have done in terms of the reserve ratio requirement cut, which will release roughly 1 trillion renminbi of cash in the system or liquidity in the system, as well as the reverse rate cut, the key here is what they're doing is mainly focused on protecting the growth target. If you looked at the data that came out in the last few weeks, it was very clear that the 5% growth target for this year was looking difficult. Now, from a market perspective, I would argue the more important challenge facing the market is the sentiment. Alongside, obviously, the earnings growth visibility, the foreign capital leaving the market. But from a domestic perspective, the consumer sentiment continues to remain at the weakest level we have seen in decades. And that's driven more through a combination of the wage deflation in the system and the ongoing real estate weakness. And I don't think we're at the end of that real estate cycle. So would I be structurally changing my view? I don't think so.
And I think they're saying, did they say they're cutting? They cut or they're saying to cut?
They've cut.
I saw this, 2 cuts.
Yeah, so they've cut by 50 basis points on the reserve ratio already, and they're saying there could be another 25 to 50 basis points going into the end of the year. Very similar to the Fed, holding that press conference saying this is what we've done and we'll probably do more.
By the way, there is a Bank of Japan press conference as well. Any thoughts, since we're talking central banks?
I think Bank of Japan is very important, but given a combination of obviously what happened in August in terms of the markets post the last hike, and we're still very much having the LDP elections later this week. I think for now, Bank of Japan is potentially on hold. I do think they will try to hike further, but it's not coming in a hurry. The experience in terms of the tightening of financial conditions in August did actually put a pause on their thinking of going aggressively with regards to normalization of policy.
And Neeraj, just to finish that point, India continues to outperform China even from here on?
I would think so. And again, I can't say for next 1 month, but if I take a 5 to 10 year view, I think the structural story, and if you think about the combination of secular, structural, and the cyclical factors, they're all lining up in a positive way with the geopolitical tailwind. I do think the potential for markets, specifically the higher quality companies in the large cap space, I think there's still runway.
You know, I spoke with Jamie Dimon of JP Morgan yesterday evening, and I was asking him whether about this India-China question. It was interesting because we were talking about in terms of financial markets, right? But the larger point is government to government. There seems to be like this break in relations between the US and China, and that seems to be, I mean, the sense I got from that conversation. We'll play out sound bites at 8:30. Is that it's kind of in a way irreversible. I mean, they're on opposite ends of the spectrum, as he put it. And, so the rise of industrial policy, I mean, industrial policy dictating where businesses should go. In that sense, I think India seems to be pretty well placed, right? As opposed to China or other markets in the region.
It's India's time, and all you want is we don't do a self-goal. I think otherwise things are looking good. The economy is on a great trajectory. The infrastructure bill, digital, hard infrastructure, I think it's all very well aligned for structural growth story to stay for a while. And
what would you buy here? That's the troublesome question, right? When valuations are elevated, so much money is hitting the market.
So I'll start with what I would be cautious on. The small mid-cap, I'm getting more cautious given what we have seen in terms of the rally. What you will buy, I think the whole energy transformation story, the new energy sectors, they still have a long way to go. The government target of 500 gigawatt by 2030, even if we don't get there, think of the growth trajectory that is required from here to 2030 for that. So that actually is an interesting sector. There are pockets of retail and consumer where you do see value. Banks, I'm getting closer to neutral because we've seen the best of the credit cleanup behind us, although I don't think we're at the beginning of a new credit cycle in terms of NPLs. But you're seeing some challenges in terms of loan-to-deposit ratios, deposits really in deficit. So I think there are sectors which are still in a secular trend, and you still want to be actually long in those sectors.
All right, Neeraj, thank you very much for joining us. Great speaking with you, and thank you for dropping by. We'll take a quick commercial break here. We're going to come back. Lots of stock-specific action on the other side. Our research team joins in with that. So these are the stocks you'll hear on. Bharti, Firstsource, Pondi Oxides. Don't hear that often on the list. Reliance Power, GR Infrastructure. And we'll also have names like PNB, Spandana Spurti, which are expected to open in the red. Stay with us. We're back.
साथियों, मैं भारत का पहला प्रधानमंत्री हूं जिसका जन्म आजादी के बाद हुआ। आजादी के आंदोलन में करोड़ों भारतीयों ने स्वराज के लिए जीवन खपा दिया था। उन्होंने अपना हित नहीं देखा, अपने कंफर्ट जोन की चिंता नहीं की। वो तो बस देश की आजादी के लिए सब कुछ भूलकर अंग्रेजों से लड़ने चल पड़े थे। उस सफर में किसी को फांसी का फंदा मिला, किसी के शरीर को गोलियों से भून दिया गया, कोई यातनाएं सहते हुए जेल में ही गुजर गया, कईयों की जवानी जिंदगी जेल में खप गई। साथियों, हम देश के लिए मर नहीं पाए, लेकिन हम देश के लिए जरूर जी सकते हैं। मरना हमारे नसीब नहीं था, जीना हमारे नसीब है। पहले दिन से मेरा मन और मेरा मिशन एकदम क्लियर रहा है। मैं स्वराज के लिए जीवन नहीं दे पाया, लेकिन मैंने तय किया
Welcome back. So the cues are positive and we're just about 60 points away from the next milestone. That's the implied open. Tells us that that gap could take us closer to the level of 26,000 on the Nifty. So of course we have our eye on the overall market, but also individual stocks. And for that, as always, our team is standing by with the CNBC-TV18 list of top stocks to watch. Let's kick it off with Bharti Airtel. Vamakshi is watching out for this one. Vamakshi, morning. What's the news?
Well, good morning, Surbhi. Bharti Airtel will be in focus today, and on the positive side, and that is because the company has erected 1,700 towers in 7 months. Now, roughly, this space equates to nearly 8+ new towers added daily in Gujarat. And in fact, with this, they've bolstered their network infrastructure across the state of Gujarat. They will be expanding its coverage to 7,000 villages across the state, and they aim to reach nearly 5 million+ people in Gujarat. So this bodes well for Bharti Airtel, both in terms of subscriber addition as well as some bit of positive could come in as far as the market share is concerned.
Okay, all right, Vamakshi, thanks a lot for that. Well, let's move on to Vivek, who's here to tell us about PNB's QIP. Morning, Vivek.
Well, good morning. That's right, a very important development as far as PNB is concerned. So yesterday, the bank launched a QIP, and this particular fundraise is they're looking to raise close to 5,000 crore rupees. The base size of the issue is 2,500 crore, and the upsize option is another 2,500 crore. Now, when you're talking about the indicative issue price, it is seen at close to 103.75 rupees a share, almost a 7% discount to the current market price. And if you take into consideration the upsize option, it's almost a 4.5% equity dilution from the current equity base. Now, what is it that the company is raising funds for? Number one, to augment the Tier 1 capital, and number two, for growth capital. So watch out for PNB, given the fact that it's at a slight discount. Expect the opening to be in the mild red.
Okay. All right, Vivek, thank you very much for that. Let's talk about more stocks with news flow. Vamakshi is here with those. Vamakshi, morning.
Well, good morning, Prashant. Let me first start off with Firstsource Solutions. Its arm, Firstsource Solutions UK, will be acquiring 100% stake in Ascensos, and this is for a consideration of nearly 42 million GBP, or roughly around 468 crores. Now, keep in mind that Ascensos generated a turnover of 64.1 million GBP in 2023, which roughly puts the price-to-sales ratio at 0.66 times. This acquisition will allow the company to expand into retail verticals, strengthen its nearshore, as well as multilingual capabilities. Keep in mind that the retail and CPG BPO market is a $20 billion opportunity globally, as far as the company has said, and given those details, expect the stock to open higher. Spandana Spurti, on the other hand, is expected to be under a bit of a pressure today. They have undertaken sale of the stressed loan portfolio with an outstanding value of 304 odd crores to an ARC. Now, this is for a consideration amounting to 16.74 crores on security receipts consideration basis. Now, the ARC has subscribed to 91.5% of its security receipts, which would amount to 15.32 crores, while Spandana has subscribed to 8.5% of security receipts amounting to nearly 1.42 crores. This deal will definitely help the company clear its book, but on the other hand, they're getting in very little as far as the overall asset value is concerned. That is the reason why I'm going with the red for Spandana Spurti. And lastly, let's watch out for Pondi Oxides. They are looking to raise up to 250 crore via QIP in one or more tranches, and they've also determined October 16th as a record day for a stock split of 1:2. So going with the green for Pondi Oxides.
All right, got it. Thanks so much for all of those names. Vivek is watching out for some more stocks, including, I think, Reliance Power. So much news flow, Vivek, right, on Reliance Infra Power on a daily basis suddenly. Tell us what's the latest.
Well, that's right. All three of the companies, have reduced debt significantly and also announced significant fundraising plans. So Reliance Power has joined, the fundraising bandwagon. What's actually happening is a preferential issue. Companies raising a little over 1,500 crore rupees at 33 rupees a share, and they're issuing close to 42.6 crore shares. Who are the investors? Reliance Infrastructure, Autumn Investment, as well as Sanatan Financial Advisory Services. The preferential issue will enhance the net, worth of the company, and there will be zero bank debt as far as Reliance Power is concerned. What is it that they're raising funds for? For utilization and expansion of business operations. They also want to enter renewable energy and debt reduction as well. Now, talking about GR Infra, the company has emerged as the lowest bidder in a tender invited by the Maharashtra Metro Rail Corporation. Bid value of a little over 900 crores, and the EPC construction mode is what this particular bid will be done for. Total construction period of close to 30 months.
Okay. All right. Thanks a lot for that, Vivek. Well, let's hop across to Vinny. She's here to tell us about some more stocks and news. Morning, Vinny.
Good morning. So I'm keeping three stocks on the radar. We'll start with AstraZeneca. A positive move is what we're expecting. Now, the company has received the approval from the Central Drug Regulator. That's the Central Drug Standard Control Organization, and this is for a cancer drug. So very important one, especially the launch will be happening in India. So keeping an eye on that one. We also have Thangamalai Jewelry that is in focus. Now, the board is going to be meeting on 26th of September. They are going to be considering some fundraising plan, and this could be via some equity shares or bonds or something like a QIP that we're watching out for. So important for Thangamalai Jewelry. Lastly, we have Senco Gold that's also in focus on the back of a block deal. We're expecting a bit of a positive move because ICICI Prudential has actually bought 4.9 lakh shares in the company. Now, the seller of this is Oman India Joint Investment Fund. They have sold around 5 lakh shares, around 5.9 lakh shares. That's reducing their stake from 2% approximately to 1.27%. Slight bit of a reduction there, but surely had got the demand coming in from ICICI Pru, so positive expected for Senco Gold.
All right, got that. Thank you very much, Vinny, for that. So let's quickly recap all the stocks in news today. The ones that have positive news flow around them are Bharti Airtel, First Source Solutions, Pondy Oxides, Reliance Power, GR Infra, AstraZeneca Pharma, Thangamal Jewelry, and Senco Gold. The ones that have some negative news flow around them are PNB and Spandana Spurti. So that's our top 10 list for the morning. Let's move on now to commodities. We have Manisha joining in with all the action. Manisha, good morning. So, with the kind of headlines we're getting from Lebanon, you would expect a sort of a major risk premium on commodities. But I don't know, I guess oil isn't reacting that much, at least as of now, right?
Well, yeah, it isn't. But, we've seen 4% of gains in crude oil prices in the previous week. And after all that volatile move that we have seen, the crude is holding around those levels of $75 a barrel right now. The conflict between Israel and Hezbollah is something that the markets are keeping an eye on. But remember, all said and done, and with all of this conflict and violence, not one barrel of crude production has been impacted yet. And that is what the markets clearly are reading very closely with. In the meanwhile, we also are looking at a second major hurricane in 2 weeks forming in Gulf of Mexico. Now, that is something that could keep the prices on the higher side. And then again, the speculative net long positions have improved at lower levels. So there is some entry that the money managers have made at crude oil prices around $70 or so. And we've seen 28,000 lots being bought yet again in the previous week. So these are some numbers still in the developing stage. But the escalation in violence and the geopolitical tensions have been supportive of gold, holding at around $26-30 an ounce, which is an all-time high for those prices. Silver continues to gain as well. And in the base metal prices also, there are speculative long activities being improved. So whether it's copper, aluminum, zinc, we have seen new net longs being added into this one. Most of the base metal prices also in the Asian market seem to be trading in positive right now.
All right, Manisha, thank you very much for that. So commodities very much in the focus with some announcements coming in from China this morning as well. We'll take a break. We're back. Amnish Agarwal, Head of Research at Prabhudas Lilladher, will be joining in with some specific stock discussion. Stay tuned.
समृद्ध भारत के लिए जीवन समर्पित करूंगा।
if we want to take India as a superpower, we need to make sure Modi is there all the time.
Welcome back. Hope you're having a good morning. Abneesh Agarwal, Head of Research at Prabhudas Lilladhar, joins us on the show. Hi, Abneesh. Thanks a lot for joining in. Abneesh, wanted to ask you your view on metals. You know, we're having sound bites coming out of China that indicates that they're trying to make a bit of an effort out there to pull their economy out of the doldrums. What's your view on metals? You know, normally you'll see a positive rub-off, but what's the pick of the pack?
Okay. You see, in terms of metals, as you rightly said, a lot depends on China because the kind of consumption, the production which is there in China is multiple times than what we have in India. And if there are serious attempts to bring the China out of, you can say, out of a slowdown, plus the kind of interest rate cuts which we are now witnessing in Europe and US, and if there is some revival in demand, then the metal prices can actually improve from here. And Indian metal stocks usually react positively to the increase in the metal prices globally. So at the current juncture, the two stocks in metal which we are liking, Hindelco, look more as a structural pick because of Novelis and because the way the company is positioned. Otherwise, in the ferrous space, we have been liking two stocks in particular. One is Jindal Stainless and another is JSPL. But incrementally, I think it will all depend upon how the international moves come. And if the international prices remain firm and the demand revives, then we could see more of move coming in some of the metal stocks.
No, I mean, absolutely. The thing is with this China stimulus, etc., is that they've said so much over the last couple of months that they've announced some things here, there. So you got to really sort of look at what really happens. I mean, it's not like a given thing. It's not a surprise. I mean, this was expected, and a lot has been done before as well. So the market is a bit more skeptical at this point. Just a few names, Amnish, I want to throw your way. These are big movers, right? Amber was a big one, which went up. SBFC, I don't see any very much brokerage coverage, which is small business finance. Fairly recent listing, went up 20%. And maybe VIP Industries, if you have any thoughts. Amber, SBFC and VIP.
You see, VIP Industries has been under pressure. If you look at, say, last couple of years, the inventory has been piling. They have even lost some market share. But in the past few months, the company has been in the process of clearing the inventory. Now, I think the raw material prices are favorable, and the second half is likely to see some sort of a revival in demand overall for the industry because 1Q in particular, and I think even up to maybe July, August, the demand has not been that great. So like what is happening in the entire consumption space, the entire hopes are hinging on, you can say, what happens in the upcoming marriage and festival season. And with a lot of the, you can say, the old inventory getting out of the way in VIP, I think things could be, you can say, things could start improving from here. And this is one stock in the consumption space, again, which has come up significantly from 700 rupees plus, and the kind of frenzy we are witnessing in your consumption stocks. I think VIP could also be, you can say, one such stock where the market believes that the performance might have bottomed out, the things might start looking up with the revival in the festival season.
But VIP versus Safari, what's the choice between the two at these valuations, at these levels?
I have been preferring Safari over VIP because the visibility of growth here has been strong. In Safari, I think they are expanding the capacity significantly and they have been gaining market share. So on a relative basis, we prefer Safari over VIP.
Got it. All right. Let's talk about a couple of these PSU banks. Then, you have PNBA that's announced that QIP of around 2,500 crores. And there was a big, a lot of enthusiasm with regard to PSUs on the whole, and banks as well did participate. In the last, 10 days or so, we've seen that the private sector banks actually have outperformed. Your pick from the banking space?
You see, PSU banks have been leading the pack. If you look at, say, last 12 to 15 months, PSUs have done particularly well. The price to book of most of the PSU banks, say 1 year and a half back, it was 0.5, 0.6, and subsequent to the re-rating, which is, it was not in the air. You see, your books are improving, your NPAs are coming down, and the growth rates have been better. But now, if you look at on a relative basis, private banks, their price to book today is significantly lower than where they used to trade pre-COVID. So that is why the private banks actually give you a good trade at the current juncture. And in case of, say, private banks, particularly, you see, barring ICICI Bank, you look at SDFC, you look at Kotak, you look at, say, all other IndusInd, Axis. So all of them are trading at a discount to their pre-COVID levels. So with your NPAs under control, growth rates improving, I think the private banks actually can provide very steady returns even from the current levels.
Absolutely. I got that. Just a few other names here, Amnish. The auto names, right? I mean, Friday was a big day for names like M&M, Escorts. Yesterday, again, autos are doing well. M&M was the top gainer on the Nifty. Bajaj Auto sort of piled in. There was Hero, which did very well. This is just sort of rural recovery. I mean, that's the play which is working its way through.
Shant, it does seem so, because all these three stocks, they're a big play on the rural recovery, and with the monsoons being normal, a lot of hopes are there on the rural side. And you see, these two stocks, M&M and Escorts, they have got tractor, but at the same time, M&M is perhaps the only player. If you look at the entire PV space, they are still growing in double digits relative to others which have been flattish or they have shown declining volumes. And with the Thar new launch which is coming, I think a lot of, you can say, the build-up and hopes are around that. And if their volumes in your PVs, they continue to be showing the growth the way I think M&M would have more legs, more upsides in the, you can say, coming months and quarters. Now coming to Hero, I think a classic, your rural play, and with the revival in rural demand, I think Hero should do well. In the past, say 6 to 7 months, the stock has done well, and I think from here on also it can outperform at least for the next 3 to 6 months.
Okay, all right, Amnish, we'll leave it there. A quick conversation, shorter conversation there, but appreciate you coming on here as always with us on CNBC. What we want to do is play out sort of the big CNBC TV18 exclusive. This is veteran banker and JP Morgan Chase's global CEO, Jamie Dimon, saying that India is doing a lot of things right. It's shown a lot of optimism about growth prospects. I spoke with him yesterday, and he said there is a lot of room for interest rates in the US to go down. We spoke about geopolitics, which he thinks is the #1 determinant for projections about how the global economy is going to do. And there he's skeptical. He thinks geopolitics is getting worse, and one needs to be prepared to deal with what may be coming our way. Listen in to some of that conversation from yesterday.
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals. Obviously, every nation look at it and say, we can't rely on someone who might one day be an adversary. That doesn't make them an adversary today for supply. Just like JP Morgan's always have multiple diverse supply chains. We don't rely on anything. The second one is around disagreements around policy, like, if countries are aiding and abetting industries to dominate a global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. The semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. For India. A huge opportunity for India. People call it the China +1 strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got U.S. elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that? I mean, in that sense, what's happening is in a way irreversible? you know, the break in relations, sort of a Cold War?
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one, so that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about, you know, disconnecting.
Let's talk about you know, the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, the stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, you know, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit, you know, growth with, you know, inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
I'm not... so my caution is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, you know, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries get involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest question. You know, the economy fluctuates. I don't worry that much about the fluctuation of the economy. And you know, obviously the Federal Reserve will try to do its job to moderate, you know, the vicissitudes of the economy. But we are spending a lot of money. And, you know, in my view, that spending the money causes growth. It also causes inflation. And whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm, you know, long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm put me on the cautious side of that one.
Right. I mean, rising interest rates did not hurt markets. Will falling interest rates be an impetus? I mean, can they be a further impetus?
Yeah. Again, so when you talk about rising, you know, things are, sometimes history rhymes, but it's not always the same. I think when rates went from 0 to 2.5, that was barely rising rates. That's just kind of normalization. And we had very strong growth coming out of COVID. So, you know, 5% was probably needed to slow things down just a little bit. Yeah, underneath the rate, there's a real economy. No one knows what that real economy is going to do next year. No one. And so I don't look at it like, you know, they're panicking to, you know, maybe the economy gets stronger, maybe it's going to get weaker. And so they're trying to remember they're reacting to data they see today. You know, and then you can try to predict what the data is going to be a year from now. I think there's more underlying inflation because of things like the green economy, fiscal spending, remilitarization of the world, demographics. Those things will drive inflation down the road. And, you know, even AI, in my view, right now it's a little inflationary because we're adding a lot of talent around data. You know, it's not, the deflationary part may happen, but that may be several years down the road, yeah.
Right. You are, when you say you are a bit more skeptical, is that the economy you're skeptical about or markets and what they're pricing in?
Both.
Both.
You know, I think the stock markets and the bond markets are pricing in a soft landing. Okay. But you also look at the stock markets are generally very high, and bond spreads are very low. And, you know, that's kind of Goldilocks. And that may very well happen. I mean, I'm hoping for that. I just give it a lower odds than the market does.
Of that happening.
Yeah.
Well, interesting conversation between Prashant and Jamie, and we'll keep getting you snippets all through the day. So stay tuned to that. For the time being, though, we'll slip into a short break. You come back, we'll get our technical experts, Mitesh and Sudarshan, are waiting for us on the other side.
A very very proud to be Indian, and today I am very proud to say that our Prime Minister put India on the map in the entire world.
We are so proud that we have this kind of hard-working Prime Minister, and we are very, very excited to see him.
Today, he had a great opportunity to sit down on the Quad Summit, and the way he presented the country on those four countries, we are very proud.
Okay, all right. We have the market open in about, 11 minutes or so from now. Mitesh Thakkar and Sudarshan Sukhani are with us with what they'd want you to do as far as trades are concerned. Gentlemen, great to have both of you here. Mitesh, very, very close to 26,000. Will that be a psychological resistance even for a bit? Or you think market cruises past that?
Prashant, typically, I think, I would say that yes, there should be some supply around this 26,000 level. Though we have extended targets of around 26,400 to about 26,500, but typically the round number does, typically warrant some kind of profit booking. So the way we'll do it is that post the gap up, I think till the gap is filled. So let's say you'll have about 70, 80 point kind of a trailing stop loss. Suppose the gap up, just use yesterday's high as your trailing stop loss, maybe 5 points below that, and hold on to your long positions.
Got it. Okay, hold on to your long positions. Got that. Sudarshan, what's your call on the index?
Yeah, good morning. Well, the market is in a strong uptrend. We want to stay long and try to buy on every dip. Now, there's another point. We had a very big rally on Friday, Thursday, Friday combined, let's say. Now, that rally requires a lot of consolidation. So we are likely to consolidate in the next few days, 2, 3 days, 4 days. I mean, no one can predict how many days. But within that consolidation, every dip remains a buying opportunity because the assumption is once this consolidation finishes, we'll again break on the upside. So stay long and look for dips to buy. Keep a 100-point stop loss.
Got it. All right. Stay long on the index. Look to buy the dips. That's a clear message coming in from Sudarshan as well. Sudarshan, why don't you go ahead first and tell us what are the stock picks you have for the day?
Sure. I have a long list of my mid-caps. Canbank is a buying opportunity with a stop under 101. Balrampur Chini is a buy with a stop under 556. Power Grid is another buying opportunity, stop under 328. And SBI Life, the last and fourth buy with a stop under 1823. The common theme for all these four stocks is that they are going through minor dips. So essentially, we are looking to buy on a minor dip, which is a good location to buy.
Okay, all right, now got that. Mitesh, what about you?
I have a buy on L&T Finance with a stop at 180 for targets of 192. HDFC Life is a buy as well. Keep a stop at 714, look for targets of 755. Sale or Steel Authority, I would want to buy on a mild decline. It's around 128, 128 half. Buy here with a stop below 124 half for targets of 136. And final buy call is JK Cement. It rallied well yesterday, but just trading at the supply pivot. So around 4,800. So wait for the stock to get past 48, 10, 15 and then buy. Keep a stop at 47.45 and 49.60, 49.80 should be the target area.
Right. No, got that. By the way, yeah, you're absolutely right. I mean, that insurers which all got sold into, they've been recovering last 2 days actually. And yesterday was both HDFC Life and SBI Life both did well, were some of the big gainers of the Nifty. The auto names, Mitesh, I don't know, Bajaj and Hero, these are Mahindra and Mahindra is the other one. 2 or 3 days now, I mean, they're seeing some action. Technically, how are they placed?
So we've had buys on, sorry, not Bajaj. We had buys on Hero Motors and Mahindra. I think they both look good and there should be more trading upside from these levels for these stocks. The only thing is that Bajaj I would want to avoid purely because of the rally which has already happened. So if you enter now, your risk reward equation is very skewed. But Hero Motors on a mild decline, I would still be a buyer.
Okay, all right. Thanks a lot for that, gentlemen. We'll come back to you all for your 9:10 call. For the time being, we'll slip into a short break. We come back, we'll get you the pre-opening rates. We'll also have with us Dayanand Mittal of JM Financial to focus on the oil and gas sector. Stay with us. Welcome back. Hope you're having a good morning. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, let's get in Avni Bhatt then, who joins us to help us out with some F&O strategies. Hi, Avni. Good morning and good to see you in as always. First up, are there any cautious signs with regard to some of those data points that are looking a little bit stretched? If you could give us a couple of observations there.
Good morning, Nigel, and a very good morning to all the viewers as well. There is no red flag as such currently. The only thing is that the pace of up move may probably slow down, because yesterday we had seen an uptick in India VIX of almost around 7.5% without any major short covering rally and in spite of a positive price action. So this indicates that the pace of the up move may slow down from here, but there are no red flags as yet. Second pointer is the FII long short ratio. It is at 75% longs. Once it reaches around 83 to 85%, that would be a good time to ring the caution bell and book out some profits from those levels. Till then, I think one should enjoy the FII participation and the contribution to the up move.
So tell us your strategy then on the Nifty. It's the GIFT 50 suggesting we start out gap up with a gain of around 50 points. Would you chase the opening? Would you be looking to buy on dips? And if you could give us levels on the down and the upside.
Yes, so there's a clear trading strategy for Nifty. This being the monthly expiry, there's a huge open interest built up at 26,000 call. So in case if Nifty manages to cross 26,000 and sustain for at least 15 minutes during the day, I think we'll see a very good sharp, a rally, short covering rally on the upside that may take Nifty up to around 26,200 in no time. So a clear-cut trading idea is buy about 26,000, keeping a stop loss of 25,800 on the downside, and upsides could extend up to 26,200 to 26,300 levels. That would be the trading strategy on Nifty. Similar trigger levels for Fin Nifty is also around 25,000 mark. So that's the trading strategy on the index.
Yeah, let's wind this down with stocks then.
So some of the stocks, I have 3 stocks on radar. All 3 are reversal plays, as chasing breakouts can be dangerous at the current juncture. The first is Coal India. It has seen a good recovery post Friday's up move. Yesterday, we had seen some follow-up buying also, with 12% long addition in futures and 11% uptick in volumes. So it's a good candidate for reversal. One can buy in the region of 495 to 500 for a target of 535 and 540, keeping a stop loss of 485. The second space is the insurance space. We had recommended SBI Life Insurance on Friday, and it is almost hitting our targets. Another stock on the reversal point is HDFC Life from the space. One can target around 760 to 775 levels on the upside, keeping a stop loss of 702. And the third stock is from the banking space, which is IDFC First Bank. A very long consolidation seen, and a good support base has been formed at 70 to 71 area. So one can buy the stock for a target of 77.5 and 80 for the October series, keeping a stop loss of 71.75.
Okay, all right. We'll leave it there. Avni, thank you very much for joining us, and good speaking with you here on CNBC this morning. I mean, the first rates in the pre-open are also coming through. We've got the Nifty, which is down about, obviously not 200, but it's just the first sort of rates all over the place. Should settle down in a bit from now, and we will have more settled rates in a couple of minutes or so from now. Amnish is still with us. Amnish, thanks very much for waiting. I just wanted your thoughts on, I don't know if you've, a couple of stories on Reliance Infra, and I mean the comeback in that sense of the ADAG stocks. Fundraising happening in Reliance Infra, 2 prominent investors putting in money, the debt level, the debt being cleaned out, looking at newer opportunities on EVs, etc. I don't know if you've looked at this, and how would you read it? Casually, people kind of, make all kinds of comments. Well, things like, that group starts to raise money. What does it mean for the market? But I think that may be a little unfair if you've not looked at what they're trying to do very specifically. I just wanted your thoughts.
Yeah, Prashant, I am not on top of what is happening in that company. So for me, not fair to make any comments.
Okay, that's a safe one. Got that. Amnish, what else are you watching out for? What's catching your interest?
You see, the main thing which is happening is, which I believe that lot of hopes are getting built in on the festival season, rural, and what happens in the coming wedding season. So, like we used to say in case of, say, infra and many of these stocks, that every year we see that second half is going to be the driver. And it took many years for the recovery actually to set in. Now, the kind of valuations many of the sectors are trading at, and the kind of optimism which is built in. So next 3 months are crucial from the demand viewpoint, whether it is rural, urban, or you can say broader demand. If we see any sort of a weakness in the demand in comparison to what people are anticipating, then I think that we might be overestimating the kind of, you can say, uptide in terms of, say, the overall growth.
Okay, all right. Thanks a lot, Amnish, for joining in and helping us out with some fundamental analysis. Wishing you and your team a good day ahead. But let's turn our attention to the oil and gas space. Dayanand Mittal, the oil and gas analyst at JM Financial Institutional, joins us on the show. Hi, Dayanand. Good morning and good to see you. And thanks a lot for joining on the show. We've seen a bit of a bounce in oil prices, according to the sheet that you all put together. What kind of range are you working with? First on Brent crude prices.
Yeah, thanks, Nigel. Good morning. So our view has been that the recent correction in oil price was more on account of exaggeration of the weakness in Chinese demand. So Chinese demand has been soft, but nowhere it has collapsed. So instead of global oil demand growing at about 1 million barrel per day or about 1%, it has been cut by about 10 to 20 basis points, but still oil demand growth is robust at about 0.8% or so, which in no way is a shocker. So the recent collapse in our view was more due to a lot of speculative activity which takes place in commodities, and hence it was an exaggeration of that. Our view on crude price is based on the presumption that OPEC Plus still continues to have a very strong pricing power. Primarily because OPEC Plus during COVID times had cut output by 10 million barrels per day. As of now, they've cut output by still about 5.5 million barrels per day. So they have enough headroom to cut further in case there's a demand shock. And second, US crude production has not been rising despite the very high oil price we have seen over the last few years. This is because of a lot of ESG concerns, unavailability of equipments, and more importantly, US oil companies becoming more sanguine and focusing on ROC rather than just simply on growth. And hence OPEC Plus, we believe, will continue to have a very strong pricing power, and they will try using that to ensure crude stays around that $80 per barrel level, which is a fiscal break even for Saudi. So views continues to be around that level. That Brent will stay around that $80 per barrel. It will not spike beyond 85-90, given the lot of demand concern, and fairly so. So yeah, around $80 is what we think it will stabilize at.
Okay, interesting. Dayanand, thanks for neatly putting that together. Then how do you approach stocks? If you believe that Brent is going to be holding at around $80 per barrel, will you look to buy into ONGC and Oil India, which weakened a little bit in the last month or so, but from the recent lows, they bounced well as well?
Yeah, that's exactly our view. So we have put out a note last week highlighting the same thought, that we continue to prefer the upstream company, particularly Oil India, given the very strong production growth outlook over the next 2-3 years, about 30-40%. And also ONGC, given about 12 to 15% cumulative production growth outlook over the next 2-3 years. As we all know, because of windfall tax, their realization is capped at 75. So anything above 75 gives market that comfort that 75 net realization is here to stay. So and valuations also, though all the PSUs have rallied, but here in upstream companies' case, both ONGC Oil India valuation are still in a reasonable zone. And hence we prefer ONGC Oil India over the OMCs, where we believe probably valuations are a bit stretched, and also refining margin, we are not as bullish about refining margin as many in the streets are. And marketing margin, the current high marketing margin, we believe is not a sustainable one. It might stay for a couple of months, a couple of quarters, but yeah, it's not sustainable. So one should not bake that in future estimates.
Got it. All right. What about how do you approach the OMCs? The fear is that we have a couple of big state elections coming about. Crude oil prices have been a little bit weak as well. And that's what could weigh on these counters. Your take?
Yeah, so as highlighted, so we believe the current high marketing margin which they're making, which is 6, 7, 8 rupees above the historical margin that they earn, that is not sustainable. It's just a matter of few months, quarter here and there, when government either cuts fuel prices or in our view, most likely they will hike excise duty. They would not like to preempt crude price and take a fuel price cut, given we all know crude is highly volatile, geopolitical tensions are pretty elevated, so crude can bounce back any moment. So reversing fuel price cuts in India might be a challenge. So safer move for the government might be to go for an excise duty cut and some marginal fuel price cut. Yes, elections are around the corner, but as you know, it's just in a couple of states. So doing a pan-India cut may not be the most likely move, or if any, it might be a limited couple of rupees only, I guess.
So preference is more for the producers rather than these oil marketing companies, it seems. Anything else you like with regard to the oil and gas space? Any big calls, buy or sell recommendations from the space, besides the names we've already discussed?
Yeah, so in the gas names, we like Gujarat Gas among the CGD space, particularly because we believe spot LNG prices in the medium to long term are likely to moderate from current 16-17% of crude. It might moderate to more like 10-12% because a huge LNG supply capacity addition which is happening globally, particularly in Qatar and US starting CY26. And hence, moderation in spot LNG price boosts competitiveness of Gujarat Gas business model versus propane. So that stock we like. We also like GAIL, given the gas transmission business is doing relatively well after a tariff hike last year. Plus, India's gas consumption is likely to grow at 5-6% CAGR. The gas trading business is doing relatively quite good. So we like GAIL as well. And overall, Reliance, though, is not purely oil and gas, but yeah, we like Reliance with more due to telecom and retail business.
Okay, all right, Dayanand, we appreciate you joining in and helping us out with your analysis of the sector. Wishing you a good day ahead, and we look forward to chatting up with you in the near future. Well, let's get in Mitesh back as well as Sudarshan to help us out with the 9-10 call. Sudarshan, you go first.
SBI Life, considered buying SBI Life with a stop under 1823.
Got it. Okay, all right. And what about you, Mitesh?
Yeah, L&T Finance, buy for targets of 190.
Okay, all right. Thanks a lot for that, gentlemen, for joining in and giving us your picks out there. Well, let's focus on the metal space. China has announced a slew of measures which can be positive for the metal stocks. Now, they say that the PBOC will cut the reserve requirement ratio, which is more commonly known as the RRR for banks, by around 50 basis points. They've stopped short, though, of giving a specific timeline for this cut. They've also hinted that the RRR could be cut by another 20 to 25 basis points by the end of this year. They've also given a few more highlights, and let's run you through a few of them. They say that they'll cut rates on the existing mortgage loans. They'll cut the 7-day reverse repo rate by around 20 basis points. It's at around 1.7%. They say it'll come down to around 1.5%. And they'll also cut the minimum down payment ratio for second homes to around 15%. Earlier, I understand it was around 25%. So that's a slew of measures that they've already announced. And that big RRR cut is something that will enthuse the metal stocks on the whole. Phillip Capital, they have said that they maintain their positive stance on metals. The top picks for them are JSW Steel, JSPL, that's from the ferrous space, and from the non-ferrous space, Nalco and Vedanta. They've also recommended accumulating NMDC as in sale, but in a staggered manner. So the metal index could be in the focal point today, going by what we have seen in terms of action coming in from the Chinese regulators. But let's move on then. Let's talk about utilities. Vivek joins us to run us through a Motilal Oswal note and all the stock that he's tracking. Vivek.
Well, good morning. A very interesting note coming in. It's a thematic note that is coming from Motilal Oswal. They've written on the utility space, and what is it that they're seeing? They're seeing a colossal multi-decade investment opportunity where they see investment of close to 40 trillion rupees. Now, when you're talking about this particular investment, how is it that they're breaking it up? Firm opportunity of 34 trillion rupees in firm capex and another 8 trillion rupees as an optionality upside. Now, out of this spend mix, generation spends are expected to see 86% of the total mix, transmission close to 10%, and smart metering another 4%. What, according to Motilal, are the key tailwinds for the sector? Number one, power demand today is accelerating at a higher 7% CAGR versus a historical trend of 5% CAGR only. Also, they see a lot of spends coming in as far as upgradation and replacement of old infrastructure as far as the utility space is concerned. As the electricity mix undergoes a shift, now they're looking at more renewable energy, all-day electricity coming in. And lastly, they're seeing transition to cleaner sources of energy, given India's target of 500 gigawatt in renewable energy capacity by 2030. So what are the stocks that they like? They're initiating coverage with a buy rating on Power Grid, JSW Energy and Tata Power. They have a neutral rating on NTPC as well as IEX. Watch out for the entire space in the few coming days.
Okay. All right, Vivek, thank you very much for that. By the way, Vivek, since you're there, I mean, a lot of interest in the Reliance Infra stock, Reliance Power. I mean, anything new? What are you hearing on these names?
Well, that's right. Fondly calling them as the ADAG group stocks. So what essentially happened, as far as Reliance Infra is concerned, Reliance Power is concerned, and the other group stocks is the fact that, number one, there has been quite a lot of debt reduction that has happened. And number two, there has been a significant improvement in terms of the net worth, given the fact that there has been fundraising that has been done successfully. In some cases, it's actually the promoter entity that has been infusing funds, but also there have been some noted investors that have come in. So, this particular space too and that particular group too, given the fact that the listed entities now have zero bank debt, is something that we'll keep an eye out for. What we'll also have to watch out for is the kind of promoter pledges that exist, and that is something too that we'll need to keep a close track on.
All right. All right, Vivek, thank you very much for that. That's basically the ADAG stocks which are in focus. Well, I think we've got a couple of seconds to go for market opening, and there is a lot to track in terms of individual stock-related news flow, but the broader market as well. For the index, of course, there is the question of 26,000. Let's just look at what the pre-open has left us with. 25,921, a flat kind of a start. Slightly down, but nothing at all. The Sensex should also come up, the Nifty Bank, and where that is at. And we'll see whether there is, sort of continued momentum in some of the names which have done very well recently. Auto is really top of the list there in that sense. So 70 points lower on the Sensex, about 17 points lower on the Nifty is what we have. Okay, first trades coming up on your screen. So 25,920. 0.07% change. Nifty Bank, 54,032, 0.16% lower. We've got the Sensex, which is down about 0.25%, 84,760. Midcap index is starting just so slightly in the green, about 0.15% higher. IT index, actually the IT services index was the top loser yesterday. One of the very few which was down, 0.75%. It's down another 0.5% this morning. So 41,791. It's down another 0.5% or so as we begin the session. The heat map on the Nifty appearing on your screen now. Equal number of stocks which are higher and lower. I think more down than up actually on the Nifty. A 30-point cut to begin the session. Let's get to stocks. Nigel.
Well, that's right. Fusion Micro, that's the one that continues to be the top loser today. It's down close to 5% and falling on very large volumes. Investec has downgraded the stock to sell. Target price has been cut to around 300 rupees. CLSA as well, they have downgraded the stock to underperform from outperform, and they have halved their target price to 260 from around 550. So that one, in fact, is down close to 20% in the last two sessions. You have SBFC. Well, that one, in fact, yesterday was up close to, I think it was locked up. That one is taking a hard knock today. It's down close to around 3%. Maybe, in fact, just there's some mild profit taking after the big move that we saw yesterday. But metal stocks, they're in focus, as we mentioned earlier. The sound bites coming out of China were encouraging, and they are indicating that they want to do something to get their economy up and running. So you have Nalco that's up close to around 5%. Big move you're seeing out there. The other ferrous names as well are moving up. Tata Steel is up. Vedanta, I think, as well should come up for you on the screen. There is that niggling worry with regard to what goes on in their alumina refinery. For the time being, though, the stock has popped up and it's up close to around 2%. So good move out there. VIP, we mentioned earlier today. Then Mr. Kedia had checked in. He bought close to around 7.5 lakh shares. In the next 2 days, they have a lot of big investor meets that are lined up as well. And VIP has been a big underperformer. In the last 1 year or so, the stock is down more than 10% in a very, very buoyant market. So that stock is, well, one of the top volume winners in trade today. GMRPA, I think there's an initiation note coming in there. So that stock has opened up with good green, up close to around, I think, 4% or 3.5% as we speak. So in the frontline names, metal stocks are doing well. Nalco, NMDC, SAIL. You have Escorts, Kubota as well. That's up close to around 2%. So some of the top volume movers out there. And Ramco Cement is one of the top volume losers in terms of the F&O market. So that one's down close to around 1% or thereabouts. But let's get a chat going. Surbi has hopped across to the JPM conference, and she's speaking with James Sullivan. Surbi, take it away. All right, I think we'll get to Surbi in just a bit from now. But the reason that the Nifty is down is because the tech pack, you have Infosys that's down close to around 1%. Wipro is down, HCL Tech. So tech is dragging actually in today's trading session. Put up the IT index. Both the pillars of the market have started off on the back foot. That's tech as well as the Nifty Bank. But the Nifty Bank has been the leader. It's been the one that's driving the index up. So we have to see whether or not this dip gets bought into on the Nifty. What's doing well? Metal stocks, but they don't account for very much in terms of a weightage out there. But as promised, Surbi's got James Sullivan, the head of APAC research at JP Morgan. So let's go across to that conversation. Surbi, take it away.
Well, Nigel, thank you so much for that. I'll tell you what, we were discussing some running stories around the streets of Mumbai, not so much markets, but now we'll take James's focus back to the market, which continues to make such headlines over here. James, it's such a pleasure to be here with you in person, and thank you for making time for us. And we talk at a very interesting time, right? Because we have global markets at all-time highs, and now you have the central banks increasing the music, whether it's the Fed or the PBOC overnight. Can the party continue?
Thank you very much for having me. It's great to be back here in Mumbai. Look, I think that the critical element to think about from an Indian market perspective is the degree to which market performance for the past couple of years has been really a DIY story. If I look at flow of funds, it's been almost entirely domestic investors that have driven this market, and yet that still has further to go. If I look at domestic household participation in the equity market, we're only at about 5 to 6% of Indian households, which is low for most emerging markets. So again, more runway from here. If I look at foreign investors, you're still looking at foreign investors dramatically underweight this market and falling farther behind as the market continues to perform. The JP Morgan estimate is that we need to see about $100 billion in incremental inflows into Indian markets for institutional investors to just get to neutral.
Wait, let me come in over there. $100 billion of inflows.
That's correct.
Just to get to neutral weight.
Correct.
And do you really see that kind of money coming in, and over what time? And then what happens to valuations in India?
So year to date, you've only seen about 10 billion in inflows, so an incremental 90 billion to go. And then incrementally, we need to look at sector and stock selection to understand where that's going to go. We still see a very strong earnings growth story coming out of specific sectors within the Indian economy, in particular infrastructure, construction, as we start to look at supply chain relocation, which has not yet occurred coming into this market. So again, going back to this theme of market performance and economic performance has been very DIY in nature. It's been Indian corporates driving CapEx, not FDI coming into India from offshore. As that starts to occur, you still have significant incremental economic growth and therefore earnings growth, which makes valuations significantly more palatable.
Okay, just one more question, and then my colleagues in the studio also have several questions for you. Just this morning, we've seen easing measures out of China. And we know that that's one market that a lot of foreign investors have stayed away from for obvious reasons. Tactically, do you see China getting more flows, or will they keep coming to India for the reasons that you described?
So 2 points I would make. Number one, again, you have not seen aggressive foreign buying of the Indian market yet. So it's not like that's going away. It hasn't actually occurred. And so incrementally for that to come, you'd see the Indian market go up, not down. The conversation regarding China gets interesting. What we've seen from most investors is we've seen some folks start to come in and bottom fish in certain sectors where you have very low valuations and very strong cash flows. In particular, in the internet, e-commerce space, we've seen some incremental foreign buying. It's very much, we'd like to see the data points, not the announcement, however. And so I do think you'll have to see earnings come through in a more aggressive fashion to see fund rotation back into China from here. But we are overweight certain sectors of the China equity markets off the back of very low valuations and very low expectations.
Okay, great. So we're getting the money. We've been getting a lot of the domestic money, and we're probably going to get more foreign money as well. Let me just quickly hand it to my colleagues back in the studios. They have some questions as well. Prashant, Nigel, over to you.
Surabhi, thanks very much for that. That's a big number, right? $100 billion to get up to sort of neutral weight. James, one of the things we've heard sort of repeated again and again when we speak with investors, foreign investors, etc., is that this underweight may remain because valuations remain very high and foreigners kind of feel left out. And they don't really want to chase stocks higher because that's what they'd have to do. I mean, it's a very different situation if they came in size a year ago or a year and a half ago. Do you think eventually, I mean, people will just throw in the towel and they'll have to just get in, or it's possible that they stay out for a while longer? What's your sense?
No, thank you for that. I think there's two different criteria that I'd be looking at, particularly from a foreign investor perspective. Number one, earnings incrementally have to come through. First quarter was a little bit on the slow side. JP Morgan estimates is that you'll see a re-acceleration in certain sectors, but not the overall market as a whole. And so again, very clear stock and selection bias rather than just broad asset allocation into the Indian market. The other reality, if I'm looking at it from a foreign investor's perspective, however, is tracking error relative to my benchmark. The degree to which India market outperformance continues to accelerate and I'm underweight, I'm seeing more and more drag on my overall performance numbers. So you could start to see investors try and square those positions as we come into year end. It's also just very interesting from an investor psychology perspective. Most investors will close out their books at the end of this calendar year. You effectively get a new risk budget on January 1st. That does drive many investors to start to more aggressively change their asset allocation across countries and sectors off the back of that fresh risk budget.
James, just, you do mention the state elections which are lined up, right? So apart from valuations, do you think politics is a determinant for how investors will view the Indian market in terms of policy direction, etc.? We've had a substantial increase in handouts, or at least talk of handouts, across elections which have happened over the last 1.5 years or so. And, once you roll these out, it's very difficult to take it back. You can only expand on it. That's essentially the experience. What is your sense? I mean, could that be a trigger? And is that a risk to watch out for?
No, it's a great question, and I would approach it from at least two, if not three different directions. Number one, from a macro geopolitical risk perspective, it's important to understand the degree of risk premia built into markets. Given valuations here in India, there are not significant risk premia built in, which is important for investors to keep in the back of their minds. There's not a lot of wiggle room in the price from a geopolitical risk perspective. Now, that said, from a policy perspective, we've seen relatively clear policy goals out of the national government here in India. We've seen very clear and effective implementation across a lot of those goals over the course of the last couple of years, which is clearly investor expectation moving forward. I would highlight that the recent election here in India, as you say, has resulted in slightly more income redistributive policies coming out of the central government. At the end of the day, given the nature of Indian economic development, and Sajid Chinoy, who's our chief Indian economist, talks about this quite a lot, there's been this concept of this K-shaped economic recovery. Dealing with the bottom leg of that K is absolutely critical for economic growth, particularly on the consumption side in India. And so the fact that we are seeing government policies more proactively address that bottom leg of the K, that's actually very important for economic growth as well as political stability here in India.
Okay. All right, James, just some more questions before we let you go. So now that it's been established that there is more money coming in India and maybe foreigners are going to play catch up sooner rather than later, I think the question that people are grappling with is what to buy in India. We've had this phenomenal PSU move, state-run companies, their move play out. Those stocks are off their peaks. But do you think that's where people will go back and gravitate in? Is it still going to be manufacturing or capex? Or will there be a return to, say, consumer staples or even banks, which haven't done that well in the recent past?
I think one of the consistent refrains that we talk about at JP Morgan and we hear back from many, in particular foreign investors in Asia, is really trying to understand where government policy is going to inflect different areas of economic growth. We're seeing that very clearly in China, where investors are trying to follow government pronouncements and follow different favored sectors in the Chinese economy. Here in India, we see significant incremental government capex in infrastructure in particular. Again, that's been almost entirely Indian government as well as Indian corporate-led. We have yet to see that influx of FDI into supply chain relocation, which we do incrementally expect as well. So industrials, infrastructure are our favorite sectors. We would also highlight from a regional perspective, we talked about geopolitical risk earlier in the conversation. We are seeing very strong performance out of defense stocks in almost all countries in Asia, Japan, Korea, here in India, where you've seen very, very strong performance for some of the names from a bottom-up perspective. And as the Indian government continues to seek to diversify its suppliers in that space, we would expect to see continued sector performance.
All right, so still optimistic on some of those themes that have done really well in the last year and a half over here. Final question, James, what would be the biggest risk for this market, for India?
I think if we start to see significant policy questions moving forward, the critical element of India really over the course of the past two administrations has been policy clarity and very effective implementation of policy. If you look at Aadhaar, if you look at direct payments to citizens, if you look at a lot of the different macroeconomic policies that this current administration has pushed forward, that's been a clear driver of not only economic performance, but also drag on market performance. As we start to look forward, any shift in terms of policy certainty, any shift in terms of an investor's ability to understand what are the goals of the Indian central government introduces risk in forecasting. Risk has a price.
Okay, all right. So as long as policy continues to move at the pace that it has, and if there's stability and continuity, we're getting $100 billion in inflows in all probability, right? That's the big headline. Thank you so much for joining us today. Pleasure having you right here with us, and this conversation very, very helpful. Thank you very much.
Thank you.
All right, folks, back to you guys in the studio.
Thanks a lot for that, Surabhi. Interesting conversation as always with James. But let's get back to corporate corner then. JK Cement, that's the first management on the show. The stock is up close to 25% in this year. In fact, Motilal Oswal, they reiterated their buy rating. They've raised their EPS and EBITDA estimates for the next two fiscals. Unchanged for FY25, but for FY26 and FY27, they have upgraded their estimates a little bit higher. Mr. Anuj Khandelwal, the business head at JK Cement, joins us on the show. Hi, Anuj. Good morning, and thanks a lot for joining in. Well, let's talk about demand first up. You know, the first quarter was marred because we had elections. There was a heat wave as well. And the monsoon season as well, normally impacts demand. But how do you see demand shaping up? There is talk of some production cuts, of demand being weaker than expected. So give us your estimate with regard to demand. How do you see things shaping up? And what does it mean in terms of volume growth for your company, JK Cement?
Good, Nigel. Firstly, many thanks for having me on this segment. You've rightly said, look, the last 6 months, it's been quite a flattish growth for the industry, but it was more or less anticipated given that we were coming off a very high base year. Last year was the pre-electoral demand, year for cement, if I might say so, where, in the first 6 months, the demand had grown by around 15% over the previous year. So this year was expected to be muted in terms of growth in the first 6 months, first due to elections and then intense monsoon, higher than normal. In the next 6 months or so, we are far more positive about how the demand will play out. Maybe we'll have let's say in the next 6 months, around 6 to 8% kind of a growth in demand versus H2 of last year. So in the whole year, it'll be around, let's say, 3 to 4% kind of a demand growth for industry. We as JK will try to beat the industry growth by a few percentage points.
All right. So the industry grows by 3 to 4%. What kind of a volume growth should we be looking at for JK Cement? I think in the past you were hinting at high single digits for FY25. Is that still on?
Yes, that is absolutely on. So if the industry grows by overall for the full year by 3 to 4%, given that we are in a way pegging the next 6 months to grow at, let's say, 6 to 8%. So hence, if the full year industry grows by 3 to 4%, we'll try to grow by, let's say, 7 to 8%.
7 to 8%.
And if the industry grows more, then of course our growth rates also will be higher. But tough to say. We really hope, as your guests in the previous segment said, that $100 billion might come to India. If some of it also makes way to infrastructure segment, of course we'll be talking of bigger numbers.
All right, let's talk about pricing then. Demand, you're sounding optimistic about a recovery and you'll outpace what the industry will do. What about pricing? You know, Anuj, in the last 2 to 3 weeks, I've been flooded with information. Price hikes being taken, price hikes being rolled back, part of it getting absorbed, part of it getting rolled back. What's the current situation on pricing? Because pricing is at multi-month lows. In fact, I could say multi-year lows as well. When do you push through your first price increase? Start of October?
It's a difficult question, Nigel. Look, we need to understand how these 6 months have gone by. First an election and then an intense monsoon. So you are right, the prices are quite tepid to say the least. Difficult to forecast prices because it's dependent on many factors. But one thing, which will be a positive for the industry per se is that as H2 starts and the demand grows, the overall environment for the industry will be better. But pricing is something it's very difficult to forecast, and I better not hazard any guess on that.
Okay, let's try to focus on what you can do to make things better. I think trade is around 65% of your mix. And out of that, I think you have low teens contribution of the premium segment, which gives you better profitability, better pricing as well. So tell us, where is that number currently and where is it headed? Premium products as a percentage of trade sales.
Yes. So last year we were around, let's say, 12 to 13%. This year we want to end, or the exit run rate to be at around 16 to 17%. And in the next year, try to take it to 18 to 20%. This is a segment where we focus a lot, not just because of profitability, but essentially the segment of individual home builders are growing more and more quality conscious as they are getting more aware. So the premium products which offers better quality to them and better features to them are something they are preferring a lot. So we have it's a priority initiative for us. This year we want to exit at around, let's say, 16-17%, and maybe next year touch 18 to 20%.
Got it. All right. So we've got pricing volumes out of the way. Let's talk about capacity. The last time we chatted, we knew that you all had a goal of 30 million tons in mind. Now you've upped that. You all are looking at 50 million tons. That's nearly doubling capacity in the next few years. And I understand that as a percentage of your market share, it should be roughly around 10-11% or thereabouts. So tell us, this entire capacity addition that you're talking about, by when does it take place? What is the capex that you're looking at?
Great. So look, 1.5 years back, somewhere around November 2022 or so, we were at 16 million. Right now, we are at 24 million with 6 more million tons under construction, which will get commissioned by end of next calendar year. So let's say December 25 or so. That'll take us to 30 million, which would be like a doubling of capacity in 3 years' time. Beyond the 30 million, which is already announced expansion underway, what we are working on, which is yet to be firmed up and we are yet to take it to the board, is around, let's say, 6 to 7 odd million, which is pivoting around the Jaisalmer mines which we have. Then around 5 to 6 million around our south plant, because that plant is sold out and we want to expand and grow our market. And then post these 2 plants, when they get commissioned, then we'll of course turn back again to central India to see if we can put up one more line there. We have also acquired the Toshali cements in the recent past, 6 to 7 months back. And we'll also try to see if we can work around an expansion around that unit. So while what I would say is that the 30 million ton, the plan is firmed up, it's under execution. The good thing for us is that we have plan laid out for 50 million tons, but we'll take it in a very systematic manner so that while we deliver the growth which the investors expect out of us, we also keep our financial prudence in place.
What about inorganic growth? That's where all the buzz is, right? All the excitement over there. You're not interested in inorganic. You're going to do this organically.
This you can't say because, we acquired Toshali Cements 6 months back.
That's too small. Anuj, that's too small. Toshali is very small, less than 500,000 tons. I mean, we're talking about bigger acquisitions. It could get you to that goal even faster. What's your take?
So on a serious note, look, our base plans are all on organic growth because we have the right limestone reserves to do the organic growth at a cheaper outlay. Inorganic growth, it always depends on opportunities, the competition, the valuation, etc. So it's very difficult to plan, plan your capacity expansion basis that. None of the companies do. If you look at other companies also, they have a organic plan charted out. Inorganic growth is always a cherry on top. It will come when it comes, but our base plan is organic growth.
And I think as of now, you're expanding at around $60 per ton, right? Roughly?
Yeah, so look, if it's a brownfield expansion, it touches $60, $65. If it's a greenfield expansion, which might happen when we take up Jaisalmer, it'll be a bit more costlier. But yes, broadly, that number is correct.
Since you're expanding at such a low capex, Motilal Oswal, they put out a note. They believe that your ROE and ROCE can move to 21% and 15% from around 16 and 11% as of now. You agree?
Though they are experts in numbers, I have not really, I can't really sign off on those numbers. But look, one thing which is there and which they are getting it right in their report is, yes, our capacity expansion happens at a lower rate. Secondly, we have a track record of evacuating that capacity fast. So if we were to maintain that track record, then the productivity of that capital comes in sooner. So that is something which we need to look out, evacuate our new capacities faster so that we can meet the targets which the report has set out for us.
Okay, all right. Yeah, so, that's what they are estimating, that your ROC and ROE will improve, and you pretty much indicate that you're looking at some cost-saving measures as well. So run us through that. In the next 2 years, 150 to 200 rupees of cost savings by a whole host of measures, alternative fuel, you're looking at reducing the lead time as well. Do you think that's possible? And what would it mean for an EBITDA per ton? In the last few years, you've averaged between around 1,000 to around 1,100 odd. Give and take everything, highlight the cost saving that you're looking at and how much of it will flow through to an EBITDA per ton, because the pricing one still, is a little bit dicey, the cement pricing as of now.
Okay, so maybe let me take your second question first. Giving an absolute EBITDA per ton target is difficult for a couple of reasons. Firstly, we are going through a silent period right now. And secondly, as you rightly said, pricing is such a big determinant of EBITDA that many times EBITDA per ton is not controllable, right? So from whatever our level is, we'll try to improve the cost, which will show down to our bottom line by 150 rupees per ton or so. And you're right, all these initiatives are definitely practical, implementable. 50 rupee per ton will come from logistics costs, both through saving measures as well as lead distance reduction. We are amping up our green power. Last year it was 51%. Already Q1 it was at 57%. And to meet our sustainability goals, we want to take it to 75% in the next 3 to 4 years. We are progressing well in AFR journey, and our thermal substitution rate is high. So a slew of measures will lead to that 150 rupee per ton cost saving, which will help us be more and more competitive in the industry. Beyond that, also we have our initiatives planned out, which will happen in medium term. We've won coal mine auctions in central India in February. So once, of course, it will take time for that to materialize, but whenever it does, it will lead to even more cost savings.
Okay, Anuj, final question before we let you go. We'll talk about debt and, capex and all the next time you join in. But I want to ask you about the paint space, because suddenly, there's a lot of optimism out there. Initially, when you'll announce you're going to go into paint, the street didn't like it one bit. But now they have come to terms with it, and they believe that maybe it's a business that goes parallelly with cement business. You're currently doing, I think, around 60 crores on a quarterly basis. How do you see this scaling up in terms of revenues? And by when does it break even? FY26? I know you're heading the grey cement division, but if you could throw some color on how the paint division is shaping up as well.
Yeah, so fair disclaimer, I don't lead the paints business, but yes, it's shaping up really well. Last year, we did 153 crores of net sales. This year, the target is between 250 to 300 crores, so which means it'll be doubling in a year's time. Yes, it has. Look, we were always clear that it has massive synergies with our channel on the white cement and the putty business, and it is coming through. So right now, our focus more is on trying to grow the business, set up the business, grow the scale of the business. Like any new business, it'll make a few losses in the initial years. But as of now, the focus is on growing the top line per se. Also, just to reiterate the fact what I've told you in my previous interviews. We have a set budget which is there for the paint business from an investment and loss funding perspective, and we are tracking well against that budget. So it'll not be just growth and not looking at the bottom line at all. But yes, but still the break even will be a couple of years away, like it is there for any new business.
Okay, all right, Anuj, appreciate you joining in. As you said, you're in silent period, but post the results, we'll re-invite you. Then we can push you a little bit more on pricing, EBITDA per ton, as well as how the debt number is shaping up. Thanks a lot for joining in and filling us in with all of those details. Well, time to slip into a short break. On the other side, we'll connect with Sriram Subramaniam of InGovern Research Services. InGovern has raised a red flag over Religear's AGM delay. Stay with us.
Okay, welcome back. This is, of course, Corporate Radar. We have advisory firm InGovern, which has raised red flags over Religear AGM delay. They've called for essentially the chairperson, Dr. Rashmi Saluja, to step down from their roles, which they think will signal a commitment to accountability and a fresh start with a fresh board and leadership for Religear Enterprises. Remember, the battle at Religear, of course, has turned fierce and maybe murky as well. On one side is Dr. Rashmi Saluja and the board so far. And on the other side, of course, is the Burman family, which, of course, Dabur, but the Burman family, which is trying to buy Religear. They already own about 25% in Religear. There is an open offer which is out there at about 235 rupees per share, but that offer has not gone ahead so far. I think pending, one last approval. There is, of course, also the bit about the AGM delay, where no explanation really has been given why the AGM has been postponed, where perhaps people are keenly waiting for a vote on an extension for Dr. Rashmi Saluja, the chairperson at Religear. We have Sriram Subramanian, founder and managing director at InGovern Research, now joining in. Thank you very much for joining us, Mr. Subramanian. Prashant here. You put out very clearly, you say time to move on. And this is what you write. Amidst a power struggle and regulatory scrutiny, Dr. Rashmi Saluja and the named KMP's key management personnel stepping down from their roles in the company would signal a commitment to accountability and a fresh start with fresh board and leadership for Religear. So, of course, Religear itself has issued their own statement. They're saying, well, I'm sure you've seen it. They're calling it unnecessary. They're saying, well, it's a process which is going on, and this is aimed at influencing the securities market, etc., etc. So just explain this for us, because there are lots of interested investors as well, who are waiting keenly for a resolution to this thing. So what are your thoughts, sir?
Yeah, so Religear has taken the ROC's approval, which is a logical process to get the AGM extended by 3 months. So this AGM has to be held before end of December now. But there is no logical reason. They have put out a reason which is not logical, because they have said that it is due to the this one in the open offer, the issues with the open offer, etc., which has no relevance to why the AGM has been postponed. Because at the end of the day, this is being contested in the Delhi High Court now. It's gone to a division bench. Okay, that is fine. That is understandable. But beyond that, is the company also assuring then that the AGM will be held before December if the AGM, if the open offer process doesn't get resolved by then? So that's a impasse. So there is no logical reason why they have pushed out the AGM. The only reason why they could have done it is Rashmi Saluja, being the only non-independent director on the board of Religare, has to come up for reappointment. And there is a fear that she will likely get voted out because already, as you rightly said, the Burmans own 25%. They are they're already fighting her. Two is the other shareholders are also very keenly watching. They've had this mess of the last year and a half. So they are, our interactions with institutional investors tell us that they want a change there. So the board has been siding with her. The independent directors have not done their duty. They have just not acted in the interest of the company. They have issued ESOPs for which we had put out a note where IRDA has come out with an order. Of course, that has gone to the SAT and is now being fought at the SAT. But yet, IRDA has given out a detailed order. SEBI has come out with a detailed order on the matter of and issued a show cause notice to the independent directors on why they tried to stop the open offer. In India, the takeover or an open offer is a natural trigger, actually. There is the moment 25% is crossed, there's a natural trigger. And SEBI itself doesn't have any powers to stop the open offer. But at the end of the day, the company has cited some RBI permissions, etc., and that's the reason they've stopped the open offer.
So the AGM has to be held before December. As you said, do you think it is inevitable that her reappointment has to come up, right?
Yeah.
Has to be an agenda item, or is it possible that it is not an agenda item?
No, I mean, for an external person and logically everybody on the street expects that to be coming up. The company may cite some other logic or some other reasoning, like they have done with the postponement of the AGM itself, but everybody is expecting that she will come up for reappointment.
And then you say that there are enough votes, Burman plus institutional shareholders, and have you had a conversation with some of these institutional shareholders?
Yeah,
about which way they are leaning?
there's a sense of I think there's a sense of angst amongst them, and that's where they are saying that the board and Dr. Rashmi Saluja have not done their this one properly diligence. Initially, in fact, they supported the open offer initially, and then subsequently last year they went against the open offer. So it's not clear as to why the board is not supporting the open offer at the first place. And secondly, it's not clear as to why they pushed out this AGM.
Okay, so before December now, AGM and the vote both should happen. So it looks like increasingly likely that Ms. Saluja perhaps will be voted out, right?
Yeah, we obviously have to see whether the notice comes up, the proposal comes up, as it is not yet announced. Once it's announced, we'll have to see. But the investors are definitely, there's a sense of angst around her leadership. Right?
Okay. Now this open offer itself, which is at 235 rupees, will that have to be, I mean, whenever that starts to come to, when it is launched, I mean, will the price have to be revised or will there be interest at 235? Price is at about 280 today.
Yeah, I don't think the public shareholders will tender at that price. Of course, it's up to the Burmans to decide whether they want to increase the price. That's the minimum floor price. So if the Burmans want to buy out more public shareholders, so they will have to increase the price because, as you rightly said, it's 280 or thereof today. And so that's up to the Burmans. But at the end of the day, the process has to be completed, right? I mean, they already want 25%. The process has to go through and be completed. And that's a logical end to the Burmans coming on acquiring the shares.
Right. I mean, from an investor perspective, when we speak, what is given out as a reason for re-rating is that this becomes a Burman-owned company, right? I mean, in terms of valuation,
yeah,
multiples, etc. I'm sure you also hear that. How far is that process? Do you think? I mean, is it I mean, is there an end in sight to when you actually see
We don't
some?
know. See, these regulatory processes could take time. Each regulator has their own, this one, the company board is against this entire process. So to that extent, they are putting spokes in the wheel of this entire process, right? At various forums, be it RBI, be it SEBI, be it IRDA, they have always put spokes. So from that perspective, we don't know how long the regulators also take to give these approvals and the like.
Okay, all right. But I think you've made it clear that, in your opinion, a lot of the institutional shareholders are also watching this closely for a speedy resolution. If it happens or not, we don't know as of now. Mr. Subramanian, thank you very much for joining us with that opinion. And I think it's a story which we will watch very, very closely. Well, let me toss it across to Surabhi, who's at the JP Morgan conference, and she's sitting down with Saurabh Kumar, Senior Analyst, India Banking and Financials Research at JP Morgan. Surabhi, over to you.
Prashant, thank you so much for that. Yes, I'm here with Saurabh Kumar, who tracks a sector that seems to be finally stirring back to life. It's a sector that's been underperforming for a while, and the whole question is that when foreigners start coming back to this market, will they keep loving Indian banks and the Indian BFSI space? So Saurabh is here with us. Saurabh, great to be talking to you in person. Thank you so much for making the time for us. And, I really want to start with that first question. So let's get the elephant out of the room. This whole debate around how banks are struggling to mobilize deposits and how that's going to take a toll on the business model itself, because everyone's rushing to put that money in the equity markets. Is the fight for deposit real? Is the struggle real? And if yes, can it really be detrimental to the profitability of banks?
Okay, so I think, parking money into equity markets or property is liquidity neutral for the system. It's just money transforming from retail to maybe wholesale. So I think the main issue is that our nominal GDP is compounding at 10-odd%, so deposit growth at 12%, credit growth is higher, and that's a fundamental mismatch. And eventually, I think you will see credit growth converge towards deposit growth, unless obviously nominal GDP picks up. I think in terms of fight for deposits, what you will see is wholesale deposit rates are falling down, but retail deposit rates have largely been maintained. The real issue in the system is around CASA, because in this environment of asset reflation, nobody wants to park money at 2-3% on savings rates. And that is where you're seeing incremental deterioration in the funding profile. Having said that, if you look at the cost of funds movement across major banks, it's been, the rate of increase has largely moderated down. From here on, it is just CASA mix or whatever the rates do.
So that brings me to the other sort of theory and the premise that you put out in a recent note, right? Because when we're talking about bank margins, the immediate sort of conclusion that most people jump to is that it's contingent on rates.
Yeah.
Lower rates should mean better margins, and higher rates could perhaps increase the cost of funding, or maybe vice versa, depending on your loan mix, depending on your borrowing mix as well. But you're saying that's not the case. It's not really rates that will determine NIMs, but perhaps the CASA mix. So could you explain this further?
Yeah, so I think the thesis is essentially if rates come down, margins come down, rates go up, margins go up. If you basically see the movement of rates over last, let's say, 2 odd years with a 250 basis point rate hike, most of the cost of funds has been equal to the yield on assets increase across major banks. So over a 18 to 24 month period, it's a pass-through structure that most banks operate in India. You do get quarterly volatility in terms of margins coming down, but they do revert back. Over a period of time, what dictates the margin is the loan mix, which is the share of unsecured loans rising, if at all. And the other is essentially your CASA funding. And as that funding profile obviously worsens, your margins come down. So rates is a quarter-to-quarter phenomena. I think what matters over a cycle and what I think matters from a valuation or stock price perspective is your eventual target NIMs or target profitability, ROAs.
Okay, so that's the theory. Now let's apply that to the current environment where CASA growth, like we discussed, is getting crimped. The Reserve Bank has obviously been sort of raising the red flag on unsecured lending, so your yield perhaps is getting more challenged. And we are in an environment where the Reserve Bank is expected to follow most other central banks and start easing at some point. So just take us through what you expect on NIMs here and whether you indeed expect the RBI to start easing by the end of the year.
So for JP Morgan, our expectation is for a rate cut cycle to start December. Cumulative 100 basis points will be what I think our economists forecast today. Broadly, that should lead to a 10 to 15 basis point degradation in NIMs across banks. That
a 10 to 15 point degradation in
15
NIMs.
basis points, yeah.
15 basis points
degradation in NIMs. Having
and this
said
over,
that,
over what period you'd expect? Over how many
so
months?
it depends on the trajectory of the rate hike, but it should happen over a 3-quarter period. So I think. But more importantly, I think what will also depend is how quickly they cut rate. Is it 25 basis points every quarter? Is it 50 basis points? So I think that will be more important. I think the main issue for banks is, yes, NIMs are coming down. For private banks, credit costs are also going up and growth is tapering down. All of this should mean that your EPS should be at some marginal risk of degradation till October of next year. And I think that is where I think risk of downgrades remains. Having said that, there is obviously flex many banks have in terms of their operating costs on their credit, which I think can essentially mean that there is some flex to operate at around target ROAs. Some of these numbers are also captured in the street estimates. So I think the key here is essentially who can grow faster. And this is where we basically are betting on banks where loan growth is actually faster than the system, and who have the funding flex and the capital flex to basically deliver that.
Okay, and talking about loan growth itself, considering that, like we discussed, unsecured continues to be very tightly monitored and watched, and we've seen the risk weights go up there as well. What will drive loan growth? And there's this whole talk about the capex cycle picking up. I don't know if that can really incrementally drive it. So where will the book grow, and what kind of lenders would you then watch?
What we're seeing in the system, and Reserve Bank puts out this data, I think if you look at the growth is now being driven from mortgages. So mortgage growth has picked up. The large industry growth has actually picked up from about 3% to 9% if I recall. So yes, you're seeing the headline growth taper down from 15% to 14%, but you're seeing a shift in mix away from unsecured loans toward more secured retail, towards corporate sector, and that is what our overarching view is, that effectively you are in a cycle where what we call it capex over consumption, that capex linked plays are actually going to do better versus consumption linked plays.
Okay, sort of hang on. Our colleagues in the studio also have some questions for you. Prashant, over to you.
Saurabh, hi. Hi, good morning. Good to see you there at the conference. Since we're talking about specific segments, I just wanted to ask you 3 segments. One is microfinance, right? I mean, there's a lot of talk that we're going through a down phase, a down cycle. I just wanted to understand where we are at. Are we we're just getting into it? Are we midway through? And when do we get out of it, the microfinance bit? Second is housing finance, which seems to be kind of everyone's favorite. Strong momentum and very low NPLs historically as well. What's your view there? And I think you've liked CV financiers about a month and a half ago when we spoke. So just wanted a quick sense on these 3 segments.
Okay, so on microfinance, I think we are clearly mid-cycle. I think there is more pain to come probably this quarter. Having said that, even if credit costs peak out, I think growth could remain challenged for some time because there has been clear over-leveraging for customers at that segment, and that will take some time to wash out in the system. On the unsecured loans more broadly, I think you should see peaking out of credit costs in Q2, starting to decline Q3, but I think again growth will remain challenged for the broader unsecured piece, I think going into next year. On housing finance, I think we remain constructive. Basically, what you're seeing here is as property prices appreciate, it does 2 things. One is collateral values rise, which means that your credit costs actually come down. Obviously, with the rising property price, nobody wants to default on their home loan or even a LAP loan. And the second is obviously for the same amount of loan, you're disbursing higher value. So housing finance from a cyclical perspective, given the underlying sector, looks much, much better placed from a growth and from a credit cost perspective. So that's be the view. On CV financiers, we think they are indirect plays on the capex story, which we like more broadly, and obviously they also benefit from being a fixed rate book in an environment where rates fall. You could potentially get margin expansion. So CV, you get again, we think growth will be better than what markets think, and I think more importantly, there is potential of margin improvement and credit cost remaining benign. So CV, to our mind, CV financiers, especially in the NBFC space, do look very interesting to us.
Yeah, Saurabh, you are also the real estate analyst, right? You track that space as well, and that is an important part of the entire, such an important part of the entire mix. It supports so much else. That cycle remains as solid as ever. There was a little bit of a slowdown maybe in the sales in last quarter, but just a quick overall view there.
Yeah, so we think we are in the fourth year of a typical 7 to 8 year upturn. We are probably mid-cycle. Inventory levels continue to remain low in the market. Prices continue to move up. And eventually, obviously, after 4 or 5 years, we'll probably see a downturn. But I think given the conditions today in the market on inventory levels, given the fact that prices are appreciating, which basically gets some amount of pent-up demand also to come in, some amount of investment demand to also come in, we think the cycle will remain supportive till you see supply levels go up substantially. I think the cycle will basically break up on supply or debt. We don't see that risk today.
Saurabh, finally, to sum it up, and I'm going to come back to financials. So banks may see a slight crimping of margins, and then we need to see if they can keep sustaining strong loan growth. Some argue that maybe the best of the asset quality is also behind us, and the curve goes down from here. In this environment, are you, as an investor, are you better off for looking at banks as an investment, or should you go back to, let's say, capital market plays or insurance or asset managers, because some of these have been, or even wealth managers, because some of these stocks have been fantastic wealth creators already?
So yeah, I mean, they tie to this broader thesis of saver to investor, that the money is moving from savings accounts to some of these plays. But I think from a large cap bank perspective, yes, some of this is also priced in. The valuations are pretty reasonable for the growth on offer. And I think if you are a value investor or valuations do dictate some amount of your investment outlook, then large cap private banks do look good. They are still taking deposit market share. They're still taking credit market share. I think from a capital market businesses, they do look interesting from a growth perspective, but I think valuations are quite heady at about 35 to 45 PE at this point of time. And there is obviously this risk of some, if market were to tail off, I think the operating leverage could play on the negative side.
Okay, so some of the large private banks remain your preferred bet. Yes. Got that, Saurabh. Thank you very much. Very insightful conversation. Thank you for joining us on the show today.
Thank you, Surbhi. Thank you for having us.
Thank you. Well, with that, it's back to the studios.
Thanks for that, Surbhi. Well, the markets actually have turned around. We've moved into the green. We started off with a cut of around 20-30 points. Now we're up 20-30 points. A good times from a bullish perspective. We'll slip in a short break, come back, continue our focus on markets. We'll also dip into the commodity space. Manisha Gupta is waiting for us.
क्वाड मूनशॉट इनिशिएटिव के तहत $7.5 मिलियन के सैपलिंग किट्स, डिटेक्शन किट्स और वैक्सीन का सहयोग देने की घोषणा करता है। रेडियोथेरेपी ट्रीटमेंट और कैपेसिटी बिल्डिंग में भी भारत सहयोग देगा।
Welcome back. Markets holding with strong gains. Metals are leading the way, but I think HDFC Bank, just pull up the intraday chart. That will sum up the first 45 minutes of trade. HDFC Bank opened up a little bit in the red. Dip got bought into, helps the Nifty higher, helps the Nifty Bank up as well. Midesh Thakkar is back with us. Midesh, well, the markets are trading with mild gains. your view on the index, levels to track, as well as your fresh picks at 10 a.m.?
Yeah. So I think on the index, today looks like to be more of a consolidative day. Though I think, both the markets are mildly positive. But overall, it could be a day when you would want to buy on declines, one. Two, I think on the stock side, Nigel, you were just pointing on metals, and I have, some recommendations over there. Tata Steel is a buyer. Disclaimer that I have some call options positions over here, so there's vested interest, but it looks like it reversing from a sideways consolidation could do very well. So keep a stop below 150 for half year. Look for a target of around 167 to 170 on the upside. And the other stock which I like is Steel Authority. That's a buy as well. Again, disclaimer that I have some position in cash markets too. Again, there's some vested interest, but it's given a gap kind of a breakout. Could see good continuation. So we'll recommend a stop below 130 here and a target of around 143 to begin.
All right. Thanks a lot for that, Mitesh. But let's focus on the metal space then. China has announced a slew of measures which can be positive for metals. They say that the PBOC will cut the reserve requirement ratio, that's RRR for banks, by 50 basis points, but they stopped short of giving any kind of timeline for that cut. They've also hinted there could be another RRR cut by around 20 to 25 basis points by the end of this year. There are a few more highlights, so let's put that up for you. They'll cut rates on existing mortgage loans. They'll also cut 7-day reverse repo rate by around 20 basis points from around 1.7% to around 1.5%. And they'll cut down on the payment ratio for the second home to around 15% from 25% earlier. Phil Capital, well, they maintain their positive stance on metals. Their top picks are JSW Steel as well as JSPL from the ferrous pack, Nalco and Vedanta from the non-ferrous pack. And they are recommending accumulating NMDC and SAIL. Both of them have seen a sharp correction from the recent peak, but they believe accumulating these stocks in a staggered manner could work well as well. So explains why metal stocks are higher. But Manisha joins us to give us a complete wind down in terms of what's going on in the commodity index. Manisha, take it away.
Well, thank you for that, Nigel. I'm looking at raw sugar prices because this is yet another sector which has continued to gain up. Well, actually, when you look at the commodity index in its totality, whether it's precious metals, energy, most of agriculture also seems to be surging up. So for raw sugar prices, we are trading at around $22.5 a pound there. Prices are trading at a 5-month highs. And also, this is because of the concerns that you have coming in from Brazil, where the wildfires have damaged almost 5 million tons of cane crop there. And that tells you that the overall Brazil sugar output for 2024-25 now is forecasted down at around 39.2 million tons. Well, if you look at the global markets as well, the International Sugar Organization tells you that they are looking at a higher deficit this time around in this year. Last year was 200,000 tons. This time around is expected at 3.5 million tons. That also has been aiding sugar prices. For the overall markets, it is also to do with the high crude oil prices and the expectation that you could be looking at more divergence, especially in Brazil, from sugar to ethanol supporting prices. For the Indian markets, it's an expectation that the minimum selling price of sugar could be raised, and also the ethanol pricing for the new season is yet to come in. Currently, we are looking at lower numbers there. When it comes to blending, though, that has continued to stay on a higher side. In an accumulative manner from November 2023 to around August 2024, the blending stats at 13.8%. And when you look at the month of August 2024 itself, the blending stat stands at 15.8%. So we are looking at stronger numbers onto that one as well. Industry clearly has been looking at long-term policy on ethanol blending. So that is something that you could be looking at as well. And then, of course, when you look at the numbers itself in sense of Indian ethanol capacity, well, that is the prices that we stand at currently. And the industry is asking for nearly 5 to 7% or more of an increase onto that one. The industry also is looking at the overall capacity, which has seen quite an increase really. So when you look at the Indian capacity in 2017-18, we were at around 517 crore litres. In 2023-24, that number has come into almost 1,600 crore litres. So strong numbers coming in from that one as well. Markets are looking at further gains in sugar prices, given the fact that internationally we are looking at a supply deficit.
All right, Manisha, thank you very much for that. So as commodities in focus, we're going to take a quick commercial break here. Up next, it's our segment, it's the economy. Lata will be speaking with Suresh Ganapathy, banking analyst at Macquarie, to focus on financials and what next year. Stay tuned.
to announce that the Quad Cancer Moonshot is what we're talking about. Our goal is to team up end cancer around the world and starting with cervical cancer. I know it may sound unrealistic, but it's not. Announced that our 4 countries, the leaders behind me, and many organizations here today are committing over $150 million for HPV screening and therapeutics.
Well, you know, a big basket consumer today, right, ordered an iPhone 16 at 8 a.m. on Big Basket and it got delivered by 8:07. This same consumer last year would have had to wait a day if she had ordered it on Amazon or Flipkart. And this, you know, is the perfect example of how lines are blurring between e-commerce and quick commerce. Now, let's see how each of them stacks up. Now, the biggest advantage that quick commerce obviously has is how quick it is, and that's consumer behavior.
Welcome back. A lot of turbulence has hit NBFC, housing finance and banking space this fiscal. Banks first underperformed on higher deposit cost, fear of lower margins. Now NBFCs also suffered initially due to higher cost of borrowings, but they have recovered very smartly. MFIs, microfinance lenders and small finance banks were also largely microfinance, have suffered from higher defaults due to over-lending. Only housing finance companies in this entire space have surged and surged as they got a boost from the mega listing of Bajaj Housing. Now, where do these various BFSI segments stand today? I have with me someone who watches all this very carefully, Suresh Ganapathy of Macquarie, to give us an idea of where are the trouble spots and where do we still find value. Good morning, Suresh, and thank you very much for sparing time for us. Well, I have actually a very fundamental question on Bajaj Housing, which has ignited so much excitement in the otherwise ignored area of housing finance. Why would HDFC close down if housing finance is really so lucrative? I still can't make my peace with that question.
You have to understand, Lata, that scale matters here, right? HDFC closed down at a scale size of 6-7 trillion rupees. So Bajaj Housing Finance is far away from that. I'm pretty sure when they reach that kind of a scale and size, sustaining the current level of profitability will be very difficult. You also have to understand that almost 50% of the book for Bajaj Housing Finance comes from non-pure mortgage, which is basically loan against property, construction financing, and other kind of segments which are very high yielding. The core mortgage business doesn't yield that much kind of an ROA. So eventually, when you're going to go to a 6-7 trillion rupees, it's tough to run a 3.5 trillion rupees of a non-mortgage book, right? So those challenges Bajaj Housing Finance will face, in my opinion. It's just a matter of time. It's just because today they are smaller, they're able to sustain some of these growth metrics as well as profitability metrics.
Yeah, I just wanted that point on the table, that someday scale will hit, but they are a distance. They're hardly 1 trillion book, and perhaps these problems will rise only when you're 6 trillion. But you made another point about the whole housing finance, mortgage lending itself being a low margin business. And yet all those companies are doing very well. Aptus, for one, is, of course, up and away with, I think, a 4 times book or even over a 4 times book. Is there any interest for you in that space otherwise?
Yeah, look, Lata, I think when I said mortgage finance being a low margin and a low ROA business, I meant the usual, the average ticket size being around 40 lakhs or 50 lakhs, right? You're talking about the mass market housing. Where exactly the niches are basically is in the affordable housing finance, where you're largely lending to smaller ticket size segments where banks don't compete, and also largely to self-employed guys. And many of this lending is basically to construct your own houses on your land, right? So that's one segment where clearly the yields are also higher. You can get 14-15% yield and you're able to make that kind of an ROA. Again, to reiterate the point, it's only up to a certain scale and size you can build an affordable housing finance book, beyond which obviously you'll have to venture into the mass market housing. Guys like ours or Home First and all these guys obviously currently are pretty small at this point in time, and therefore they're able to get outsized returns and therefore a higher ROA and eventually higher valuations. Eventually, scale will be one of the biggest inhibiting factors for profitability in our view in the longer term for any housing finance company.
Okay. Well, I would assume Aptus and all are very far away from that area. So perhaps good buys now. Suresh, let me come to the bigger question of cost of funds. I think now it's a 3 or 4 month old debate or even longer on the cost of deposits for banks. Now, technically that should hit NBFCs as well, right? Although NBFCs have started borrowing much more from the market, there is still a cost issue between banks and NBFCs. Where would your preference lie at this point?
Yeah, so if you were to really look at from the near-term results standpoint, you'll continue to see greater degree of margin pressures or perhaps slowdown for the NBFC space. If I were to really look at the second quarter numbers, there is obviously, as you know, stress in certain select pockets, be it on the credit card side, certain categories of course, personal loans. And of course, we also know, the over-leveraging in the microfinance space, which is happening. But, as you know, Lata, markets are always forward-looking, right? So while we know that the next quarter or couple of quarters will be a little bit more challenging, the fact that, the last couple of months, liquidity situation is definitely eased quite a bit, right? If you look at the banks parking surplus money with the Reserve Bank of India and the government spending, of course, actually picking up. You have call money rates hovering continuously below repo rates. The 10-year bond yields are now down to 6.8%. So as you know, as you rightly said, that more amount of money is being borrowed from bond markets to take advantage of the fall in bond yields. All that takes time to play into the numbers for the NBFC space. Also note that during this time, of course, Fed has already cut the rates. You're likely to see the Reserve Bank of India also cutting rates, albeit maybe only 50 basis points. But that also will start flowing through and there will be a change in narrative or stance from the Reserve Bank of India. That's good for the NBFCs because I think the first leg of the rally will happen more in multiple expansion, which you already saw to some extent in the NBFC space. And later on, you slightly see that seeping into the fundamentals. But the actual improvement is at least 6 to 9 months away. The next 3 to 6 months will still remain a bit more subdued for them.
Okay, so you're saying that when the rate cut cycle starts and there are a goodish number of economists who are expecting the rate cut in December, probably a little dovishness in the October policy and a rate cut in December. I don't know how correct they're all. But if that were to happen, you think the first line of beneficiaries are the NBFCs.
Definitely.
For the banks, initially, it will be a negative on their margins.
That's right. We also did an analysis where we did the last 3 Fed rate cut scenario in 2001, I think 8 and 2019. And what we found was that the only sector in India which actually did very well in each of those rate cut cycles in the near term, what I meant is in the next 3 months or 6 months during the Fed rate cut cycle was NBFCs, right? So, I mean, of course, these are all correlations and in analysis, but nevertheless, that's something which we need to keep a note of. Yeah.
No, I take your point. We are already at 6.76 on the 10-year and Indian rate cut as well as more cuts from the Fed. If the US 10-year were to go below 3.5, we should have a concomitant fall in Indian yields as well. So I take your point on that. Okay, let me come to the other. Okay, just to finish the cost of deposits problem, what is your best guess on when the banks will see an easing of their deposit problem? I mean, it is caused by HDFC having to cover up for the HDFC merger, as well as other reasons, like the government spending wasn't good enough in the first 3 months, etc. When do you see this peaking off?
Yeah, so if you actually look at the latest data from the Reserve Bank of India, that is still showing an upward trajectory on weighted average term deposit rates, right? And weighted average lending rates. So that, Lata, will continue for another, I would say, a month or so, a couple of months. So the way we are looking at it is I look at it this way. The last couple of months, liquidity situation has become better. You're likely to see, or you've actually already seen credit growth having come down from 16 to 14%. Not many people are aware and it's not being talked about much. The incremental loan to deposit ratio this financial year till date, I'm taking March 22nd as the reference point, is only 60%, right? So the outstanding number is 79, but the incremental is already down to 60%, which means all the actions taken by the regulator is playing out in terms of lower growth, lower incremental loan to deposit ratios, which actually means that coinciding with the rate cut, which perhaps can happen from December, I would say we are likely to see around that period slight easing of deposit rates, if not easing, very clearly peaking of all the rates in the system. You know what happens? Tricky part here is the October to November is a festive period. Coupled with that, Jan to March is a seasonally very tight period. So I don't think we are likely to see any kind of cuts happening by March. Maybe post-March is the time when you're actually likely to see an effective cut in the deposit rates. But till that time, considering where we are entering into busy festive period coupled with a tight seasonally fourth quarter, don't think any cut in rates will happen.
Okay. Well,
that's why it didn't make any sense for RBI to even cut rates, because it is not going to transmit in the form of a lower rates in the system, right? So that's how we should look at it. Yeah.
Okay, so the cut in deposits might come, say, in the June quarter, is what you're saying?
Yes, okay. April to June quarter. Yeah.
Fair enough. So we have to grin and bear it for 3 quarters as far as the banks are concerned. And now finally, to come to asset quality, we know that there has been an MFI issue. And, you know, the credit cost advantage that banks had, the very, very low credit cost, that also is running out. So do you, if you compare, where do you see the asset quality pressures coming in first?
Yeah. Look, I think, Lata, the way you should look at it is which banks have what exposure to the different kind of segments here, because it's too difficult to generalize at this point in time that say all these private sector banks or all these PSUs or all these NBFCs are going to face an issue, because the stress today, is granular in nature and it is concentrated in certain pockets. For example, the credit card stress is still real. We have been speaking to some of the bank managements, and the net credit losses that some of the banks are running in the credit cards portfolio is anywhere between 5 to 6%. Now, that's not a great number to look at, right? And MFI, of course, you know about the over leveraging which is happening, and of course certain categories of personal loans. So I guess clearly those institutions which are exposed to these kind of subsegments will be at a greater risk. But again, none of this risk is debilitating on the balance sheet of the institution and also the broader systemic level. So in that sense, at a system level, things are fine. But at an individual stock level, the problems could be more. So for example, will I be cautious about taking exposure to microfinance lenders? The answer is yes. Will I be cautious in taking exposure to a credit card lender at this point in time? The answer is yes.
Okay. So that's why I think your best stock is Sham Finance, because it's far away from both these kinds of loans. That's your, what's your NBFC pecking order?
Yeah, so actually I also like the housing finance companies. I mean, if Bajaj Housing Finance is getting 6 times price to book, I'm pretty sure all the other housing finance companies which are closer to that level of ROA should at least get half of what Bajaj Housing Finance is getting. I understand growth is, of course,
so LIC Housing?
Differentiating factor. Yeah, LIC Housing Finance we do like. So then we can also look at, as I said, Shriram Finance. We also like AB Capital, one of the newer stocks that were initiated. Again, it's in the consumer lending space, but they have run down their unsecured portfolio, and SME lending is a bigger component in their overall piece. So yes, selectively, it's high time that we look at some of these NBFCs.
Okay. Now, as coming to the banks, at the moment, everyone's best buy would be ICICI Bank. And then, of course, HDFC Bank has fallen lower in the order. And after SBI's latest credit cost increase in the last quarter, even that's gone down the ranking. Once the hump of deposits is over, 1 year down in June, what may the ranking look like?
Yeah, look, I think if you're calling for a falling rate cycle to some extent, maybe IndusInd Bank fits the bill. It has the largest proportion of fixed rate portfolio. HDFC Bank has an NBFC in itself, right, which is about 25% of the balance sheet, which is HDFC Limited. So you're talking about easing liquidity conditions. That also fits the bill. I thought another important point which I should make to the viewers at this point in time is the Reserve Bank of India at the margin is getting what should I say, a little bit more relaxed or comfortable, right? Because, okay, that's a better word to be used, Lata, because if you look at it, all the desired outcomes have been achieved, right? Be in terms of lower loan growth, they are going to do something on LCR and ECL stuff. Unsecured loan growth is down. And look at some of the actions that have been taken. They have completely given back the gold loan financing ability to India Infoline. They have also given IndusInd Bank an AMC license, which is unthinkable considering the fact that they really don't want parabanking activities to be done under a banking umbrella and depositors taking the hit, right? So if that indeed is the approach, I think it's a great time to relook at the banking space more.
Okay, just a final question on HDFC Bank, something that slipped my mind and you brought up, with HDB about to be listed, how does that change the valuation? After all, the sky-high valuations of Bajaj Housing also brought some more buying to Bajaj Finance.
Yeah, here is where I think HDFC Bank gets a little bit more unfortunate because the contribution of HDB Financial Services, the overall valuation is pretty limited because HDFC Bank itself has so much of market cap that, and I know, and every analyst values at $5-6 billion HDB, even if it gets listed double, where you're talking about $150 billion valuation versus another $5 billion valuation that the market is willing to give, right? So it doesn't move the needle. And there are other subsidiaries which also have a great value. So in that sense, HDB listing, while of course it is sentiment positive, it doesn't really move the valuations for HDFC Bank in a big way, unlike for Bajaj Finance and Bajaj Housing.
Fair enough. Thank you very much. It was a bhelpuri of questions on various aspects, but thank you very much for leaving us that much the wiser on banking, NBFCs, housing, finance and MFIs. Thank you very much, Suresh Ganapathy. We have to take a break on that note. Chartbusters coming up.
Changing, and the consumer now wants everything in 10 minutes. But e-commerce players currently only offer same-day delivery, and that also in just select cities. But it's their presence that is unmatched. Currently, they service nearly 100% of India's PIN codes, while quick commerce has now only just started, sort of expanding into Tier 2 and Tier 3 markets. And Zepto, Blinkit and the likes have been expanding their product range into appliances, into toys, into cosmetics and more. But e-commerce players have a much wider product assortment and they offer much higher discounts, and they're also much better equipped to deliver big goods like a TV or a refrigerator to you. But the way quick commerce apps have been ramping up is definitely giving jitters to e-commerce players. Now see, Flipkart for instance, right? It is already testing the model with minutes, and it's also ramping up its fulfillment centers. Myntra on the other hand is already testing 4-hour deliveries. Amazon is also looking at a foray, and at the same time is also ramping up its storage capacity for faster deliveries. Nykaa for instance is also making its faster deliveries, which is same day and next day deliveries, available in 110 cities. And now experts say that, down the line, it's not like one will eat the other up. Both will coexist, where impulse buying will go to quick commerce and planned purchases will continue to stay on e-commerce platforms. But yes, e-commerce players are likely to work on reducing their delivery times to as fast as 30 to 45 minutes. And this festive season, we're likely to see this battle playing out. Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy?
Metal surge on anticipated higher demand as the Chinese central bank says it will cut rates and reserve requirement ratio by 50 basis points soon. Logistics player Western Carriers makes a flat debut. Mumbai-based realtor Arcade Developers see strong listing with gains of over 35%, while Northern Arc Capital lists with gains of around 25%. The management of Northern Arc will be joining in a few minutes from now.
Nomura issues a bullish note on Ipca Labs and raises target to 1750 rupees per share as it estimates a compounded 30% growth in earnings over FY25 to FY27, the stock higher by about 2%.
AstraZeneca surges after it receives a nod from the drug regulator to sell and distribute a cancer drug. The stock is up 10%.
We also have Thangamayil Jewelers higher, off highs now after it's announced that the board will consider a fundraise on the 26th of September.
Hello and welcome to Chartbusters. I'm Nigel, with me is Mangalam. Well, the markets are holding well in the green. The largest constituent, though, the Nifty Bank, that's been the leader in the last month or so. Well, that one's taken a bit of a break. The sector on fire, though, today is the metal index. China stocking up the market. They're saying stimulus is coming their way. They're looking to pep up the economy. And because of that, metals is the top sector of the day. Hey, Mangalam.
Hi, Nigel. Heavy metal is the music of the day. There is some sort of profit taking on the Nifty Bank. The broader market's actually doing a lot better. So we have around 1,400 stocks advancing for about 1,000 stocks declining. The lines have come slightly closer, but nothing really to worry about. We were within touching distance of that 26,000 mark on the Nifty as well. Whether that happens today or later is, just a matter of time as against if, because we have seen some traction in our markets continue over the last many trading sessions. As you have it, more stocks advancing than the number of stocks which are declining. The lines have become just slightly narrow. Let's welcome the newest kid on the exchanges. Then we were talking about how there have been 3 listings today: Western Carrier, Arcade Developers, and Northern Arc as well. But as we do that, before we do that, let's go across to Shilpa Rao for a quick technical check on the market. Shilpa, your call on the indices and individual stocks quickly.
Good morning, Nigel and Mangalam, and thank you for having me on the show. Indices, as we have been speaking time and again, it is almost there. 26,000 is there. We are about to hit that. From here also, I believe 25,800 is looking like a very solid support, and if it holds that, then we will see levels of 26,100 to 200 on an immediate basis. Talking about Bank Nifty is also holding very strong. The immediate support now comes at around 53,700 marks. If it holds that, we are good to see 54,500 to 55,000 in no time.
All right. And individual stocks, what are your calls here?
I have 2 buy recommendations. The first one would be a buy in UPL. UPL has given a very decisive breakout now, and the sustenance above 600 will see the next targets of 620 to 630. The same has been recommended here in Prabhudas Leeladhar. It's a 620 call option at around 14 rupees with a stop loss of 9, and for targets of for 22 and 28. So that can be definitely looked into. The other one would be a buy in BEL. The defense sector is bucking up, and this with a support at around 280 zones, I believe the stock is also very well placed for a good run up towards 300 to 320 zones. So that can also be looked upon.
Okay. All right. Thanks a lot for that, Shilpa. Well, for the time being, I think let's slip into a short break. When you come back, we'll continue to focus on markets as well as on stock-specific action.
How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown.
Welcome back. You're watching us here on Chartbusters. A bunch of stocks in focus. We have Sapphire, which has moved higher. We've seen a decent traction in other names as well. Car Trade Tech, for instance. But swiftly, there has been a big decline in the share price of IEX. That's the one that should come up for you on the screen. In fact, it's a big decline, down about 5% in the last 10 minutes itself, down about 7.5% from the high. So we'll keep an eye out on this story as it plays out. But the big listing of today has been Northern Arc, listed at a near 33% premium to its issue price. We have Ashish Mehrotra, who's the MD and CEO of the company, joining in to discuss the company's post-listing strategies. The stock still holding with a gain of 25% above its issue price. Thanks a lot for joining in, Ashish. Pleasure speaking to you once again. If you could give us a sense of how your capital structure changes in terms of CRAR post this fundraise, because the fresh issue has been close to around 500 crores. Your CRAR has reduced from near 23% in FY22 to about 18% because of the capital consumption. With this money coming in, how does that change?
Hi, good morning. Delighted to be there with you today. We're a diversified financial services business. Our CRAR, post this listing will be upward of 23-24%. But we have sufficient headroom given we have our debt equities below 3.5%. What we've raised is predominantly a growth capital, given that we are a diversified financial services business with very high quality balance sheet with probably can say best in quartile credit performance in terms of fully adjusted for credit cost, better than our peers. And then we have a strong fee income coming from our credit solutioning business, which is essentially the placement business and the fund management business. So I think there's enough headroom for us to grow, and we've been growing at about 31% over the last 3 years. I think we are very happy and we've overwhelmed and thankful for the support we've got from all the constituents as part of the process there.
Okay, all right. Hi, Ashish. So your CRAR has moved around 23-24%.
Hi.
You're fairly, comfortable out there, and you believe that from here on as well, this money could be used for growth capital. So tell us about growth then. What's the AUM growth you're focusing on for the coming year? That's FY25. And say in the next 5 years, what's the goal? Where does your AUM head? Please go ahead.
Yeah, thanks. You look at it, our past performance is we have growth rate of about 31% on the balance sheet and about 40% plus growth on our revenue, and even a better performance on the bottom line. Tells us, given the strong foundation and 3 core Ds which really differentiates us, in the 6 sectors where we operate, we have deep domain expertise given the quantum of the credit which flows through us between lending, placement business and the fund management business. The second is our obsession with data. We probably run 30 plus time-tested risk models, which has ensured that over a decade and a half, our credit performance is on the top quartile among our peers. And then we're fully digital in what we do. That means efficiency and scale comes into play. If you bring all of these together with an organization which has two key pieces. One is the learning mindset and the second is a growth mindset should tell you where we will be and how we'll deliver this growth capital to expand our business in a diversified sector and to ensure we generate industry-leading risk-adjusted return on our,
Ashish, I can see that your current AUM is what, around 30,000 crores?
So that's that is our GTV, gross transaction volume. So unlike so we would have lent about close to 11,700 as of March 31st March 24. We've done an equal amount of placement or credit solutioning for other lenders. And then we would have invested through our funds, again, in the 6 sectors where we operate. So we essentially caters to the diverse credit requirement of the retail customers, between micro loans to small business loans to vehicle finance, affordable housing, agri supply chain. So these are the 6 core sectors where we lend. We provide credit solution to the other players. And we also then invest from our funds in these 6 sectors.
So let's get a little more specific then. 11,000 crores is your direct loan, 11,000 crores is placement, and the rest would be some of your fund infusion in the 6 sectors. I'm looking at growth in your sectors itself. Consumer finance has grown from what, 3,000 crores in FY22 to close to around 10,000 crore in FY24. That's nearly tripled. How much of that is organic loans? How much of that is placement? And going forward, what is this mix likely to be?
You know, the mix, obviously the balance sheet, to my mind, growth rate has been about 31%, and we should be able to grow in that quantum. Given the headwinds and the increase in the risk weight, we saw a massive opportunity to provide credit solutions through other investors by structuring transaction in a way that the small loans could have liability profile. We have probably the best liability profile, given that the 20% of our borrowing comes from offshore multilaterals, given the nature of the business we conduct. And we're then able to provide credit solution, large part of that, to these originating partners. But if I look at on my balance sheet, 40% of our exposure is to MSME, which is core business focus for us. MFI will be about 26%, and an aggregate basis, another 27% would be the consumer on a balance sheet. On a risk-adjusted basis, if you look at it, a GNPA last year was below 50 basis point. And we ensure between a stage 1 to stage 3, we carry almost 84-85% provisionings. So on a fully loaded basis, our return on assets is upward of 300 basis point.
Got it. Ashish, since you briefly mentioned about your cost of borrowing, as you told us the last time, I think 60% of your borrowing comes in from banks, and in a declining rate environment, your cost of borrowing could slip a little bit. So tell us, how do you see that shaping up? And in turn, what it would mean for your NIMs? How much of it would you hold on to? How much of it would you pass through?
Obviously, our NIMs has been pretty strong at about 830 basis point. This is the pure lending NIM. And you can gross that up by another 100 basis point. On the loaded NIM goes to 940 because of the fee income on account of placement and the fund business. We are also AA rated. Last year we got rating upgrade just basis the performance of the company before the equity infusion, subsequent to which, if you look at our liability profiles, is pretty strong between domestic institutions at about 60%. About 20% plus come from multilaterals, both global and domestic, and balance from other sources. My sense is, as we look at it, we should see some bit of expansion because we will obviously get some amount of borrowing cost advantage, and obviously over a period of time that will get passed on to our end customers.
So what would, according to you, be the typical yield on your book in the next couple of years? And at the same time, your NIMs from 830 basis points core, will they expand further?
I think the loaded NIM will expand if we are able to grow our fund management business. Look at it, we run performing credit fund, and we deployed over 10,000 crores. Using the domain knowledge in these 6 sectors. We're right now raising and deploying for about 4 funds, including one climate fund focused on financial services and so on and so forth. Our sense is that will provide a significant lift on a fully loaded NIM, coupled with the fee income we have. And the gradual NIM expansion as our direct-to-customer business grows, which is now about 50% of balance sheet, you will see a improvement in the NIM margin over a period of next few years.
Right. You did allude to increasing, your share of revenue coming in from the fund management business. If that were to happen, your NIMs would expand. Could you break down growth on, all these parameters? Because overall, your balance sheet is growing at 31%. You have your own lending business, you have the fund management business, and you have the placement business. Together, it will grow at 31%. But individually, if you could guide us for some growth here?
I think the balance sheet growth has been, as you rightly pointed out, is over 31%. The gross transaction volume, which means the deployment in funds between placement of credit solution to other originating partners and our own deployment in the focus sectors where we see, I think we should be able to maintain the performance we've demonstrated over the last 3 years as we go forward. I think that's where we stand today. And an organization which has both the growth mindset and a mindset to learn, and we learn a lot more given that we have over 110 million, we've deployed 1.7 trillion, we've enabled finance. So all of that enabled us to learn. We have 35 million time performance of loan data, helps us to ensure that our risk scorecards significantly perform better. Coupled with touch and feel off the ground, to my mind, we should be a powerful force to reckon with because you bring comprehensive solution to these high growth sectors between lending, placement, fund management. It's a very powerful proposition.
Okay, all right. Ashish, thanks a lot for joining in, giving us some color on the business. Congratulations to you and your team. Have a good remainder of the year. And as you'll deliver numbers in this fresh news, since you're listed on the exchanges, we'll re-invite you on the channel. Thanks a lot for joining in. Well, for the time being, I think we slip into a short break. Or actually, before we do that, let's turn our attention to our special segment where we get you a few ideas for profit from Money Control Pro. Anubhav Sahu of moneycontrol.com joins us to talk about a stock that he's tracking closely. Anubhav, take it away.
Post general elections in India, we selected Syngene as one of the preferred pick for sector rotation. Now, this has played out well with about 32% run. Now we see a macro setup even more conducive for the company. So on one hand, a start of US rate cut cycle ends the high interest regime and should help in funding for new age R&D driven biotech companies. At the other end, Biosecure Act can literally decouple China's biotech supply chain from the US biotech value chain and holds a promising future for Indian CRAMS industry. Now, Syngene mentions about China switches, which has led to setting up of pilot projects across a broad range of services. And the requests for proposals are up almost 50% compared to last year. Now, the company has limited exposure to China and has worked out an alternative supply chain network, which works as a proposition to clients looking to avoid China exposure entirely. Now, a key near-term growth trigger to watch is the repurposing of the biologics manufacturing facility acquired from Stelis Biopharma. That said, as valuations are at premium, investors should watch for the weak market phases to accumulate it.
Interesting. Thanks a lot for that, Anubhav. For the time being, though, we slip into a short break. Come back, 100 Focus on Markets. Don't go anywhere.
Ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, a recent SEBI study has revealed some interesting insights into performance of retail traders in the F&O market. Hormuz has gone through all of that. He's joining us to fill us in with all of those details. Hormuz.
You know, they say that the proof lies in the pudding, but this SEBI study is neither the proof nor the pudding that many F&O traders would want to see, read or hear. Now, 1.8 lakh crore rupees. Now, that is the cumulative loss made by individual traders within the F&O segment between FY22 and FY24. That's the big number from this latest SEBI study. Now, a study that the market regulator released last year said that 89% F&O traders lose money. Now, that number remains where it is, as 9 out of 10 individual traders in the F&O segment continue to incur quote-unquote significant losses. Now, let's tell you more about those significant losses. Including transaction cost, the average loss of over 93% or over 1 crore individual traders stood at 2 lakh rupees each. If that is not enough, the top loss-making traders raised the bar higher. The top 3.5 loss-making traders averaged a loss of 28 lakh rupees per person, of course, including transaction costs. Again, all of these figures between FY22 and FY24. So does anybody make a profit? Absolutely. A staggering 1% of the traders in the F&O segment made a profit over the last 3 financial years. And if there ever was a gulf between domestic and foreign traders, the upcoming graphic will show you that. Proprietary traders made a profit of 33,000 crores in FY24 before adjusting for transaction costs. FPIs made a profit of 28,000 crore. And putting these two numbers together, the individual traders made a loss of over 61,000 crore rupees in FY24. So how did these traders manage the profit? Now, most of these are generated by larger entities using algorithms. 96% of proprietary profits and 97% of FPI profits are generated through these algorithms, according to the SEBI study. Now, if you wondered that the SEBI study from last year would act as any deterrent to youngsters from venturing into this unknown territory, that has definitely not been the case. The number of traders below the age of 30 within this segment has now risen to 43% from 31% in FY23, and 72% of the total trader base is beyond the top 30 cities of the country. Shows you the extent of the F&O penetration in India. Now, if there would be a study that proves F&O penetration being faster than insurance, don't be surprised. We spoke to you about the losses that individual traders made that ran into lakhs of rupees. 75% of those traders had an annual income of less than 5 lakh rupees. And I'll end with possibly what is the highlight of this report, and nothing better can describe this than a famous Hindi film dialogue, and I quote, "रोज आते हैं इस उम्मीद में, आज जीतेंगे, कल जीतेंगे, परसों जीतेंगे और रोज हारते हैं." Now, why do I say so? Because despite making losses for years, 75% of these F&O traders continue to trade as per this SEBI study. So there you have it. Foreign algo trades making money in F&O while the individual retail investor continues to struggle. Of course, what people do with their money is an individual choice, but these stats would definitely set alarm bells ringing for sure.
Right, Hormaz, thank you. Insightful data there coming in from SEBI itself. Told delightfully by you as well. With that, what we'll do is move on to a CNBC-TV18 exclusive. Veteran banker and JP Morgan's global CEO, Jamie Dimon, has said that India is doing a lot of right things and has shown optimism about growth prospects. So he's hot on India.
America was overly reliant. That's not being angry at them. You should ask why we didn't do it before. But in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals. The second one is around disagreements around policy, like, you know, if countries are aiding and abetting industries to dominate a global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. The semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. A huge opportunity for India. That people call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc. Prime Minister, that odd par program, I think I'm saying that right, the changing the GST, the tax system among the states, national infrastructure, your schools graduating a lot of extremely bright, talented people. Those are the things to do. Reduce regulations. Here, regulation and bureaucracy does cripple foreign direct investment. So make it easier for foreign direct investment to come here. And then you have to do industry by industry. But I do think you should be attracting it. It'll help you grow much faster.
All right, with that, we'll wrap up on this edition of Chartbusters with the news that the market has come off its highs. And briefly, we had seen the Nifty move into the red along with the Sensex as well, holding up around the flat line. Let's see what the second half of trade holds for you. Take a short break, come back. On the other side, we'll have the Trading Hour team next for you.
Hello and welcome to Trading Hour. I'm Sonal Bhutra. With me is Hormaz Patakia. We started off a little choppy today actually. We recovered from the lows, but the high today was 25,981, so close to 26,000 yet so far. And that has been the trend, right? But of course, after that stellar rally that we saw yesterday, it was something which was expected as well. For now, the Nifty is up 15 points, quite choppy. The mid-caps, they are doing well. So 106 points higher on the mid-caps right now. Bank Nifty that did really well yesterday has come in for some profit booking. So that's where we are seeing cuts of around 100 points right now. But yes, this is not something to worry about after the rally that we saw yesterday, though we have seen a lot of central bank action coming by in the Asian markets as well, China as well. Dow posted a record high yesterday yet again. So the expectation was maybe we could mirror that again, and maybe today could be the day for 26,000, but that hasn't happened. Maybe some sort of pullback, some sort of choppiness is something we can expect.
It never happens in one go, isn't it, for the Nifty? It will always come closer to those levels, it will tease, and then eventually a few days later it will cross that mark, still 40-50 points away from that mark of 26,000. It will take 38 sessions if it does happen today. But of course, it is the Nifty Bank that is the main catalyst for this up moves that we have seen on the Nifty. The last 8 sessions that the Nifty Bank has moved higher, it's been up 3,000 points. From those levels of around 51,000, we tested 54,200 on the upside yesterday. So it is the Nifty Bank that will be the one to watch out for today as well, because it's the financial services expiry. So we'll see if this moves in the second half of the session as well. So we'll keep an eye out on that. Of course, what's doing well today are the metal names. Of course, the metals index is the top sectoral gainer by a distance with all those stimulus measures that have been announced in China. The Nifty Metals Index and every single constituent of the Nifty Metal Index doing well today, be it NMDC, be it Nalco, SAIL, Vedanta, Tata Steel, all of them are doing very well in today's trading session. Tata Steel among the top gainers on the Nifty as well today. NMDC is up 4% and as is SAIL. So overall, good going for the broader markets. The benchmarks though are still in a neither here nor there sort of a zone.
Oh yeah, so broader markets, they continue to be doing well. And if we talk about certain names, Sapphire, for instance, that stock is up 12% right now. We have ASIC Kelkar, that stock is up around 10%. So some of these pockets which tend to do really well. But it's time to talk about market fundamentals. So Unmesh Sharma from HDFC Securities is joining us now. Unmesh, good morning. Thank you so much for joining in today. Well, you know, we've seen a lot of central bank action that has come by. We saw it with Fed. Now, in China as well, there's an indication that could happen. What are these trends suggesting, and what would this mean for the Indian markets?
So, good morning. So globally what started to happen is that while there seems to be some kind of stimulus on both sides, the reasons are very different. In the case of the Fed, you know, clearly we were at the peak of the cycle. I think that was indicated very well across the commentary from the Fed in the policy documents as well as outside in forums like Jackson Hole. China, on the other hand, is facing a completely different issue, which is that there has been a significant slowdown in the economy and there is balance sheet stress there. So, you know, as we have seen in the past couple of cycles as well, the way in which the Chinese government reacts to that is to pump liquidity into the system and keeps the lending environment very benign, because unlike Fed or India, where the transmission of policy happens through the banking system, there even individual lending at the individual asset level to a large extent is centrally controlled. So, you know, different reasons where I think in the case of Fed, I think they seem to be indicating that the fight against inflation is broadly under control. While in this case, it is a little bit more of pump priming an economy which clearly looks under stress.
Unmesh, good morning. Thank you for joining in. And what does all of this China factor does to a sector like metals, because it has been relying on these measures from China? The stocks are moving higher now that there is expectation that there will be stimulus announced. But do you always prefer metals to be a tactical play, because there will always be some headwind or the other that emerges for a sector like that?
I think, look, you know, the long-term structural trend on metals, and, you know, you would have seen that in all resources, including oil, is the fact that despite having so much turmoil in globally with the two wars, you know, both in the Middle East as well as in Europe, is that metal prices actually haven't spiked so much. And while there are other reasons for this, I think one very large reason has been that China, which has been in the last two large cycles, the big sink of all metals demand, if you aggregate it, in a lot of cases like copper or aluminium, they were basically absorbing 50% of global demand. Of course, that's an average. But I'm saying that in general, if the Chinese economy is not doing well globally, metals find it very difficult in that type of environment to go up. And that's true both for oil. Now, all of that is positive for India because we are a net consumer of these commodities as well. But broadly in China, I think what will happen is that we've seen this, in the past, after the slowdown in the global credit crisis as well, is that in the short term, every time there is a stimulus from the Chinese government, there will be a spike in metals. But all of this is tactical. So the way to think about it is that there is a structural kind of bear or underperforming kind of metals basket in which there will be these bear market rallies, which will be timed as per the stimulus in the China. And that's how investors should tactically play this.
Okay, Unmesh, I was going through your note. The projected earnings growth for FY25 is 5.7% and for FY26 is 16.1%.
Yeah.
What is the reason for, what do you think would be the factors that would lead to this low single-digit growth, and what are the factors that would contribute to the growth we'll see in FY25? And what happens in FY26 that we'll see that 16% growth? Is it low base, or there are some fundamental changes that will come by?
Yeah, so look, I think what is happening is that what you're looking at is aggregate. The way in which investors broadly look at earnings growth to a large extent is, X of banks and X of, large resources, which are global. So, if you try to bring it down to the earnings growth for the domestic economy, so as to speak, then that number actually is around 12-13%. And, so what happens is that if you X that, that is what you'll see. I think to a large extent, what is happening is that the base effect of the earnings has started to play through. We are a little bit now on what I would call steady state in terms of, real earnings growth of 6-7%, inflation of 4-5%, and then a slight multiplier on that. So while, yes, the headline number is 5 and, 16, it's really around, broadly around 12%, which you will find each year X of the large swing factors, which is how investors would look at it.
What about this quarter then, Unmesh? It's just a week from now that companies start to report business updates, and then the IT companies starting to report results as well for the quarter gone by. Is there a particular sector that you would want to watch out for in terms of the earnings performance this time around?
I think, to a large extent, I think if you look at the big sectoral change, if I may, because, I can go on for like on 12 sectors, but I think the one single one which we are keeping an eye on, we really want to know what is happening in the rural economy. I think there is enough, commentary that things have started to improve after reaching a bottom. But I think that with now, by the time the results start to come out, will be the second week, first or second week of October. What we'll start to see is whether this, adequate rainfall in terms of temporal and spatial distribution has been adequate. Because I think to a large extent on the large consumer names where we have incrementally turned positive, this will be a key driver of earnings for the rest of the year. So, come October, I think we'll be listening carefully to these calls to understand whether indeed the rural economy turnaround is playing out or not. And the second big factor would be what happens on the large banks, because that will be a key determinant one on our calls of, a little bit more overweight on large private banks in terms of whether the rate cycle is impacting, how they will impact. And it feels like there is a convergence on the large deposit and credit growth. If that comes out, I think that will be a very interesting play. So large banks has been our call for this. The commentary will suggest whether we should continue to go more overweight. And, it's been a laggard, so whether that is the way forward or not.
All right, okay, Unmesh, banks, they definitely will be the key to watch out for from here on. That is the sector to watch out. Thank you so much for joining in today with your take on the markets and the outlook going forward as well. We'll slip into a break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned for that.
Back with us here on Trading Hour. The Nifty continues to remain around that mark of 25,950 as we speak, and it is now recovering slightly off the highs of the day. 25,981 is the high that the index made earlier in the session. Good time to get in Mitesh Thakkar for a quick chart check. Mitesh, good morning. Thank you for joining in. Well, does 26,000 now pose as a barrier for the Nifty, at least for the time being, and couple that up with your stock recommendations as well?
So I think, to be honest, I think it's not the Nifty, but I think some profit movement on the Bank Nifty, and I think it doesn't look like a barrier. It just looks like an index which was extremely overbought during some kind of a pullback. But I think another 100, 200 points lower, I think the Bank Nifty could yet present a fresh entry opportunity. So not negative in that sense, and still maintaining a positive bias. Today, I think it's the metal and the realty pack which is doing very well. So I think maybe the focus should be there. I had some metal calls earlier in the day. Right now, I have a buy on Tata Power with a stop at 457.5 for targets of 480 and maybe even higher levels eventually. And also a buy on Oberoi Realty. That's a buy with a stop at about 1860 and a target of around 1970 can be looked at.
All right. Okay. Thank you so much, Mitesh, for joining in with those picks. With that, we'll slip into another break. When we come back, we'll talk more about stocks and specific market moves.
We've gone, since I've been here, we've gone from 6,000 employees here to 60,000. And they're across all things, data, scientists, engineering. We cover 150 companies in research and banking. 850 multinationals are coming here, custody, asset management. We've just been growing with the country, and your country's been growing quite well, and I'm quite optimistic about the future of India.
Who are you supporting, if I can put it bluntly?
I'm not endorsing anyone at this time.
Okay.
I spend more of my time on policy. What's the policy we need that can really help both the world, that's foreign policy, and domestically? So I think we need to do a lot just in America to lift up our country, and as we do that, it helps the rest of the world.
Mr. Trump, in an interview, he said this, that he may tap you to be the Treasury Secretary, Mr. Dimon. I just wanted to ask you
this. He said
like,
the next day, definitely not. So I don't expect to be the Treasury Secretary.
मैंने दिल्ली के मुख्यमंत्री का कार्यभार संभाला है, जिम्मेदारी संभाली है। आज मेरे मन की वही व्यथा है जो भरत जी की थी जब भगवान श्री राम 14 वर्ष के लिए अयोध्या से वनवास पे गए और भरत जी को अयोध्या का शासन संभालना पड़ा। जिस तरह भरत जी ने 14 साल तक भगवान श्री राम की खड़ाऊ रखकर अयोध्या का शासन संभाला, उसी तरह से आने वाले 4 महीने के लिए मैं दिल्ली सरकार चलाऊंगी। अरविंद केजरीवाल जी की गिरफ्तारी एक दुर्भावना के तहत हुई है। शायद कोई भी और नेता होता तो मुख्यमंत्री की कुर्सी पे बैठने से पहले 2 मिनट भी नहीं सोचता, लेकिन अरविंद केजरीवाल जी ने कहा कि मैं तब तक मुख्यमंत्री की इस कुर्सी पे नहीं बैठूंगा जब तक दिल्ली के लोग उनकी ईमानदारी पर भरोसा नहीं दिखाते, और उन्होंने मुख्यमंत्री पद से इस्तीफा दे दिया। लेकिन दिल्ली के मुख्यमंत्री की कुर्सी, ये कुर्सी अरविंद केजरीवाल जी की है। मुझे पूरा भरोसा है कि फरवरी में 4 महीने में जो आने वाले चुनाव हैं, दिल्ली के लोग अपने प्यार के साथ, अपने आशीर्वाद के साथ, अपने भरोसे के साथ फिर से अरविंद केजरीवाल जी को मुख्यमंत्री की कुर्सी पर बैठाएंगे। तब तक ये कुर्सी इसी कमरे में रहेगी। अरविंद केजरीवाल जी का इंतजार करेगी।
Earnings have been the key, and that is the reason why India has rallied 660% over the last 2 decades and outperformed US, which has only rallied 440%. And that's largely because of an earning. But FY25 have not started on a great note. First quarter earnings was lackluster, and we anticipate even second quarter earnings are going to be subdued enough. We do anticipate the comeback of earnings will happen from third quarter onward. On the small and the mid-cap side, we have seen close to 52 stocks out of 89, where consensus estimates are available. We have seen earnings downgrade happen.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. We spoke about markets, discussed market fundamentals as well. It's time to shift focus to the commodity space. Manisha is joining in today, and we're focusing on palm oil. Manisha, what's happening here?
Well, yes, there has been a lot of news on edible oil in the last couple of weeks, and that is because it's one of the essential commodities. We also saw government hike import duty by 20% for the crude and the refined edible oils, including palm as well, with an expectation that the international markets perhaps will come down and it would all work out well for the Indian farmers, consumers and the industry as well. Instead, what we have seen is that the international prices have continued to run up, and the latest reports suggest that Indian refiners, because of this, have cancelled nearly 100,000 tons of palm oil, which was anticipated to be coming into the country between October to December. Now, the duty hike and the global prices hiking has led to profit booking by many of these importers here. Palm oil prices globally have surged up above 4,000 Malaysian ringgit, and the prices are now trading at a 12-week highs, up nearly 7% on week. And that clearly doesn't work in sense of importing it with the kind of rise in prices that we have seen. Also, the strong EU demand, also ahead of the deforestation norms that take place in December 2024, has been another reason that you have seen the global palm oil prices continue to rise up. Well, the markets are also looking at very strong numbers coming in from Malaysia, where the exports have gained up by 9%. Indian markets will be looking at imports in any case going forward because this is festival season. As of now, there are enough and more supplies, but come the next month, which is October and November, you would be looking at imports. So overall, the feeling really is, or the context is, that you could be looking at higher edible oil prices in the last quarter of this year, which is also the festival season, by the way.
Manisha, thanks a lot for summarizing all things palm oil this morning. Thank you for that update. Shifting focus now to the new market debutants, and there were 3 of them today. Western Carriers, Arcade Developers and Northern Arc made their debut on the last street today. We start off with Western Carriers first up, this logistics player. It was a flat debut for them, and now the stock is trading below its IPO price. Mangalam is joining in now with more on the company. Mangalam.
Well, there are a couple of reasons why perhaps, it's been a flat listing and the stock is below its IPO price as well. They raised about 400 crore via fresh issue. The overall IPO was about 500 crore rupees. The total subscription was 30 times. Now, 30 times, is more than what was needed for the IPO to go through. But, it's a lot less than the recent 60, 70, 80, sometimes even 100 times subscription that we are seeing for IPO itself. It is India's largest private multimodal rail-focused 4PL asset-light logistics company. It's got volume shares of 6 and 2% for both domestic and EXIM businesses, respectively. They will pay about 163 crore of debt via IPO, and 151 crore would be deployed towards capex itself, for which the revenue CAGR over the last 3 years has been just a paltry 4.65%. Metals account for 53% of their revenue, FMCG and pharma the remaining for the company as well. Even if you look at the throughput volumes, from FY22 of 2.16 lakh TEUs, it's actually fallen to 2.12 lakh over the last couple of years. And a couple of things that stand out in their financials, even as the revenue has grown about 4.65%, margins have improved from 7% to closer to 8.7%. We've seen the debt for the company increase from 150 crores to 265 crores. And the EBITDA jump actually hasn't reflected in their cash flow from operations. So, cash flow from operations have decreased from 31 crores to about 22 crores. And on the other hand, the receivables for the company have increased from 59 crore to 136 crores. So until there is some improvement in their balance sheet going forward, there is some growth, etc., the street would perhaps back something like this. Maybe they would wait for some sort of growth to return and improvement in their balance sheet to come by as well.
That explains the muted debut that we've seen on this name. Thank you so much, Mangalam, for putting things into perspective. That's about Western carriers. On the other hand, we had good listings, 2 of them. Let me start with the Mumbai-based realty player Arcade Developers. It saw strong listing. In fact, the stock listed at 38% premium to its issue price. Right now, it's seeing gains of around 35%, and that was expected because the subscription was very strong. It was the highest subscribed IPO in the real estate sector in the last 5 years. And it was totally subscribed at 106.19 times. So there was a lot of interest, and that is something which can be seen in the stock price as well. Now, the promoter holding before the issue was 80.17%. Post listing, it will come down to 63.33%. The company will be using these proceeds to develop ongoing and upcoming projects, general corporate purposes, and also funding of future real estate projects. Now, remember, the company is both into redevelopment and development of newer projects. And remember, redevelopment has been a big opportunity that we are seeing for Mumbai-based players, and this company is expanding into that. The company, as I said, it's a Mumbai-based real estate player, and that is where they're expanding. If you look at the financials, the operating performance that the company has done in last couple of years, volumes have improved to 0.19 million square feet, collections have improved to 258 crore rupees, which compares with 170 crore rupees in the previous year. Sales in units have substantially jumped to 258 units. This compares with 87 units in FY22 itself. Now, what really worked for this company or this subscription this time around, or this IPO? One, redevelopment is something that the street liked. It is a big opportunity. Second, the valuations. If we talk about the FY24 NAV, which is the net asset value, that is how we look at these particular real estate companies. This was the lowest that we've seen across the other Mumbai-based real estate players. Arcade Developers at 21 rupees, Keystone at 157 rupees, Godrej Properties, that is in a world of its own, at 359 rupees, Macrotech at 180 rupees, and we have Suraj Estates at 148 rupees. So the valuation upside was a lot here. The redevelopment opportunity was a lot here, and that is what the street seemed to like. Yes, there are some risks with respect to cost of materials, the vendors not being the same for every project. But yes, looks like this is something that the street likes, and let's see whether the execution is as per the street's expectations.
Always the key, right? Execution. It's showing up in the price as well. The best performing stock among the 3 listings today is Arcade Developers, 35% higher currently at 173. The IPO price 128, and the third one on the list today was, of course, Northern Arc Capital, and that too listed at a 25% premium to its IPO price. They're trading with gains of around 21% as of now as well. So holding on to those listing gains, and as Mangalam was highlighting, right, that 30 times subscription, what otherwise on paper looks very healthy, is not the kind of subscription that you've seen through the year in most of these IPOs, and even this one was subscribed almost 118 times, and even then it's listed at a 25% premium. Now, this company is it raised around 500 crores through a fresh issue of shares, and it is a non-deposit taking NBFC, and it's been operational for over a decade now, and it is operating in sectors across various sectors and geographies. Now, we spoke to the management also earlier in the day, and they mentioned that they are expecting to see an improvement in margins going forward, and that has been one of the key concerns as well for most of these NBFCs and for banks as well. So they are expecting an improvement there, and 40% of the company's core business is focused on MSMEs. So it is an MSME focused company there, and the balance sheet has grown at a pace of around 31%. So it'll be interesting to see if they maintain that pace of balance sheet growth going forward as well, and that is something that the street would watch out for going forward as well.
Okay, all right. So that is Northern Arc Capital. We have those 3 listings that we wanted to talk about, but with that we'll do one thing. We'll slip into a short break. Up next, we'll be joined by Gokul Hariharan of JP Morgan. Stay tuned for that conversation.
Result season. Similarly, on the small cap side, close to 40 odd name out of 79 name have seen earnings downgrade. So that's where some comfort is going away, and hence we are broadly cautiously optimistic on markets near-term basis. Market is rallying so much. It is rallying because of sentiment, that is liquidity. So we need to track where this retail or this liquidity is primarily sitting in right now, and that is largely in also in SME side. So that's where some of the hit has started coming through, and we have seen close to 14 to 15% kind of a decline since end August onwards. The better idea for them would be not to chase the rally, to buy the dip or to start looking at a weaker time movement which will come. But this will be an opportune time for the first time investors or even the foreign investor who missed the entire rally in India for the last couple of years. So when they are seeing any quality names are seeing a sizable kind of a correction, which we have witnessed last week during couple of days, that's where they can deploy the money and start making investment into the Indian equities.
We need to find companies that are going to dominate the international landscape. Now, when I say international landscape, IT services has proven the fact that they are large, they are resilient, and they are a mature industry, accounting for close to about 7 to 8% of India's GDP. I'm not too sure that it's an underpenetrated market anymore because apart from fuel, alcohol remains one of the biggest sources of revenue for the government. The concern on valuations, I think, will remain for a while. I've been concerned about it for the last 1 year, but it doesn't really matter. For the largest period of time, as Old Bridge Capital, we've been talking about manufacturing. We've been talking about
Welcome back and on to a CNBC-TV18 exclusive. Then Jamie Dimon, the chairman and CEO of JP Morgan Chase, spoke to us about the US elections, the possibility of higher tariffs under Donald Trump, and a lot more. Listen into excerpts from that conversation.
Not endorsing anyone at this time.
Okay.
I spend more of my time on policy. What's the policy we need that can really help both the world, that's foreign policy, and domestically? And I would have a negative income tax. I would have better permitting. I'd reduce certain regulations. I would love schools to judge themselves on when the kids, high schools and community college, when they graduate, what kind of job do they get? You know, and so you're focusing on the outcome, not just, you know, the input. And so I think there are a lot of things to do to make America healthier and to lift up all of our citizens. I think we've, you know, if you look at the data, we've left behind the bottom 20%. Yeah, we should focus on that. That is a legitimate thing for government to say, why is that? They're also dying younger, their schools are worse, they have more crime in the neighborhoods, and that's kind of why you have populism. And so I think, you know, we need to do a lot just in America to lift up our country, and as we do that, it helps the rest of the world.
I mean, there's been a talk that if Mr. Trump, and in an interview he said this, that he may tap you to be the Treasury Secretary. Mr. Dimon, I just wanted to ask you this.
He said, like, the next day, definitely not. So I don't expect to be the Treasury Secretary.
Well, there's Mr. Musk, who's also been sort of, you know, he said openly that, well, I'd love to be part of a Trump administration. Yeah. I just wanted...
Okay, so Elon, this idea about having an efficiency commission, I actually like the idea. I mean, I think governments have to become more efficient, more competent, and look at, you know, when they take money, what do they get for it? And I actually think it's a very good idea. It's kind of like, remember Al Gore had the reinventing government? We really need to do it. I mean, in America we need to do it. I'm sure a lot of other countries need to do the same thing.
Right. Do you think under a Trump presidency, I mean, one of the big things which we all talk about, and he said many times, is tariffs essentially go up all the way, quite a bit, especially with China, but matching tariffs for all trading partners. Do you think that's a likely scenario?
I don't know the answer to that. I've spoken to some of his top advisors, and actually I was in D.C. last week, and they say, yeah, it's more of a negotiating tactic than an expected outcome. Remember, they did negotiate USMCA, they did negotiate with China, you know, a whole trade agreement with China. So yeah, I think the tactic would be rolled out. I would prefer we just end up with better trade deals.
Mr. Dimon, a quick last word about what your plans are. I mean, that's the other bit which, I mean, you're one of the last rock star bankers, if I can put it that way. And I'm not exaggerating. I just wanted to ask you that.
I'm getting old, basically. I love my job. I literally love doing it. I can help our employees and our clients, and I think it lifts up countries. And, you know, we finance schools and states and hospitals and governments and big companies and small companies. And then we have policies to lift up part of society that needs a little bit of help. I love it. And, you know, eventually I'll leave. You know, we've got great successors. We've got built-in successors. If you ask the analyst community, they can point 4 or 5 people they think are quite capable. And so sometime down the road, you know, some of those people move up, and maybe I'll go to chairman for a while, something like that. And
you can catch the full show and conversation with Jamie Dimon at 5:30 p.m. today. But before we get into a break, let's quickly take a look at the markets because they've come up from the highs sharply. The Nifty is in the red. It's a 13-point downtick that we are seeing there. Midcaps too, which were surging, they have come up from the highs absolutely flat with some positive bias though. And if we talk about the names which have led to this fall from the highs, we do have some of these banking names. IndusInd Bank, for instance, is at the lows of the day. We also have some of these consumption names which are contributing to the losses. HUL, for instance, is at the day's low. We have Asian Paints, Reliance Industries is the other one, ITC is one of them, and these are some of the names which are at the day's low, contributing to the fall that we are seeing on the Nifty from the highs of the day. So we'll keep tracking markets for you, but we have to take a short break. Up next, we'll be joined by Gokul Hariharan of JP Morgan. We'll discuss a lot of things from AI to tech to semiconductors. Stay tuned for that interesting conversation.
Okay, and a large part of services were not part of that entire framework. I think now looking in hindsight, if you have to extrapolate the same trends forward, it's going to be a little bit of a challenge because some of these businesses are trading at value at the market capitalizations in a cyclical industry, which some of them don't deserve.
आज भारत का 5G मार्केट बताऊं, बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। आप हैरान होंगे, आज भारत का 5G मार्केट बताऊं, बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। और ये 2 साल के भीतर भीतर हुआ है। अब तो भारत मेड इन इंडिया 6G पर काम कर रहा है। ये कैसे हुआ? ये इसलिए हुआ क्योंकि हमने इस सेक्टर को आगे बढ़ाने के लिए
Welcome back. You're still tuned into Trading Hour, and it's time to talk all about AI, technology, semiconductors, and a lot more. In fact, in recent news, India and the US have tied up for setting up a chip manufacturing plant in India. And the other talking point is, of course, the ever-expanding artificial intelligence landscape. Let's get in Gokul Hariharan, co-head of APAC TMT Research at JP Morgan, coming in and joining in from the sidelines of the JP Morgan India Investor Summit. Mr. Hariharan, good morning. Thank you so much for joining in today. You did have an interesting Asian tech tour. You met 40 companies on the tour, and the takeaways have been quite interesting as well. Something that stood out for you, how we are seeing demand when it comes to semiconductor, the chip supply issues, if they are getting over very soon, and how are investors perceiving that big boom that we are seeing in artificial intelligence?
Yeah, good morning and thanks for having me on. So I think the technology industry is going through a pretty interesting cycle. We're essentially getting a K-shaped recovery here. Everything AI related is booming. We've had this boom since 2023 and it's continuing to go. There's obviously some questions about whether we are kind of at the peak of this. We don't think so. There is still pretty strong growth coming through from heavy investments in foundational large language models developed by a lot of the cloud services providers. There is also incremental demand coming through from sovereign AI, countries such as India and other countries also developing their own AI. So AI clearly remains an important driver for growth for semiconductors in the next 2 to 3 years. We think that this is likely to last for another 2 to 3 years. At the same time, a lot of the areas where we saw a lot of incremental demand during the pandemic period in 2020 and 2021, including a lot of the older generation chips and associated products, they have been in a bit of a post-pandemic funk. So we're still going through a little bit of a correction in those segments. They're still kind of bouncing along the bottom, which is why I said there was a K-shaped recovery. We're kind of seeing a little bit of a light at the end of the tunnel for that segment. So that should probably start to come back up in 2025. That would contribute to the stronger growth for semiconductors in 25 and 26. Lastly, I think as Gen AI becomes more broad-based and we see a wider adoption, we will start to see a lot of Gen AI applications start to come on to the edge devices or the devices that you and I use, smartphones, PCs, etc. Apple already talked about Apple Intelligence coming through with the iPhone 16 products, and we'll see a lot of other manufacturers also bring these functions to devices, which will be potentially the next leg of driver or next growth driver for semiconductors as it pertains to AI.
Mr. Hariharan, good morning. Thank you so much for joining in. I'd like to go on to that semiconductor push that India is currently having and the announcements that were made on the Prime Minister's tour to the United States. Do you see that? You know, it's of course it is a long gestation period, right, for a semiconductor unit to come around and then production begins and all of that. But do you see this move as the first step for India to become that semiconductor manufacturing hub that it aspires to be?
Yeah, I think very interesting times here. I think I've covered semis for 20 years. The first time that we're starting to see something really happen back home in India, so that's very exciting. I think India is going about it in the right way, I would say. There are probably 2 or 3 things which are fundamental. First, I think the government policy seems to be pretty consistent and also very realistic at the same time, not really trying to do very advanced semiconductors, which only very few companies in the world do, trying to start at more manageable kind of aspirations. Second, I think the companies that are starting to invest in India, we are starting to see big companies, Micron and a few other global companies invest. Also, some of the bigger conglomerates in India, Tata Group and others, are also starting to invest. So there is support from local biggies as well as MNCs for this push. And third is the external factor, right? I think the whole world is looking at some degree of supply chain diversification. People want a China plus one or a greater China plus one kind of supply strategy, and that's kind of come into sharp focus. A lot of countries are trying to find that next destination. I think India clearly has a role to play as a potential destination there. Now, I think if you look at the semiconductor ecosystem itself, there are various parts to that ecosystem. India is kind of starting to take some baby steps, largely in the assembly and packaging or packaging of chips, you could say. That's probably the right place to start because A, it is labor intensive, which kind of caters to the lower cost skill labor available in India. Secondly, the entry barrier in terms of technology and IP is not that steep, so new companies can actually come on to this pretty quickly. It's still a smaller part of the value chain, but that's probably a good start. Now, if you look forward a little bit, I think the 2 areas which are the higher value part, adding parts of the supply chain, one is design, chip design itself. That's where American companies like Qualcomm and NVIDIA basically lead the market. India has actually the largest or one of the largest pool of design talent, chip design talent domestically, roughly about 300,000 people working on chip design. Only thing is that it has not really coalesced into something that could be a homegrown company. There are a few interesting startups coming up in the chip design space, in analog chips, mixed signal, IoT, etc. But that's still a very early step. But if that can start to crystallize, that's going to be quite powerful. The second part, obviously, is the holy grail, which is the wafer fabrication or the fab, as people call it. That's quite difficult. India is already announced maybe 1 or 2 fabs. I think Tata Group has announced one. There are a couple of others also that have been announced. That's going to be a little bit more of a longer journey, as you suggested. It's probably going to take 5 to 7 years. And you have to start at a more mature kind of technologies, not go directly to extremely leading edge technologies. I think India is doing the right things. I think if you look at some of the new fabs that have been announced, they're mostly focusing on mature technologies. They're also bringing in partners who already have experience working on these technologies for many years. So that's, I think, the right approach. But this is something where consistent policy would be required, which I think the government seems to be pretty committed to do. And it will take time. It's not going to have a quick result. It's probably going to take 5 to 7 years. That is required for the ecosystem to kind of clearly get established, have some kind of a critical mass, and then that kind of starts to feed on itself. Now, just as an aside, I think TSMC is a company that I follow. They are kind of like the market leader in terms of technology prowess today. But if you look back 35 years back or 37 years back when they started, they also started with N-3 or 3 generations or 4 generations older process technology compared to what was the state of the art at that point in time. So you have to start usually a little bit behind, but over a period of time, once that momentum comes through, I think you can kind of start advancing. So it's a great start, and I think there is clearly a lot of momentum. We saw this in a couple of the presentations that we had in the India Investor Summit as well, that the momentum is clearly there, both from the policymakers as well as from the big companies.
Okay, all right, Mr. Hariharan, such a pleasure speaking with you. We had a lot more questions, but we have run out of time. But that's an interesting take. Of course, exciting times ahead for the semiconductor industry in India and globally as well. That's the word coming in from JP Morgan on everything AI, tech and semiconductors. But we have to move on and talk about some stock-specific action. Nomura has issued a bullish note on Ipca Labs, raised the target price as well. It estimates a compounded growth of around 30% over the next few financial years. Ekta is joining us with more details on this. Ekta.
Thanks for that. Well, yes, Nomura has written on Ipca Labs. They have a buy. They've raised their target price to 1,750 odd rupees. They have a positive view on the stock based on factors such as the consistent outperformance in the domestic formulations market. Business, according to them, which is the domestic business, attracts higher valuation multiples and believe it will contribute 50% of the FY 26-27 EBITDA. There is scope for improvement in other business segments in the near to medium term, particularly generics as well as the API segment, and cost and revenue synergies at their subsidiary Unichem. They estimate a 30% earnings CAGR over FY 25 to 27. The estimate growth momentum may remain strong post FY 27 as well. They expect the EBITDA margin to reach 25 to 26% over time versus estimates of 23.6% in FY 27.
Ekta, thanks a lot for that. Ipca Labs slightly off the highs of the day, but trying to hold on to gains of around 1.25% as of now at 1475. Time for a short break. Up next, we get chatting with the management of Cosmo First to get an understanding of their current demand trends. Stay tuned. Back on the other side.
पॉलिसीज बनाई, हमने मेड इन इंडिया टेक्नोलॉजी पर काम किया, हमने सस्ते डेटा पर मोबाइल फोन मैन्युफैक्चरिंग पर फोकस किया। आज दुनिया का करीब करीब हर बड़ा मोबाइल ब्रांड मेड इन इंडिया है। आज भारत दुनिया का दूसरा सबसे बड़ा मोबाइल मैन्युफैक्चरर है। एक जमाना था मेरे आने से पहले जब हम मोबाइल इंपोर्टर थे, आज हम मोबाइल एक्सपोर्टर बन गए हैं। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। ये तीसरे टर्म में हमें बहुत बड़े लक्ष्य साधने हैं। हमें 3 गुना ताकत और 3 गुना गति के साथ आगे बढ़ना है। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। पुष्प, और मैं पुष्प को डिफाइन करता हूं, P फॉर प्रोग्रेसिव भारत, U फॉर अनस्टॉपेबल भारत, S फॉर स्पिरिचुअल भारत, H फॉर ह्यूमैनिटी फर्स्ट को समर्पित भारत, P फॉर प्रोस्परस भारत।
Welcome back on to Corporate Conversations then, and the management of Cosmo First is joining in right now to talk about what are the demand trends looking like for this quarter and for the rest of the year as well. We are being joined by Group CEO Pankaj Poddar to discuss more on this and the outlook going forward as well. Mr. Poddar, good morning. Thank you so much for joining in. We are almost coming to the end of the second quarter. How has business looked like this time around? Not to ask you for specific numbers, but has this quarter been better than the first quarter that you had? And of course, part 2 of my question being, have your spreads across your various film lines improved as well?
Yeah, so this quarter is looking better for multiple reasons. First, the good news is that raw material prices and oil prices are coming down, which is always very good for the industry because it brings down the working capital and also makes films cheaper versus other substitutes. Demand is growing well, and therefore the margins are also looking healthy both for BOPP and BOPET. The specialty is also growing nicely for us. BOPP is now clocking 70% plus month over month. BOPET specialty also has started doing 20% plus. And then all the new businesses that we have started are also tracking well for us. Chemical business is now making a monthly EBITDA of close to 3 crore and a monthly sale of close to 15-16 crore. Similarly, Plastic is now touching a run rate of close to 4 to 5 CR per month, and it looks like that Plastic business will also start making EBITDA positive from quarter 4 of this year. And similarly, Cosmo Sunshield, the trials are going very well, and we expect to commercially launch this product within next 2 quarters. Coming to Ziggly, which is our pet care business, that business also we have been cutting down our losses, and now we are back in a mode of growth. So we have now 25 centers, and both our online and offline is growing. We have significantly reduced our losses by close to 40% on that business, and we are tracking very well from a growth perspective. There is a month-on-growth of close to 6-7% in that business.
Okay, so Mr. Poddar, you've given us an overview of the entire business. Now we have to get specific. Quarter 1, you did indicate that realizations have improved, and that is something that has happened in quarter 2 as well. Realizations on an average, including specialty films, was around 35 to 36 rupees per kg. Can you give us a sense of whether it has moved up from those levels in quarter 2 and by how much? And is this a trend which is expected to continue? Because so far we were talking about supply-demand mismatch. Has that started moving in the positive direction across the industry?
Yes, so see, margins are going up, though for Cosmo, much more important is our specialty growth, where, as I said earlier, that BOPP is now 70% plus and BOPET is 20% plus. But in general, yes, this quarter margins are better than the last quarter, and demand continues to grow for this industry. There's a better stability in the exports market as well, whether we talk about America or Europe. So in general, things are good. But then obviously, you always have some more capacities coming up, in the times ahead, and that temporarily impacts the margins. And then you again have. So we have to, kind of acknowledge that this industry, especially the film one, is a cyclical industry. And one of our key targets is to take out Cosmo completely out of this cyclicality over a period of time. And that is the reason we have been focusing so much on specialty business. So BOPP now we are close to 70% of our volumes into specialty, and BOPIT also the tracking is going nicely.
So how much have those margins improved by? If you can give us a ballpark number, 10%, 20%, and is this a sustainable trend?
Yes, you see margins.
Specialty bit.
Yes, specialty for sure. I have in the past indicated that they tend to stay, 2 to 4 times of commodity margins. And, if we see a long-term average, they are normally 2.5 times of commodity margins, because commodity margins keep changing while specialty margins are far more stable. So given that we have started tracking, last year we were tracking at close to 60%, and this year we are now, if we talk about first 6 months, we're tracking close to 67, 68%, and last couple of months we are tracking 70% plus. So these things will certainly help improving our margins. They are showing in our profitability trends as well, and that is a key focus for the company.
Mr. Poddar, you mentioned bringing Cosmo out of the cyclicality in the near future. Is there a timeline that you have set that this is by when you want to do that? And also your CPP line, is that on track to be commissioned by the third quarter this year? And how much would the initial revenue contribution be in this financial year itself?
Yes, so see, given the fact that we're bringing more capacity even on BOPP next year, so these percentages will look lesser once the new line comes up, though the absolute volume numbers are continuously going up. We had targeted that we will touch 80% because taking it beyond 80% becomes very difficult because of the fact that you have some customers. So we are tracking well. This year end itself, we should be 75% on BOPP and 25% on BOPIT. And, other than the fact that new volumes would come up, on the past volumes, we should be moving to 80% next year itself. Coming to your second question in terms of, sorry, can you repeat your second question?
That's the CPP line, Mr. Poddar.
Yeah. So the CPP line has been commercialized already, and obviously it will take us some time to fill this capacity. CPP will help us make the structures for brands more sustainable, more cyclable, and recyclable as such. And the initial traction is good. We are working a lot of big FMCG brands to give them more sustainable structures. And, we are happy with the initial progress that we have made, and it will continue to happen in the near future as well.
Okay, so if not at the full, of course, you wouldn't be able to get the full capacity utilization this time around. By end of this year, what kind of revenue addition would you see from the CPP line itself? And the second part of the question is the cost-saving initiatives that you've taken, the renewable power and Korea plant moving to India to cut costs. Has that already started flowing to your bottom line, the cost savings that you've spoken about earlier?
Yeah, so the Korea one has already started flowing because there's close to $1 million saving coming because of that reason itself, because we have shifted the production. Similarly, renewable power also, some part of it is already done. We are hovering between 40 to 50% of our total power requirement coming from renewables, and a couple of more agreements are in the pipeline. We are expecting that in a year's time, we should be drawing 70% of our power from renewable, which is one side make us more sustainable, and on the other side, it also gives us cost reduction. And given the fact that our demand is so much stable, we can certainly afford to have a very high percentage of sustainable power and renewable power in our portfolio.
All right, Mr. Poddar, thank you so much for sparing time and joining us to talk about your road ahead for the remaining quarters of FY25. That was the management of Cosmo First speaking to us on the road ahead. By the way, the Nifty continues to hover around that mark of 25,900, but the metals index has come off the highs of the day now. At one point was up almost 2.5%. Now it's below that 2% mark. Almost 0.8% down from the highs of the day is the metals index. HDFC Bank is also another one that has come off the highs of the day. 1794 is that level on HDFC Bank that you need to track for the record high for the stock. It made a high of around 1780 this morning, and it has come off those levels as well, almost 1% off the highs of the day. But with that, it's a wrap on this edition of Trading Hour from Sonal, me and the team that put this show together. Thank you so much for watching. Halftime report comes up next.
यानी पुष्प पुष्प की 5 पंखुड़ियों को मिलाकर ही विकसित भारत बनाएंगे। साथियों, मैं भारत का पहला प्रधानमंत्री हूं जिसका जन्म आजादी के बाद हुआ। आजादी के आंदोलन में करोड़ों भारतीयों ने स्वराज के लिए जीवन खपा दिया था। उन्होंने अपना हित नहीं देखा, अपने कंफर्ट जोन की चिंता नहीं की। वो तो बस देश की आजादी के लिए सब कुछ भूलकर अंग्रेजों से लड़ने चल पड़े थे। उस सफर में किसी को फांसी का फंदा मिला, किसी के शरीर को गोलियों से भून दिया गया, कोई यातनाएं सहते हुए जेल में ही गुजर गया, कईयों की जवानी जिंदगी जेल में खप गई। साथियों, हम देश के लिए मर नहीं पाए, लेकिन हम देश के लिए जरूर जी सकते हैं। मरना हमारे नसीब नहीं था, जीना हमारे नसीब है। पहले दिन से मेरा मन और मेरा मिशन एकदम क्लियर रहा है। मैं
Stocks swing between gains and losses and amid fresh economic and geopolitical uncertainties. And after a big rally already, metals and utilities lead gains while realty and IT drag.
Metals perk up after China's central bank chief points to a 50 basis points cut in the reserve ratio and a cut in interest rates. He also promises lower rates for mortgages, even as reports suggest a recapitalization of banks is likely.
MobiKwik gets SEBI's nod for a 700 crore rupee IPO, while NTPC Green Energy readies for a likely November offer. Meanwhile, 2 of the 3 IPO listings today, Northern Arc Capital and Arcade Developers, deliver hefty gains.
A SEBI study from FY22 to FY24 reveals that 9 out of 10 individual F&O traders lost money, with their cumulative losses amounting to 1.8 lakh crore rupees during the period. Algo firms cornered most of the F&O trading profit. Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Manglam Malu. Well, today is turning out to be a day where we are just about consolidating in terms of the indices. But if you look deeper, the Nifty is very close to those 26,000 levels. So nothing really to complain about at this point in time. Just about biding time around those levels before we probably get to those levels on a decisive basis. But stock-specific action continues to be in focus. So just want to point out stocks such as AstraZeneca as well as IPCA are at fresh 52-week highs today from the pharmaceutical sales space, and separately we've seen some good listings coming in from the likes of Northern Arc as well as Arcade Developers. So both those stocks are buzzing in today's trading session. But nonetheless, no complaints, Manglam. It seems as though we are just on our journey to 26,000.
Absolutely, it's not a question of if, but it's more of when. And a lot of stocks are doing a lot better as well, despite, the broader market or the market breadth showing signs of consolidation, even as the frontline indices are slightly below the flat line. We do have a bunch of these stocks which are doing extremely well. The metal stocks, of course, because of some boost coming in from China. But keep an eye out on, Arvind Smart Spaces up around 10% at a fresh 52-week high for that stock. Sapphire is the other one, which is up around 11%. At one point was up around 11%. Now sitting with gains of about 9% as well. We are seeing some traction in names like Godavari Power Ispat. We have Everready, which is higher by about 6.5% as well. The only, real accident in today's trading session on the way down is IEX. So just keep an eye out on that stock. And barring that, there is just consolidation at higher levels itself. So good time to get in, a call on the way forward for the markets. We have Christy Mathai, who's the fund manager, Equity Quantum AMC, joining in to give her view on the market itself. Christy, what's your sense here? I mean, how do you go about the way, it's positioned right now? And on the one hand, people say that there is still the growth opportunity, but on the other, there is valuation as well. So given your view on the market right now, how are you positioning yourself?
Thanks, Mangalam, for having me. So clearly, we run a value strategy and value portfolio here at Quantum. So we are, to the latter half of what you said, we are concerned about the valuations that are broadly exhibited in the market. And I think that continues to be a key factor that kind of stops from incrementally adding so much to this market at this point in time. So the key bets for us currently looks mostly in the financial space. So roughly 40% of our portfolio is into the broader financials, which is roughly 25% into the banks, and especially the private sector banks. And that is the only place where we think there is still value that can come through if you're taking a slightly longer term the thought process. IT remains another key bet, but here we are watching carefully in terms of management commentary and what's developing in US. Broadly, the other portion of the market, in our view, continues to be overvalued, and we are largely staying away or trimming our positions in these pockets.
Okay, all right. In particular for IT, what are you watching out for when it comes to the management commentary, and what's your expectation from the Q2 numbers?
Right. So IT, we have seen, at least in the past few years, so bulk of the discretionary consumption that got started post, the COVID, the wave, what we saw. So there is fair bit of cancellation in terms of a lot of projects, and incrementally what we are seeing, a lot of companies reporting good order books, the deal wins, but because of these discretionary consumption being cut down, there is, that is not, the whole is not really resulting in large revenue growth for most of these companies. So incrementally, we think bulk of these discretionary cuts are, behind. A lot of it, the pace of cut may be a bit slow. And from here on, we think that, when we look at some of the consensus earnings numbers, if the rebound were to happen in US markets and, Europe markets, which are fairly large centers for Indian IT services, so the earnings could positively surprise on the upside. But valuations, again, in some of these pockets are high. So we are largely sticking to the large cap names, where we think there is some, still some room.
Would you have a view on the metals pack? That pack is doing well today, but, had been a bit of an underperformer post down cycle, worries about demand from China coming in. And now there are some comments from the Chinese monetary authorities trying to pump prime the economy by easing some of the liquidity conditions. Do you think that could spell some positivity for our metal space, and is that investable?
Right. So metals, in our view, is largely driven by what happens in China. We have seen the Chinese exporters kind of dumping the world market and kind of depressed pricing across in the metal space. So incrementally, some of the news that we are hearing is positive, but there have been quite a few false starts in the past as well. So we are watchful in that sense. So we do have a metal name in our portfolio, but this would not be a great time to enter. Typically these, we want to buy companies which have, either a great group supporting them, or, when their leverage is kind of trending down or the prices are pretty in the worst phase, that would be a great time to enter some of these names, which does not seem to be the case now. So we're largely holding on to our position and incrementally watching out how this Chinese commentary translates into the actual execution.
Okay. But just wanted your sense on the entire setup for the markets now, Christy. The Nifty is given returns of 19% year to date. The mid-caps are up over around 30%. What's your strategy? What are you advising clients? Probably take some profits off the mid-caps or and change and shift their money towards the frontliners? Or would you continue probably looking at the mid-caps for further gains?
Yeah, so our broadly advice is, we should, to any investor, is we should largely moderate our return expectations from the market. There's been 2 fairly good years in the market, and typically, as the history suggests, there could be some moderation that could be coming. But again, we cannot really get out of the market as such because, if you kind of miss out, being part of the market, you your returns are not so great in the long term. So strategy is to move away from the pockets which have done extremely well, which includes large and mid cap, and there is some bit of euphoria, move into the large caps. Especially you would have to look at the portfolio construct very carefully. At least from a value manager point of view, we want to deploy where there is bulk of value, which remains, in our view, in the financial space. And we are also sitting with fairly sizable chunk of cash as well, roughly around 15%, which we would look to deploy as and when the market corrects. So, advice is a bit of caution and, expectation of return moderation going ahead.
All right, expectation of return moderation with advice of caution. 15% is the cash that you're sitting on. Let's wrap it up with, the consumer space. A lot of people are hoping for rural recovery and thereby showing their proclivity towards, the staples. Just wanted your thoughts on that. Are you looking to back some of the staples? Because falls right in your, not having run and is a large cap sort of thesis.
Yeah, so I think from a staples perspective, looks like the market has priced in a lot of positives that could come, even from a rural recovery point of view. And we're just about hearing some bit of improvement within the rural bucket. But our concern is broadly when you look at the whole staples piece, of course, they are great companies with extremely high return ratios and so on and so forth. But the valuations that they tend to trade at is beyond our comfort zone. So this is a place we would love to own, but at lower valuations. So that remains our chief concern. And we also have to see whether the rural recovery, which is touted about so much, actually plays out. That is also a point to keenly watch out for.
So incremental money, where is it that you're finding valuation comfort right now? If you could give us your top 2 sector overweights, and in that, if you could, probably give us a bunch of names as well without delving into specifics.
Right. So if you look at the past quarter or 2 quarters, where we have actually deployed is essentially into private sector banks, largely to the top banks, because, there is reasonable comfort on valuation. We know there are certain concerns such as moderation and credit growth, the whole credit to deposit ratio being higher, but we largely see these, themes as transitory. And probably when you're taking a slightly longer term view, most of these banks are in the right place to deliver growth at the right valuation. The other pocket is we've been incrementally finding opportunities within the life insurer pack. So we have deployed some incremental cash that is there into those. But these are the only places. We have largely trimmed our allocation in autos and most of the other sectors.
Just quickly before we let you go, have you looked at the MNC space? The reason I ask is that stocks such as AstraZeneca are doing extremely well today. Very good price action on that counter. And, I was just reading about the kind of growth that they're seeing in the Indian market as well. Are those portfolio plays according to you?
Yeah, so not again specific to the name, but within the whole pharma space, we are fair bit deployed in the pharma space. It is, though we are slightly trimming in some of our allocations because, the US, the pricing has continued to surprise us. It continued to be extremely strong, and the India bit is doing what it used to do, fair bit of growth, very steady state growth. So the pharma as an allocation has remained, for quite some time in our portfolios, but incrementally we have been trimming a bit because some of them we think have run up too far ahead.
All right, Christy, thank you so much for joining in and giving us your view on the sectors, your top picks and things to avoid, sitting on 15% cash, preferring large caps to mid caps right now, hoping for some growth to come by, and at the same time liking only the private sector financials and some of the life insurance companies in the very recent past. Take a short break, come back, get you more on the markets and get you some insight into the new market debutants today.
ये जीवन नहीं दे पाया, लेकिन मैंने तय किया सुराज और समृद्ध भारत के लिए जीवन समर्पित करूंगा।
If you want to take India as a superpower, we need to make sure Modi is there all the time.
Very proud to be Indian, and today I am very proud to say that our Prime Minister put India on the map in the entire world.
We are so proud that we have this kind of hard-working Prime Minister, and we are very, very excited to see him.
Today, he had a great opportunity to sit down on the Quad Summit, and the way he presented the country on.
Welcome back. Well, quiet for the markets, but let's shift focus to the market debutants. We have three companies which have listed today: Western Carriers, Arcade Developers and Northern Arc, which have made their D-Street debut today. Let's start by covering Western Carriers. It's a logistics player maker, and it was pretty much a subdued debut that they've made. Mangalam, tell us more about it, and was this kind of a reaction expected?
Well, some part of it was expected, and I'll tell you the reasons why for Western Carriers. The first one, of course, is that in light of a time where, you have IPOs which are subscribed 60, 70, 80, some even in triple digits, there was a total demand of 30 times its issue price. That isn't to say that there wasn't any demand for it, but it was a lot lesser than what it was for all the other IPOs. The company's raised about 500 crores, 400 crore comes in via fresh issue. It is India's largest private multimodal rail-focused 4PL asset-light logistics company. The market share for both domestic and EXIM volumes are 6% and 2%. respectively. They are facilitating multimodal transaction, and of the 400 crore rupees that they will raise, about 165 crores goes into repayment of debt, and capex is another 151 crores itself. Now, here's why the street expected subdued listing this time around. Why? Because one, revenue CAGR of the company has been just about 4.6% in the last 3 years. Metals account for 50% of their revenue, FMCG and pharma, the rest. All these sectors haven't been doing very well in the last 3 years or so itself. And that's reflected in the meager volumes for the company as well. 2.16 lakh was what they did in FY22. That fell to sub 2 lakh in FY23 and is still at around 2.12 lakh itself. And if you look at the financials as well, some things don't tie in. Revenue of FY23 was close to 1600 crores, FY24 1700 crores. Margins have, yes, from FY22 increased from 7% to close to around 8.1% as well, 8.7%. But that hasn't reflected as much in their cash flow from operations. In fact, the debt of the company has increased from about 150 crores in FY22 to 266 crores in FY24. The cash flow from operations is actually down from 30 crores to about 22 odd crores, and receivables have increased from about 59 crores to 136 crores as well. So maybe the street would like some improvement in their financials and the macro improvement going forward, along with some tightening of their working capital and improvement in their balance sheet as well, before perhaps the street sees some merit in Western carriers.
Okay, all right, Mangalam. Thanks very much for that. So that's on Western carriers, but we have Mumbai-based realty player Arcade Developers, which has seen a strong listing today. Sonal is here to tell us more about it. Sonal.
Well, yes, it is another good listing that we've seen today. The stock listed at a premium of 38% at 175 rupees a share versus the issue price of 128 rupees a share. And this is something which was expected because it saw strong subscription. In fact, it was the most subscribed real estate IPO that we've seen in the last 5 years. And the total subscription or the bids were to the tune of 106 times itself. The promoter holding before this issue was around 80%, and that falls down now to 66.33%. Now, the proceeds, they will be used for development of ongoing and upcoming projects, general corporate purposes, and also funding acquisition of future real estate projects. About the company, as you mentioned, it is a Mumbai-based real estate player, and here the company is both into redevelopment and development projects. In fact, redevelopment is as much as development portfolio for the company, and that is a big opportunity that the company talks about. Their operational updates, they have been increasing volumes. Volumes in FY23 came at 0.19 million square feet. Their collections came at 258 crore rupees, and sales in terms of units increased to 258 units. This compares with lower levels that the company saw in FY22. So there has been a growth that we've seen there. The other thing that worked for Arcade Developers is valuations. Because if we go by FY24 numbers, their net asset value, it was the lowest that we've seen in Mumbai real estate players. Remember, the NAV here is high because of the land values and the asset values as well. For Godrej, it is as high as 359. We have Keystone at 157. Suraj Estates at 148. Arcade was just 21 rupees. So the valuations work for them. Yes, there were some risks in terms of some of the collection amount, the cash flows, and also the cost of construction that they have. But looks like Street is looking at the opportunity that they have from redevelopment and also the pricing of the IPO, where the valuations have been much lower than the peers.
All right.
Okay. Okay, all right, Sonal. Thanks very much for that. So that is on Arcade Developers. But back to you, Mangalam. Northern Arc is the other one that you're watching out for.
Yep. Last week we had the management here. When the IPO opened this morning, we spoke to them once again post the listing, and they reiterated a couple of things, and that explains why the stock has seen a fair amount of listing. It listed at a 33% premium. Thereafter, it's seen some moderation, still holding with a 20% uptick versus its issue price itself. The key takeaways from what the management said: their CRAR, which was close to around 18%, will increase to 23 to 24% post-capital raising. In fact, they've raised this capital for growth itself. The balance sheet has been growing over 31% over the last 3 years, and the management believes that this is a rate that they can continue to grow at in the future as well. As far as their borrowing is concerned, 20% of that comes in from offshore multilaterals. Their core NIMs are close to around 8.3%. Plus, they have some fee income, placement fees as well. So if you add both of them back as well, you have a total fully loaded net interest margin, as the management calls it, closer to 10% itself. 40% of their exposure is MSME. MFI accounts for 26%, and 27% is consumer loan itself. And the return on assets are over 300 basis points on a fully loaded basis. So key things to track from here on is will the company continue to grow at 30% plus? What happens to their asset quality? And nearly half of their loans are syndicated. What happens to their own loans is something that we'll be watching out for. In a down cycle, typically 65% of their loans come in from banks, so that may impact their NIMs further positively as well. So those are a bunch of things we'll be tracking.
Okay, all right, Manglam. Thanks very much for that strong debut for Northern Arc there, up around 20-odd%. But just want to point out that if you are tracking a couple of these stocks on the volume counters, Northern Arc is one of them. But the other one is Vodafone Idea, which is under pressure today as well. So that stock has lost around 30-odd% of its market cap this month itself and is down 2.5% today. So just about tottering at those 10.5 rupee levels for Vodafone Idea. Let's see whether it manages to sustain in double digits or not, but as of now, under pressure for that particular counter. We'll take a break, but Sachitanand Uttekar of Trade Bulls will join in to discuss some trading ideas. Stay tuned.
We are very proud.
Quality.
Welcome back. You're watching us here on Halftime Report. At near record highs, the market continues to consolidate, even though a lot of stocks are moving around in today's trading session. One of them is First Source at the bottom of your screen. But good time to get in, the F&O perspective. Even as the frontline indices are absolutely flat, cues suggest that this consolidation may continue for a bit. Why do I say that? Because if you look at, the broader markets, you look at the advanced decline ratio as well. This is the expiry week. Ahead of that, there is some consolidation. They've been coming closer, and now there are more stocks declining than the number of stocks which are advancing for a brief period, and now those lines have intersected once again. So the street is not fully decided on the way the market goes from here after having seen a record run already and ahead of expiry too. Speaking about expiry, this Thursday we will have the Nifty expiry, and there is a range-bound move which is expected. Put writers at 25,900 extremely active, telling you 25,800 at the lower level would be strong support, but 26,000, which is a psychologically important mark as well. Out there, the call writers are pretty active for a premium of 80 rupees as well, telling you levels upwards of 26,050 to 26,000, almost 26,100 may see some sort of supply coming in for the frontline index. But ahead of the Thursday expiry, we have the Nifty Financial Services expiry today as well. Nifty Financial Services is at 24,920 thereabouts for that index, and you have the 24,900 call and put most active, also have the highest open interest. What's the premium on the 24,900 straddle, which is a call and a put together? Close to around 60 rupees, telling you once again that is the 24,850 to 24,950 sort of narrow range that the street is expecting for the Nifty Financial Services expiry as well. That brings us down to all the individual stocks. Remember, we told you on yesterday that RBL Bank may exit F&O ban. Well, one day of being out of F&O ban, it may re-enter F&O ban. Also, Hindustan Copper and Escorts Kubota are seeing a lot of open interest, have crossed the threshold level, so may enter F&O ban if there is no further unwinding from here as well. Also, keep an eye on Nalco and Aarti Industries. Metal stocks are doing extremely well. Nalco is doing a little better there as well. One of the elements could be its potential exit from F&O ban today, and Aarti Industries is the other one. After being in F&O ban for a while, maybe one of those contenders for coming out of F&O ban in today's trading session.
Okay, all right, Mangalam. Thanks very much for that. Sachidanand Uttikar joins in now to discuss the technicals of the market. Sachidanand, welcome to the show. Well, quiet day, but not really for the stocks which are moving around. So give us a sense. What's your strategy both on the index as well as stocks?
Good afternoon, Ekta. Good afternoon, Mangalam. I think clearly both the indices are consolidating here, but if you look at the major trend, it still remains strong for Nifty and Nifty Bank as well. For the day, I think the hurdle of 26,000 may not be breached. We may see the Nifty, oscillate within this particular narrow band itself. It is trying to form an elevated base somewhere close to around 25,830, and I think that is a immediate support that we are looking at. So any declines towards this support will again give us a good opportunity to create some long positions here. The overall structure remains healthy until unless the Nifty holds above that 5-day exponential moving average support, which is placed right now at around 25,740 kind of a zone. So until unless this particular level is held on, we may see Nifty eventually swinging towards 26,270 by this Thursday's expiry. When it comes to Nifty Bank, it has been oscillating within a range of 53,800 on the lower side. And I think the headroom is available right up to 54,350. So even here, we are looking at some consolidation for the day, but eventually we may see Nifty Bank also scaling towards 54,350. When we look at stocks, there are two stocks which are looking good from a breakout point of view. The first one is Cummins India. If you look at the overall structure for the last 8 weeks, the stock was consolidating within the narrow range. But if you look at the placement of its weekly RSI, it has given a positive crossover, and the way the options data is placed, it is indicating that the floor is very well set at 3,900. It is getting elevated, and we may see the stock, eventually swinging towards 4,040 levels, and that's why we are recommending building long positions here, keeping a stop loss somewhere close to around 3860 on a closing basis. Eventually, we may see the stock swinging towards 4,040 levels. The second stock on our radar is Maruti. Now, last week we saw it building a very strong base around that 12,500, 12,450 mark. We have already seen a good rally towards 12,800. But the way the data is still shaping up on the weekly scale, we have a diamond pattern formation, and the confirmation of the same has been set right now. So we are looking at an elevated move towards 13,300 eventually. From a trading perspective, we may see a swing towards 13,060, and that's why we are still recommending building long positions here, keeping a stop loss somewhere close to around 12,660 on a closing basis.
All right, take that point. Thank you, Sachi, for joining us and giving us your thoughts on individual stocks once again, and also talking about your view on the indices, some consolidation. Take a short break, come back on the other side. We'll get you our excerpts from our exclusive conversation with JP Morgan Chase's Jamie Dimon. Stay tuned.
Welcome back. Well, veteran banker and JP Morgan Chase's global CEO Jamie Dimon has said that India is doing a lot of right things and has shown optimism about growth prospects. Speaking to Prashant Nair, he said that there is a lot of scope for interest rates to go down in the US, but he also remains worried about the geopolitical tensions. Listen in.
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation look at it and say we can't rely on someone who might one day be an adversary. That doesn't make them an adversary today for supply. Just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, it's just starting. It would take years. There's semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. huge opportunity for China. I mean, for India, a huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got U.S. elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that? I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one, so that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, the stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
So my caution is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply. God knows other countries getting involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest caution. The economy fluctuates. I don't worry that much about the fluctuation of the economy. And obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy, but we are spending a lot of money. And in my view, that spending the money causes growth. It also causes inflation, and whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm putting me on the cautious side of that one.
Right. I mean, rising interest rates did not hurt markets. Will falling interest rates be an impetus? I mean, can they be a further impetus?
Yeah. Again, so when you talk about rising, things are, sometimes history rhymes, but it's not always the same. I think when rates went from 0 to 2.5, that was barely rising rates. That's just kind of normalization. And we had very strong growth coming out of COVID. So, 5% was probably needed to slow things down just a little bit. Yeah. Underneath the rate, there's a real economy. No one knows what that real economy is going to do next year. No one. And so I don't look at it like, they're panicking to, maybe the economy gets stronger, maybe it's going to get weaker. And so they're trying to remember they're reacting to data they see today. And then you can try to predict what the data is going to be a year from now. I think there's more underlying inflation because of things like the green economy, fiscal spending, remilitarization of the world, demographics. Those things will drive inflation down the road. And even AI, in my view, right now it's a little inflationary because we're all adding a lot of talent around data. It's not the deflationary part may happen, but that may be several years down the road. Yeah.
Right. You are, when you say you are a bit more skeptical, is that the economy you're skeptical about, or markets and what they're pricing in?
Both.
Both.
I think the stock markets and the bond markets are pricing in a soft landing. Okay. But you also look at the stock markets are generally very high, and bond spreads are very low. And that's kind of Goldilocks, and that may very well happen. I mean, I'm hoping for that. I just give it a lower odds than the market does.
Of that happening?
Yeah.
ड्रोन शॉट इनिशिएटिव के तहत $7.5 मिलियन के सैपलिंग किट्स, डिटेक्शन किट्स और वैक्सीन का सहयोग देने की घोषणा करता है। रेडियोथेरेपी ट्रीटमेंट और कैपेसिटी बिल्डिंग में भी भारत सहयोग देगा।
Proud to announce that the Quad Cancer Moonshot is what we're talking about. Our goal is to team up and cancer around the world, and starting with cervical cancer. I know it may sound unrealistic.
Welcome back. There is no major movement in the frontline indices. In fact, it's absolutely flat as can be. Though we are seeing some traction in a lot of these stocks from the broader markets itself. So a bunch of them actually at the high point of trade. We would see, Tata Steel doing fairly well. It's moved to the higher end of today's trading range so far. In fact, it's up closer to 4%, closing in on that 160 mark. Also, we have UPL, which is seeing some traction. Off the lows, it's recovered about 3% moving higher. M&M is the other one from the frontline indices, which is seeing some up move as well. But one of the stocks on our radar is GMR Power, because a brokerage has initiated coverage with a buy call on the stock. What is the target price? What is the rationale? What is the brokerage? Vivek joins in with all those details. The stock locked in a 5% upper circuit. Vivek.
Well, that's right. Very interesting note. Today, MK has initiated coverage on GMR Power and Urban Infra. They have a buy rating on the stock, and they have a target price of close to 180 rupees a share, indicating significant upside. What they're saying is that the core thermal assets of the company currently are doing quite well. They have almost 1650 megawatt of thermal assets, and it's near optimal performance as per MK. Along with that, they believe that the key triggers going forward are: number one, coal tabs for the thermal power plant. The company already has PPAs to the tune of almost 90% of its installed capacity, and also debt, which was earlier concerned as far as the entire GMR group is concerned, is now improving significantly. Remember also, the company has a hydropower asset that is 180 megawatt Bajoli Holy hydropower asset. They believe that too has largely stabilized. Along with that, thermal power, hydropower, and along with that, there's also the smart metering aspect. The company has almost 7.5 million smart metering installation contract, and that has a significant opportunity as per MK. This opportunity is with Bosch. Also remember, the company, MK sales, the company now has a clear focus on deleveraging on the back of strong operating cash flows. Deleveraging has been led, number one, by the conversion of FCCBs into equity, and also the handover of the road asset that was earlier a drag. Now, along with that, what they're saying is that they expect the company's consolidated net debt to drop by almost 4,000 crore to 9,000 crore in FY25 itself. On the back of that, they see significant upside potential led by incremental smart meter contracts, monetization, and also settlement of various disputes, which they believe can provide sizable optional value. On the back of that, GMR Power and Infra, remember the stock has already done very well, but the MK sees further upside even from current levels.
Okay, all right, Vivek, thanks very much for that. So that's on GMR. But I'm looking at AstraZeneca today. That stock is really active on the upside. The stock is up around 10 to 11 odd %. Now, the news with regards to them is that they have got the CDSCO nod to sell and distribute Imfinzi, which is basically a cancer drug, which they are already selling for non-small cell and small cell lung cancer in India. But now they've got an additional indication approval from the government to sell this drug for another additional indication in cancer. Now, currently, they are the 6th largest oncology brand in the country, this particular drug is, and they've said that it's demonstrated robust growth across lung indications in FY24. The value of the drug in FY24 was around 200 odd crores. Now, AstraZeneca has also said that the oncology business as a whole forms around 62% of their sales in India. They also have other very important drugs in their portfolio. So, for example, Tagrisso is used for indications in oncology, and it did around 320 crores in terms of sales in FY24. They've launched Inheritu, which is also a cancer drug. It's used to treat breast cancer in Jan 2024, and it was in fact given breakthrough designation by the US FDA. Other triggers for AstraZeneca include that they've partnered with Mankind Pharma to expand their access for asthma patients in India. They've forayed into the rare diseases segment. They're looking to exit their manufacturing site in Bengaluru in due course. The company says that they will strive towards their ambition of being a lead specialist in certain disease areas in FY25. If you look at it, FY24 revenue was up around 29%. EPS was up around 63% for AstraZeneca.
All right, so that's about AstraZeneca doing extremely well in today's trading session, a big jump in the EPS as well. And we are seeing a bunch of traction in a lot of the other cash stocks as well as they move higher. Ticker team alerting you about that. Take a short break, come back, focus on the commodity space. Manisha Gupta joins in, and with her today would be Peter Maguire, who's the CEO of XM Australia, on all things commodities.
Announced that our four countries, the leaders behind me, and many organizations here today are committing over $150 million for HPV screening and therapeutics.
Well, you know, a big basket consumer today, right, ordered an iPhone 16 at 8 a.m. on Big Basket, and it got delivered by 8:07. This same consumer last year would have had to wait a day if she had ordered it on Amazon or Flipkart. And this, you know, is the perfect example of how lines are blurring between e-commerce and quick commerce. Now, let's see how each of them stacks up. Now, the biggest advantage that quick commerce obviously has is how quick it is. And that consumer behavior is changing, and the consumer now wants everything in 10 minutes. But e-commerce players currently only offer same-day delivery, and that also in just select cities. But it's their presence that is unmatched. Currently, they service nearly 100% of India's PIN codes, while quick commerce has now only just started, sort of expanding into Tier 2 and Tier 3 markets. And Zepto, Blinkit and the likes have been expanding their product range into appliances, into toys, into cosmetics and more. But e-commerce players have a much wider product assortment, and they offer much higher discounts, and they're also much better equipped to deliver big goods like a TV or a refrigerator to you. But the way quick commerce apps have been ramping up is definitely giving jitters to e-commerce players. Now see, Flipkart for instance, right? It is already testing the model with minutes.
Welcome back, and joining us on the show now is Peter McQuay. He's CEO at XM Australia. Peter, hi. Another new day and another new all-time high for gold prices at $26.35 an ounce now. Where do you see prices going forward from here?
I've got to laugh because it just seems onward and upward. We've been following this for a long time together, and at the start of the year, you know, you're running at that just over 2. This time last year you're at 1,800, and here you are at 26.30, 26.50. I mean, it's just got so much momentum. You've got to say, is 27 achievable by the end of the month? I think it probably is. You know, you've got 6 days to go, and it just seems to have tremendous momentum at the moment, and that may be coupled with what happened in China. So I think it's onward and upward, and yeah, 3,000 is probably the target by end of year. Everyone's got their hands saying that, so it's pretty hard to go against the grain, Manisha.
I know those are some numbers, and we continue to look at newer highs coming for gold. You talked about China, Peter, and well, yes, China has promised a lot in coming few days. They haven't given a timeline, but then they've talked about housing markets. We've seen reverse repo for 7 days and 14 days also already being worked upon. What's your sense on how much, where, when China would do? We have, of course, seen the metal prices already react to this.
Exactly. I mean, you know, when you look at the likes of tin, aluminium, nickel, you know, of course, copper, they've all had a nice rally to the upside, and they're fairly strong at the moment when you're thinking where they have been, and, you know, that move to the upside, you've got, you know, the best part of 95.50 for copper. As far as a timeline, Manisha, are they a couple of things? Is it going to stimulate, and it was a pretty aggressive move as far as the interpretation from the property sector. Secondly, it's got to be, you know, you've got to look at a fiscal side as well. Thirdly, it is a fairly big bazooka. And it's from a timeline, when is it going to be introduced? I'm sure it'll be, but they've got to get it moving. And are they still going to hit their 5% target by end of year as far as growth numbers? You got the CSI today was up the best part of 4.1, and it's still got probably a little bit of movement left. Shanghai's up 4.1 as well. CSI 300, 4.3%, and HS China Enterprise ENT up nearly 5%, Manisha. So it's been interpreted well from China's, equity market.
Oh, well, absolutely. The underlying commodity and the equity markets all surging up today with what China can do perhaps going forward. Peter, if you had to make a portfolio today, what would you buy in? Gold, as you said, is going to be quite bullish between silver and all of these base metal prices. Where do you see more momentum coming in?
You can't move away from silver and gold, Manisha. I think that's where the focus has got to be. You've got a US dollar index sitting just on 101. It's about 100.99 for US dollar index. And if they drop at 50 basis points on the 7th of November, then that's going to, I think, take a little bit more steam out of that US dollar. And that's what everyone's suggesting may happen, because there's no cut in October. So you've only got November and December, and they want to get 125 basis points. So somewhere you've got to have a 50. So if you hit another 50, that could really crush that US dollar further to as far as softness. And that's going to be, I think, the horsepower that's going to, another round of horsepower that's going to drive, I think, the attractiveness of gold. I just listened to previously what Jamie was saying, Jamie Dimon, and, you're talking geopolitically as well as far as military and what's happening with US ships in the Red Sea and around that area. So there could be geopolitical tensions again going to drive that further forward, Manisha.
So within metals, then, Peter, whether it's going to be copper, aluminum, zinc, tin, iron ore, where are you putting your money in?
Well, iron ore's been a real flat one, and maybe that's going to bounce because it's probably been oversold, so you can't take your eyes off that. We've got to see how it washes across naturally to a $5.3 trillion property market, Manisha. So if iron ore's possibly a bounce, and, we're going to see 10,000 for copper. You're at $450 away. It seems to have, again, aggressive momentum to the upside. So this could be just the I suppose, the stimulus required to really kickstart some of those metals along. I think, one in, all in. It's pretty hard to go against, you can't be too, project management around this and just try and pick one or two. I think that's going to, the rising tide's going to lift all boats.
Oh, well, absolutely. If China comes up with what it's promising, then it's all money in for metals. We get that point there, Peter. Thank you, as always, for joining in and talking all things that is metals. But with that, it's a wrap on Halftime Report. Business Crunch will take all the action ahead.
Ramping up its fulfillment centers. Myntra, on the other hand, is already testing 4-hour deliveries. Amazon is also looking at a foray, and at the same time is also ramping up its storage capacity for faster deliveries. Nykaa, for instance, is also making its faster deliveries, which is same day and next day deliveries, available in 110 cities. And now experts say that, down the line, it's not like one will eat the other up. Both will coexist, where impulse buying will go to quick commerce and planned purchases will continue to stay on e-commerce platforms. But yes, e-commerce players are likely to work on reducing their delivery times to as fast as 30 to 45 minutes. And this festive season, we're likely to see this battle playing out. informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving up.
Stock swing between gains and losses amidst fresh record highs for the Nifty. Economic and geopolitical uncertainties as well. Metals and utilities lead the gains while realty and IT stocks are the big drags.
Metals perk up after China's central bank chief Pan points to a 50 basis point cut in reserve ratio and a cut in interest rates. He also promises lower rates for mortgages, even as reports suggest a recapitalization of banks is likely.
MobiKwik gets SEBI's approval for a 700 crore rupee IPO, while NTPC Green Energy readies for a likely November offer. Meanwhile, 2 of 3 IPO listings today, Northern Arc and Arcade Developers, deliver hefty gains.
A SEBI study from FY 2022 to 2024 reveals that 9 out of 10 individual F&O traders lost money, with their cumulative losses amounting to 1.8 lakh crore rupees during the period. Algo firms cornered, most of the F&O trading profits.
And a day after its airstrikes killed nearly 500 in Lebanon, Israel launches a fresh wave of overnight attacks on Hezbollah in southern Lebanon, as Prime Minister Benjamin Netanyahu says he's looking to change the security balance along Israel's northern border.
Hello, good afternoon. You're watching Business Lunch. I'm Vinny Motiwala. With me is Hormaz Patakia as well, as always. Hormaz, a very good afternoon to you, and not a bad afternoon chopping up, right? We've seen a lot of gains coming in the last few trading sessions. So today also Nifty managing to hold on to at least some bit of a gain. There's some bit of a positive sign today.
It's a so close yet so far sort of a scenario, right, for the benchmark index. Every time it is nearing a landmark, it always does this. And the Nifty made a high of 25,980 this morning. Then it sold off, and then now is recovering from the lows of the day again as we move closer to the second half of the trading session, the final last couple of hours coming up, and it's the financial services expiry, so it'll be the Nifty Bank that will be the index to watch out for this afternoon. Remember, the Nifty Bank has been gaining for 8 days in a row now, and in this 8 days the index has surged over 3,000 points. So some bit of consolidation on the Nifty Bank, that too has recovered from the lows of the day, but this will be the index to watch out for. And if the Nifty Bank moves higher towards the final minutes of the trading session, that might well push the Nifty towards those 26,000 levels as well. The broader markets continue to do okay, but there are specific stocks that were, one particular one that I would want to highlight though is IEX, and that stock is now locked in a lower circuit of 10% as we speak. So a sharp fall coming in for IEX. So plenty of stock specific activity. There are many on the gaining side and on the losing side as well. What are you spotting, Winnie?
Absolutely, a lot on the gaining side, a lot on the losing side. I want to first highlight some of the pharma names also. Let's look at AstraZeneca. That's holding on to very strong gains. So today we're keeping an eye out on that one. We had some reports also coming in for a drug approval. So the AstraZeneca surely holding on to gains of 11%. Ipca Labs, that's another one from the pharma side holding on to gains, and this was after a brokerage report. We have the metal pack that's shining in trade trade as well. So let's pull up something like Nalco that's holding out a strong gains of around 5-6% of trade. We had GSW Steel, we had Jindal, JSPL that's also managing to hold on to gains. So yes, metals surely shining. We had Senco that's holding on to gains after we saw ICICI Prudential Life actually buy some shares in a block deal, and Onam India was one of the funds which actually sold their stake. So yes, Oman India, I beg your pardon. So keeping an eye out on the markets, Hormaz, surely an interesting one. Today we've seen the small cap actually is something that has been a bit subdued in trade. But moving on to a CNBC-TV18 exclusive, we did have JP Morgan Global CEO Jamie Dimon, who said that India is doing a lot of right things and has shown optimism about the growth prospects. What more did he have to say? Listen in.
America was overly reliant. That's not being angry at them. You should ask why we didn't do it before. But in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals. The second one is around disagreements around policy, like, you know, if countries are aiding and abetting industries to dominate a global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, you know, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. The semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc. Prime Minister, that odd par program, I think I'm saying that right, the change in the GST, the tax system among the states, national infrastructure, your schools graduating a lot of extremely bright, talented people. Those are the things to do. Reduce regulations. You know, here, you know, regulation and bureaucracy does cripple foreign direct investment. So make it easier for foreign direct investment to come here. And then you have to do industry by industry. But I do think you should be attracting it. It'll help you grow much faster.
And of course, you can catch the entire show, as you just mentioned, in later this evening at 5:30 p.m. on CNBC TV18. But shifting focus now to today's listings. Now, logistics player Western Carriers made a subdued start to its trading history on the bourses. Now, the Mumbai-based realty player Arcade Developers saw a strong listing, with listing at over a 35% premium to its issue price, while Northern Arc Capital listed with gains of over 30%. Now, both Western Carriers and Western Carriers now is now 5% below its IPO price, but Arcade Developers is holding on to gains of around 35% as we speak, and Northern Arc too is now trading with gains of almost 20% from its issue price.
Absolutely. This is what we'll be adding to our list also, to keep an eye out on where they move after all this IPO listing gains that we normally see coming in. But let's move on and shift focus to some upcoming public issues. Now, NTPC Green Energy, the renewable energy arm of NTPC, is expected to launch its IPO in the first week of November this year. Abhimanyu is joining in with us to give us more updates on that. Abhimanyu?
NTPC is targeting 60 gigawatts of renewable energy capacity by 2032, and as part of these plans itself, its fully owned subsidiary NTPC Green Energy a few days back had filed a DRHP with SEBI and is already in process of going the IPO route to raise more funds. The company is also in process of going for road shows across India and several other places in the world. As per sources, the IPO is likely in the first week of November, and the company has already begun its road shows. It's expected to do these road shows in Mumbai, in India, and in several other places across the world, including the US, the UK, and Singapore. It remains to be seen which other places the company is going for as far as road shows are concerned, and what is the degree of investment it is aiming to target. And based on that itself, its future plans, of course, would unfold, and the establishing of the targeted capacity would, of course, happen only on the basis of the investment it would be able to secure based on funds from India and abroad.
Now, continuing with this IPO rush, now SEBI has cleared MobiKwik's IPO proposal. The payment platform got the SEBI go-ahead in October of 2021 as well, but refiled its papers in January this year. MobiKwik plans to raise around 700 crore rupees, which is close to 1/3 of what they had planned during their first attempt at listing on the bourses. Ritu is joining in with more details on that. Ritu, take it away.
It's been over 3 years in the making, and now finally MobiKwik has received SEBI's approval for its 700 crore rupee IPO. The offering, with a face value of 2 rupees per share, is going to be an entirely fresh issue of equity shares with no offer for sale component. Now remember, MobiKwik had initially filed for IPO in July of 2021, but those plans were shelved because of unfavorable market conditions following Paytm's IPO in November of that year, and thereafter the company refiled its papers in January this year, scaling down its IPO size massively by 63% from about 1900 crores to 700 crore rupees now. Now, according to the DRHP, MobiKwik may also consider a pre-IPO placement of shares worth about 140 crores, which could reduce the fresh issue size accordingly. Key shareholders in the company, they include Bajaj Finance, Peak XV, Abu Dhabi Investment Authority and others. Now, as for the IPO proceeds, MobiKwik plans to allocate 250 crores to expand its financial services distribution business, which currently contributes 64% to its revenues. 135 crores will go towards funding its payment services, which accounts for 36% of the revenues. Another 135 crores is earmarked for investments in technology and 70 crores for its payment device business, and the remainder has been set aside for general corporate purposes. Now, MobiKwik, if you recall, only recently turned profitable for the year FY24, that is 15 years after its inception, reporting a 14 crore profit and 875 crores of revenue from operations for the year. And as of September last year, they had a registered user base of about 147 million and a merchant base of 3.81 million.
Thanks so much for that, Ritu. But on that note, we're going to slip into a very short break. But after the break, we'll put focus on the findings from the SEBI study, which reflects the struggles of retail traders are going through in the F&O segment. So stay tuned in.
To global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
US has been trying to reduce its dependence on China.
Welcome back. You're watching Business Lunch on CNBC TV18. And like we mentioned, SEBI has done a very interesting study which has revealed some insights into the performance of retail traders in the F&O segment. Hormaz has moved to the wall and he's going to tell us all those details of what's happening there. What are the details there for the retail investors and retail F&O traders?
They say that the proof lies in the pudding, but this SEBI study is neither the proof nor the pudding that many F&O traders would want to see, read or hear. Now, 1.8 lakh crore rupees. Now, that is the cumulative loss made by individual traders within the F&O segment between FY22 and FY24. That's the big number from this latest SEBI study. Now, a study that the market regulator released last year said that 89% F&O traders lose money. Now, that number remains where it is, as 9 out of 10 individual traders in the F&O segment continue to incur quote-unquote significant losses. Now, let's tell you more about those significant losses. Including transaction cost, the average loss of over 93% or over 1 crore individual traders stood at 2 lakh rupees each. If that is not enough, the top loss-making traders raised the bar higher. The top 3.5 loss-making traders averaged a loss of 28 lakh rupees per person, of course, including transaction costs. Again, all of these figures between FY22 and FY24. So does anybody make a profit? Absolutely. A staggering 1% of the traders in the F&O segment made a profit over the last 3 financial years. And if there ever was a gulf between domestic and foreign traders, the upcoming graphic will show you that. Proprietary traders made a profit of 33,000 crores in FY24 before adjusting for transaction costs. FPIs made a profit of 28,000 crore, and putting these two numbers together, the individual traders made a loss of over 61,000 crore rupees in FY24. So how did these traders manage the profit? Now, most of these are generated by larger entities using algorithms. 96% of proprietary profits and 97% of FPI profits are generated through these algorithms, according to the SEBI study. Now, if you wondered that the SEBI study from last year would act as any deterrent to youngsters from venturing into this unknown territory, that has definitely not been the case. The number of traders below the age of 30 within this segment has now risen to 43% from 31% in FY23, and 72% of the total trader base is beyond the top 30 cities of the country. Shows you the extent of the F&O penetration in India. Now, if there would be a study that proves F&O penetration being faster than insurance, don't be surprised. We spoke to you about the losses that individual traders made that ran into lakhs of rupees. 75% of those traders had an annual income of less than 5 lakh rupees. And I'll end with possibly what is the highlight of this report, and nothing better can describe this than a famous Hindi film dialogue, and I quote, "रोज आते हैं इस उम्मीद में, आज जीतेंगे, कल जीतेंगे, परसों जीतेंगे और रोज हारते हैं." Now, why do I say so? Because despite making losses for years, 75% of these F&O traders continue to trade as per this SEBI study. So there you have it. Foreign algo trades making money in F&O while the individual retail investor continues to struggle. Of course, what people do with their money is an individual choice, but these stats would definitely set alarm bells ringing for sure.
Thank you so much for that, Hormaz. But let's move on. And quick commerce, it's the latest buzzword in the world of retail. A meteoric rise of apps like Blinkit, Zepto, Instamart has sparked immense interest in this space. In the first part of the series, Think It, Buy It, CNBC TV18 Shilpa Ranipeta has reported that while the rapid growth has taken many, including investors, by surprise, scalability remains a key challenge. Listen in.
Indian consumers are impatient. They want everything from groceries to personal care products to home appliances in their hands as soon as possible, and they want to shop without leaving the comfort of their homes. It's this love for instant deliveries and couch shopping that has fueled the meteoric growth of the quick commerce industry in India. In FY24, Blinkit clocked 20.3 crore orders. Armed with 526 dark stores or product depots, it saw gross order values growing 93% to 12,496 crore rupees. Swiggy Instamart with its 600 dark stores clocked 17.6 crore orders, with GOV growing 58% to 8,100 crore rupees. Zepto, meanwhile, is quickly playing catch-up. Sales crossed 5,000 crore rupees in FY24, and the company plans to scale its dark store count to 700 by 2025. Elara Securities estimates the industry is currently worth $3.5 to $4 billion and is slated to grow at 25 to 30% over the next 5 years, at least 5 times faster than e-commerce.
I think it has taken a lot of people by surprise, including me. I think the promise has been kept by the players. When the GMV rates are very, very good, the brands are supporting the quick commerce players simply because they now see customers. Investors obviously have believed in the potential of quick commerce in India. And once they've seen very good traction and very good execution by the founders and the team, they have not stopped shy of pouring more money.
No surprise then that incumbent e-grocers like Big Basket, who once viewed unit economics of Q-commerce unviable, have changed their mind. Even e-commerce players like Flipkart, Amazon and India's largest retailer Reliance Retail now want a piece of this pie. Experts say the growth prospects endorse this interest, but add that growing average order value and scalability of operations will be key.
If you have an average order value of 500 to 550, and if you do roughly around 2,000 orders per day, a quick commerce dark store would largely be at a break-even point. So that is the math there. And I think definitely the business is quite sustainable, because I think if you look at some of the mature stores, I think they are already making healthy EBITDA margins. And if 2,000 orders, if they are doing a break-even on that point of time, if these orders are maybe 4,000, 5,000, then definitely you'll get healthy EBITDA margins as well.
For consumers, the big draw is not just ordering from the comfort of their homes, but that Q-commerce platforms have been consistently adding to the range of products available under one app. Experts agree that it is this strategy, along with entry into new markets, that will ultimately drive business growth.
We launched Nasik last month. Right, Nasik is not known to be like anywhere close to a metro in terms of a market.
Yeah.
The stores that we launched there have hit 1,000 orders per day in 6 weeks. It's the fastest that we've ever been able to achieve that. When we go into these tier 2, tier 3 markets, customers come and tell us that, hey, I actually couldn't find this selection anywhere else, right? Or I couldn't find this quality control anywhere else. And so we think we have an even stronger value prop in those markets.
One of the things that the quick commerce business needs because of the slightly lower average order values is basically high density, right? And that's what we need to do. And so as you go to smaller towns, it gets thinner, and that can impact profitability. So we'll be careful in terms of choosing towns.
But as more players enter the fray, a shakeout is inevitable.
Consumers may be spoiled for choice, value and service as more players enter the market. Experts say 5 years down the line, there may not be space for all of them. This will lead to the less nimble and those struggling to achieve scale quickly cracking under pressure. Experts say this will lead to a spate of consolidation that could leave with the quick commerce market with just 3 to 5 players. In Mumbai, Shilpa Ranipeta.
Well, if there are IPOs in the maniac segment, there is a quick commerce mania as well that's going on. But time for a short break. Up next, we get to the latest as Israel launches a fresh wave of attacks in Lebanon. Stay tuned, back on the other side.
India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation will look at it and say we can't rely on someone who might one day be an adversary, that doesn't make them an adversary today, for supply. Just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like if countries are aiding and abetting industries to dominate a global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. The semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got U.S. elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that. I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one. So that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
They say that the proof lies in the pudding, but this SEBI study is neither the proof nor the pudding that many F&O traders would want to see, read or hear. Now, 1.8 lakh crore rupees. Now, that is the cumulative loss made by individual traders within the F&O segment between FY22 and FY24. That's the big number from this latest SEBI study. Now, a study that the market regulator released last year said that 89% F&O traders lose money. Now, that number remains where it is, as 9 out of 10 individual traders in the F&O segment continue to incur quote-unquote significant losses. Now, let's tell you more about those significant losses. Including transaction cost, the average loss of over 93% or over 1 crore individual traders stood at 2 lakh rupees each. Welcome back. Shifting focus now to the war updates in West Asia. Israel has expanded its aerial attacks into Lebanon, killing close to 500 people and injuring thousands in what appears to be the start of a broader military campaign. NBC's Richard Engel gets us more on this.
Israel is expanding its war in Lebanon, and the target is Hezbollah. The Iranian-backed militia has been carrying out attacks against northern Israel in solidarity with Hamas after October 7th. But Hezbollah has tens of thousands of rockets, drones and missiles, and Israel has begun to take them out in the hundreds. Israel saying many weapons are stored inside homes, warning civilians to evacuate.
I have a message for the people of Lebanon. Israel's war is not with you. It's with Hezbollah. To defend our people against Hezbollah strikes, we must take out those weapons.
Lebanon's health ministry said around 500 people were killed by Israeli strikes, including children. NBC's Matt Bradley is there.
This hospital is already taking in injuries. There's been waiting for this for the better part of a year. And now they're expecting hundreds of trauma cases from all over the country.
Israel is far better prepared. The director of Israel's biggest hospital in Haifa showed me how every patient is being moved to a fortified hospital underground.
You're using it for real, for the first time.
It's unfortunate. This is not a healing environment. On the other hand, this allows us to continue to give medical care.
Hezbollah suffered a major blow last week when thousands of its members' pagers and walkie-talkies exploded. Israel has hinted at it, but not claimed responsibility. Nonetheless, the group is still able to fire.
A Hezbollah rocket hit these homes, causing extensive damage, and now Israel is bracing for an escalation, ordering all schools across northern Israel closed and declaring this entire area a no-fly zone.
A new front has opened between Israel and Hezbollah. It may be very difficult to close.
And as we wrap this edition of Business Lunch, industrialist Ratan Tata was honoured as one of the goalkeeper champions by the Bill and Melinda Gates Foundation for his contribution to help achieve global goals of nutrition by the year 2030. Ratan Tata has helmed many innovative and successful initiatives that have significantly improved public health in India.
Not enough, the top loss-making traders raised the bar higher. The top 3.5 loss-making traders averaged a loss of 28 lakh rupees per person, of course including transaction costs. Again, all of these figures between FY22 and FY24. So does anybody make a profit? Absolutely. A staggering 1% of the traders in the F&O segment made a profit over the last 3 financial years. And if there ever was a gulf between domestic and foreign traders, the upcoming graphic will show you that. Proprietary traders made a profit of 33,000 crores in FY24 before adjusting for transaction costs. FPIs made a profit of 28,000 crore, and putting these two numbers together, the individual traders made a loss of over 61,000 crore rupees in FY24. So how did these traders manage the profit? Now most of these are generated by larger entities using algorithms. 96% of proprietary profits and 97% of FPI profits are generated through these algorithms according to the SEBI study. Now if you wondered that the SEBI study from last year would act as any deterrent to youngsters from venturing into this unknown territory, that has definitely not been the case. The number of traders below the age of 30 within this segment has now risen to 43% from 31% in FY23, and 72% of the total trader base is beyond the top 30 cities of the country. Shows you the extent of the F&O penetration in India. Now if there would be a study that proves F&O penetration being faster than insurance, don't be surprised. We spoke to you about the losses that individual traders made that ran into lakhs of rupees. 75% of those traders had an annual income of less than 5 lakh rupees. And I'll end with possibly what is the highlight of this report, and nothing better can describe this than a famous Hindi film dialogue, and I quote, "रोज आते हैं इस उम्मीद में, आज जीतेंगे, कल जीतेंगे, परसों जीतेंगे और रोज हारते हैं." Now why do I say so? Because despite making losses for years, 75% of these F&O traders continue to trade as per this SEBI study. So there you have it, foreign algo trades making money in F&O while the individual retail investor continues to struggle. Of course, what people do with their money is an individual choice, but these stats would definitely set alarm bells ringing for sure.
Good afternoon, welcome to Midcap Radar. I'm Sonal Bhutra. With me as always is Vivek Iyer. It's a choppy day in trade. We are 17 points higher on the Nifty. We've seen a lot of fluctuations today. The mid-caps continue to do higher. But you know, after the handover that we got from Wall Street, the indication was maybe we could continue, be at the 26,000 mark. But the markets are like, wait for a bit.
That's right. So, you know, the wait for 26,000 on your screens is just getting a little delayed. Given the fact that we actually seen a very strong handover as far as Asian markets are concerned, Indian markets today seem to be relatively underperforming, especially the broader end of the indices. But quite a lot lined up on the show. Let's start off with the top headlines. Market recovers from the day's lowest point, but trade in a range. Nifty hurls firm about 25,900, led by metal stocks. Midcap index also hovers near the 60,800 mark.
Metals perk up after China's central bank chief Pan Gongsheng points to a 50 basis points cut in reserve ratio and a cut in interest rates. Also promises lower rates for mortgages, even as reports suggest a recapitalization of banks is likely.
SH Kelkar fires up in trade with gains of over 12% as Kotak Institutional Equities reinitiates coverage on the stock with a buy rating. The brokerage sees a long runway for growth for the company.
GMR Power and Urban Infra gains in trade. MK turns bullish and initiates coverage with a buy call. The brokerage believes that the company's coal thermal assets are nearing optimal performance.
AstraZeneca Pharma surges more than 10% after the company receives the CDSCO nod to sell and distribute Imfinzi, a drug used to treat a type of cancer. Well, good afternoon and welcome to Midcap Radar. While we are looking at the markets currently, like we just mentioned, like you just mentioned, Sunil, it's been quite a choppy session of trade. Quite a few stocks on the radar in terms of, seeing significant upside as well as downside. The metal pack today is doing very well. Look at names like SAIL, Tata Steel, JSW Steel. All of these stocks actually doing quite well. On the other hand, amongst the broader markets, IEX is one stock that's seen quite a bit of selling pressure. But a whole host of stocks is what Hormaz has on his list today. He's standing by the wall. Hormaz, which are the list of top movers in the broader end of the markets?
Well, it's more on the downside than on the upside, even though the mid-cap index is still holding on above the flat line. But IEX, as the stock that you mentioned, is the top loser within the broader market space. We just had a block deal a few minutes back that took place in the stock as well. 10% lower now, at one point was down almost 11.5% is IEX. PB Fintech is seeing some bit of profit booking after a one-way move over the last 1 month, 5% down there as well, and some bit of selling pressure coming in for mid-cap IT names as well, like KPIT and Zensar. But metals are the stocks that are doing well today after the stimulus measures promised by China, with almost all the stocks within the Nifty Metal Index seeing healthy gains of anywhere between 3.5% to almost 6%. Some brokerage commentary came in on a lot of these names earlier this morning, and SH Kelkar was one of them, 15% higher now at the highest point of the day. GMR Power also with the MK note locked in a 5% upper circuit, and Ipca Labs off the highs of the day but holding on to gains of 2%. And lastly, stocks that are doing well on the back of very strong volumes, and AstraZeneca, as you just highlighted, 12% higher on strong volumes. Sapphire Foods after the block deal. First Source Solutions having a good day today, as is Godavari Power and Ispat, 7% higher on very strong volumes, in line with the surge in the metals pack. Back to you guys.
Okay, all right. Thank you so much, Hormaz. There's some interesting names out there. The advance decline ratio is absolutely flat. We have equal number of advances for the number of declines that we're seeing in the broader space. It's a good time to welcome Shrikant Chauhan, EVP Kotak Securities, for a technical check on the market. Shrikant, good afternoon. What are the trends suggesting right now? Do we see an up move in the last 1 hour of trade? We do have the financials expiry as well today.
Yeah, good afternoon, Sonal. Good afternoon, Vivek. Well, for Nifty, I think it is very clearly heading higher. Whenever there is a correction, we are seeing buying interest, and most of the time, whenever there is a recovery, we see buying interest in large cap and mid cap companies, which are like part of index. So broadly, I am of the view that the markets are heading for the next levels of 26,200, and 25,800 is now going to act as major support for the market. So that should be the final stop loss on a closing basis for creating any long positions. For Bank Nifty, I think there also we are seeing upside, and 54,500, 54,600 should be the next level to watch out for, because the way it is consistently holding above the levels of 54,000 and 53,900, I think this particular Bank Nifty is also heading higher. I think most of these indices are very close to their about their important resistance level, and I think in next few 1 or 2 days of time, we are going to see further more rally in the market.
Good afternoon. So what are your top individual trades for the day?
Yeah, Vivek, I think metal stocks are really doing well, and most of these stocks have spent a lot of time, and most of these stocks have formed some consolidation, continuation, formation during their previous underperformance. So I'm of the view that Vedanta should be on the radar, because the stock has formed triangle formation after rallying a lot from the levels of 200 to almost 500. So now after this breakout, I'm expecting stock to move towards 500 or 520. So Vedanta is a buy at current levels around 469, 470 levels. We can keep stop loss around 454 for the target of 500, 520. And the other stock on which I'm bullish is CESC. Kolkata Electricity, which is currently trading around some 202, 205. There also I am seeing some breakout sort of formation and continuation formation. From current levels, the stock can move to the levels of 225 or 230. And also all these particular stocks from the same group, they are really doing well. So I think that momentum will also help the stock to do well. It's a buy around current levels with a stop loss close to 193.
All right. Okay. Thank you so much, Srikanth, for joining in with those technical bets. It's time to slip into a short break. When we come back, we'll connect with Murli Malayappan, the chairman and MD at Shriram Properties, to discuss the FY25 outlook and the long-term targets as well. Stay tuned.
आज भारत का 5G मार्केट, बताऊं, बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। आप हैरान होंगे, आज भारत का 5G मार्केट, बताऊं, बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। और ये 2 साल के भीतर भीतर हुआ है।
Welcome back. You're still tuned into Midcap Radar. Shriram Properties, that is the stock on our radar. The stock has surged more than 40% in the last 1 year. The company in its long-term targets aims to double its sales, triple its revenue and quadruple its profits over the next 3 years. To discuss how do they plan to achieve it and more, we have Murli Malayappan, the chairman and MD at Shriram Properties. Mr. Murli, good afternoon. Thank you so much for joining in. Well, you know, I wanted to understand the longer term targets is something that the street seemed to like as well. For now, I wanted to understand, since Q1 did see some weakness because of that Pune project approval that didn't come through, where are we in terms of approval there? Has Q2 been better than Q1? And are you on track for those 3 project launches that you had indicated earlier as well?
Yeah, absolutely on track with respect to the launches. 3 projects, out of which, 2 are in Bangalore, 1 in Chennai, all on track. And as we speak, 1 project already launched and received good success. The other 2 projects, EOI process over, and we should be able to get this done before 30th September. And project launch is on track. Pune project approval still lost mile pending, so it will not happen in Q2, but it is likely to happen in early Q3. So it is on track with respect to all the new projects. For the full year also, new projects is on track for launches. We have close to about 11 projects for the year. And for Q3 and Q4, the project launches are on track.
Okay, so the Pune project, you expect the approval to come by in Q3. What is the revenue potential here, the sales potential, and what would the execution timeline be on that project once approvals do come in?
It is over about 1,000 crore is the overall gross revenue of the project. And project timeline could be about 3 to 3.5 years time completion from the approval timelines.
Okay, Mr. Murli, talk to us about the AIF platform that you have currently with ASK. So what is the current status of that? What has been the commitment so far? And we also understand that there's an early closure over there. So can you give us a sense of what exactly is happening on that particular platform?
It's a 500 crore platform, out of which 2 investments have been done. One investment, they got an exit now recently. That is a project in Bangalore. It's a plotted development. The project has done phenomenally well. They just got an exit a couple of months ago. And another project in Chennai, which they have investment in that. They are also exploring, we are exploring together, we can do another 500 crore platform. We are exploring together on, again, investing into the core markets like Bangalore, Chennai and Pune.
Okay. So you are looking at the Kolkata market in a big way as well. That is something that you said in your outlook coming in for the next few years as well. You said Kolkata will remain a key contributor. So I wanted to understand what is the plan here? There is some monetization that you were planning here as well. How big would Kolkata be as a part of your overall pie in the future?
Kolkata, we have deliberately decided that we will not do any addition. The existing project has a potential of about 6 million square feet, out of which close to about 10 million square feet is already under construction now in various stages. The balance will get delivered in the next 6 to 7 years time. Apart from that, we have got quite a lot of land parcels with potential built-up area, which we'll look at monetizing. We'll hope to monetize this in the next 3 to 4 years time. And we are not adding any new project in Kolkata.
Okay. Mr. Murli, you've given a very strong guidance as far as, the next 3-year pipeline is concerned, double sales, triple revenues, quadruple profits. Now, when we talk about the next couple of years, how will the project mix going to look like? Will it largely be driven by affordable housing? You also have significant plans as far as the luxury segment is concerned. So how will the project mix change like, especially over the next couple of years, FY26 onwards? What will be the kind of launches that we can expect?
Currently, last 3 years time, what we have done is mid-market, it's about 67%. It is likely to go up to close to about 75 to 80% in mid-market segment. Next 2 years outlook will be completely mid-market. We have moved away consciously from affordable housing. We were a dominant player in affordable housing, but we have consciously moved away from affordable housing. Will be mid-market and mid-premium segment. That will be our focus. Close to about 80% will be in that category, some portion in luxury category, some portion in commercial, maybe a small portion in affordable. So that's where in the next 2 years time we are looking at now.
Okay. Mr. Murli, I was looking at the debt now. You have a platform with ASK around 500 crore rupees. The debt also is something which is used for the future capex that you have. 482 crore is the debt and it has been increasing. In March 2022, you had 341 crores of debt. What is the plan with debt reduction? What is the breakup of debt from NBFCs and banks? And what is the cost of debt right now?
As we speak, it is at 460 from 482. It has come down to 460 net debt. Net debt equity ratio is 0.37, is one of the lowest in the industry as we speak today. With respect to the overall debt reduction, as the projects getting completed, whatever the projects what make the debt is sitting there, all the debt is related to only working capital. There is no land acquisition which is happening through debt. Hence, as the project gets completed, this debt will come down. It will become, net debt will become zero of the projects which are getting completed. As we add up new projects, the new projects related debt will keep adding up. That's again restricted to only the construction finance. With respect to, sorry, go ahead.
No. So Mr. Murli, I wanted to understand that these new projects that are coming, the cash flows are enough to repay the debt, the cash flows that are expected from these. So what kind of cash flows are you expecting? Because that would be an important number for any investor.
Cash flows not only good enough to repay the debt, we are also likely to generate good enough healthy cash flows over 200 crores in the next 3 years' time. So over and above this debt repayment for the current projects.
Okay. Mr. Murli, thank you so much for joining us. Thank you so much for answering all of our questions quite patiently. We'll have you once again, once you deliver your Q2 results, and also we await you launching the Pune project soon. Let's now slip into a short break. Up next, we will focus on SH Kelkar in our Midcap Spotlight segment. Stay tuned.
अब तो भारत मेड इन इंडिया 6G पर काम कर रहा है। ये कैसे हुआ? ये इसलिए हुआ क्योंकि हमने इस सेक्टर को आगे बढ़ाने के लिए पॉलिसीज बनाई। हमने मेड इन इंडिया टेक्नोलॉजी पर काम किया। हमने सस्ते डेटा पर मोबाइल फोन मैन्युफैक्चरिंग पर फोकस किया। आज दुनिया का करीब करीब हर बड़ा मोबाइल ब्रांड मेड इन इंडिया है। आज भारत दुनिया का दूसरा सबसे बड़ा मोबाइल मैन्युफैक्चरर है। एक जमाना था मेरे आने से पहले जब हम मोबाइल इंपोर्टर थे, आज हम मोबाइल एक्सपोर्टर बन गए हैं। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। ये तीसरे टर्म में हमें बहुत बड़े लक्ष्य साधने हैं। हमें 3 गुना ताकत और 3 गुना गति के साथ आगे बढ़ना है। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है।
Welcome back. You're still tuned into Midcap Radar on CNBC-TV18. This is our special Midcap Spotlight segment, and the stock that we are tracking today is SH Kelkar. It's a strong move that we are seeing on the stock today. That's because Kotak Institutional Equities has reinitiated coverage on the stock. They have a buy rating with a fair value target of around 400 rupees a share. They see a long runway for growth given its established and sticky relationships in the growing Indian market. Now remember, it's a fragrance player, and that is where they have been growing even in Europe, Southeast Asia and US. So the export market also continues to be very large for them. There's a high entry barrier that we see in this industry, and this is something which makes it an attractive player in this particular industry. They see potential for margin expansion because of number of reasons: growth in high margin geographies like Europe, there's operating leverage, as well as strong cash flows that the company has seen because it's a asset light model. In terms of growth, for the next 3 years, they're expecting 12% revenue growth, 17% EBITDA growth, 28% EPS growth. And this is something because they have also won a large order from the Unilever brand, which boosts Kotak's confidence as well in the company's growth prospects going forward, and management guidance over 12% revenue growth over the next few financial years. However, there are some risks. They talk about slowdown in the broader economy that crimps consumer spending. Then people will not spend here because discretionary segment is something that takes a backseat in that case. There could be execution slippages as well, especially in these newer contracts that Kotak is worried about. But overall, they are quite bullish, already at 300, and the target for the stock that they have is 400 rupees a share.
Well, thank you so much, for breaking down this particular report, and the stock is doing very well, up almost 15%, strong volumes as well. But there's another report that's come out on GMR Power and Infra, and I've been tracking that particular name. Today, MK has initiated coverage on the stock. Remember, the stock is locked at the upper circuit. So what is it that MK says? MK says that, number one, the core thermal assets of the company are doing very well. It's nearing optimal performance. Remember, they have close to 1.65 gigawatt of thermal capacity. They believe that key triggers over here in the thermal space can be coal tie-ups, PPAs to the tune of almost 90%, and PPAs, remember, long-term capacity. They also believe that debt metrics here have improved quite significantly. They also feel that the hydropower asset of the company, that is 180 megawatt Bajoli-Holi hydropower asset, has now largely stabilized. Along with that, they believe that the company has significant opportunity and optionality size as far as the smart metering opportunity is concerned. 7.5 million smart metering installation contract opens up a lucrative asset-light business opportunity with Bosch, is what MK feels. Now, what is it that they're saying? Clear focus on deleveraging on the back of strong operating cash flows, and deleveraging has been led and aided by conversion of FCCBs into equity and handover of Hyderabad-Vijayawada road project. They believe that the net debt is expected to drop by 4,000 crores to 9,000 crore in FY25. No wonder then, they're quite bullish as far as GMR Power is concerned. The stock, remember, has done very well in the last year, and today perched at the upper circuit. That was GMR Power. Another stock in the power sector that we are looking at, significant price damage seen over there. The stock that we're looking at is IEX, and today the stock has actually seen sell-off of almost 10% intraday. And again, if you look at it, almost 10.5%, the stock now trading near the 214 rupees per share mark. But with that, it's all the time we have on this edition of Midcap Radar, Mutual Fund Corner, when we return.
पुष्प, और मैं पुष्प को डिफाइन करता हूं, P फॉर प्रोग्रेसिव भारत, U फॉर अनस्टॉपेबल भारत, S फॉर स्पिरिचुअल भारत, H फॉर ह्यूमैनिटी फर्स्ट को समर्पित भारत, P for prosperous भारत यानी पुष्प। पुष्प की 5 पंखुड़ियों को मिलाकर ही विकसित भारत बनाएंगे। साथियों, मैं भारत का पहला प्रधानमंत्री हूं जिसका जन्म आजादी के बाद हुआ। आजादी के आंदोलन में करोड़ों भारतीयों ने स्वराज के लिए जीवन खपा दिया था। उन्होंने अपना हित नहीं देखा, अपने कंफर्ट जोन की चिंता नहीं की। वो तो बस देश की आजादी के लिए सब कुछ भूलकर अंग्रेजों से लड़ने चल पड़े थे। उस सफर में किसी को फांसी का फंदा मिला, किसी के शरीर को गोलियों से भून दिया गया, कोई यातनाएं सहते हुए जेल में ही गुजर गया, कईयों की जवानी जिंदगी जेल में खप गई। साथियों, हम देश के लिए मर नहीं पाए, लेकिन हम देश के लिए जरूर जी सकते हैं। मरना हमारे नसीब नहीं था।
Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. On the show today, we'll be discussing two topics. First, of course, because of the recent Fed rate cut, what the impact could be on different sectors. We'll discuss IT sector in particular, but that in just a bit, and that is something we'll be discussing with Tahir Badshah, CIO at Invesco Mutual Fund. For now, we'll be speaking about overlapping that we see in mutual fund portfolios. There is a lot of it that we see. In fact, as per the data provided by Edelweiss Mutual Fund, in the large cap category, the overlap happens to the tune of around 60%. This is the top 5 funds by AUM, an average of that. That data should come up for you on the screen as well. For flexi caps, it's around 35%. For the mid caps, it's around 30%. And for the small caps, it's around 15%. But of course, that is an important data that we need to understand. Why does this happen and how can an investor work around it and speak to their own advisor and the mutual funds to make sure that the overlapping doesn't impact their returns? To discuss this and more, we have with us Niranjan Awasthi, the SVP and Head Product Marketing and Digital at Edelweiss Mutual Fund. Niranjan, good afternoon. Thank you so much for joining in. Always a pleasure speaking with you. Portfolio overlap just happens and sometimes the investors are not able to realize it. So tell us more, first up, with an example, what exactly is a portfolio overlap? How does it happen for an investor?
First of all, thanks, Sonal, for having me. Always a delight to speak to you. This is an interesting topic that you have chosen today, portfolio overlap. People don't often talk about it. So what is portfolio overlap? It's basically, say, for instance, you have 2 large cap funds in your portfolio. Now, large cap funds by mandate had to invest almost 80%, minimum 80% of their portfolio in the top 100 stocks as per the SEBI scheme categorization guidelines. Now, if you have 2 schemes and out of these, say on an average, they have 50-60 stocks, and out of these 50-60 stocks, these 2 portfolios have maybe 30 or 40 stocks in common, which means essentially almost 60% of the portfolio is overlapping with each other. And that is basically portfolio overlap, which means while you are holding 2 different funds, But the holdings, if you take the entire holdings of these two portfolios, 60% of them are same. Now, one thing is important to understand here, within the portfolio overlap, while the names of the stocks could be same, their weightages could be different. For instance, in the first large cap fund, the exposure to maybe Infosys, I'm not recommending the stock, but taking this as an example, is maybe 6.5%. And in the second large cap fund, the same exposure to Infosys is around 4.5%, which means the portfolio overlap between these two funds is 4.5% to Infosys. But mind you, in one fund, the portfolio manager is holding Infosys at a lower.
Okay, all right. That is what portfolio overlapping is. We'll do one thing. We will talk about this and more. We will just we'll just slip into a short break. We'll come back and we'll discuss more on the same.
जीना हमारे नसीब है। पहले दिन से मेरा मन और मेरा मिशन एकदम क्लियर रहा है। मैं स्वराज के लिए जीवन नहीं दे पाया, लेकिन मैंने तय किया सुराज और समृद्ध भारत के लिए जीवन समर्पित करूंगा।
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before?
Welcome back. You're still tuned into MF Corner on CNBC TV18. We were discussing overlapping of portfolios and why does it happen and what can an investor do about it. Niranjan Awasthi is back with us. Niranjan, you explained what a portfolio overlap really is. But why does it happen so often? And is it something that we see more in a particular category than the other?
Yeah, so portfolio overlap happen for multiple reasons, One of the most important reason is we have schemes categorization, and by regulation, each category of scheme has to invest a minimum of the portfolio position or portfolio portion into a certain asset class, and within that asset class into certain number of stocks. For instance, I was explaining a large cap fund. By mandate, large cap fund has to invest minimum 80% of its portfolio in the top 100 stock. Now imagine all large cap funds. There are more than 32, 33 large cap funds out there investing minimum 80% in the 100 stock universe. There will definitely be an overlap. So that is one reason. Second is if you're getting into a sector or thematic fund. In sector and thematic fund, because the universe is narrow, obviously there will be limited number of opportunities where the fund managers can invest, and hence there is a portfolio overlap. So these are very common reason. If you see, overlap in large cap category is roughly around 60%, the data which we just saw. As you go down into maybe a flexi cap category, this gets reduced to maybe around 35 odd percent. If you go to mid cap category, it's around 30%. And if you go to small cap category, it is further reduced to 15%. What is the reason for that? The reason is the universe in mid cap is slightly wider than large cap. The universe in small cap is even more wider. And the universe in flexi cap is almost 500 stocks, and hence the portfolio overlap is slightly lower. However, the portfolio overlap between the two funds in this category could be around 30-35%. But the moment you add more funds, for instance, in a mid cap, between the top 5 funds, if you combine them, the overlap could be around 30-35%. But if you add 2 more funds, if there are 4 funds in the mid cap category in your portfolio, this overlap can be as high as 50% as well. Hence, 2 rules for overlap. Within the category, there will always be overlap. But the more number of funds that you have in that same category, the more will be the overlap. These are 2 thumb rules of portfolio overlap in a mutual fund portfolio.
Okay, so this is the reason why there would be overlaps in a mutual fund portfolio. So how can one identify the overlaps within different mutual funds? Do you do it on your own, or do you have to go to your mutual fund or your advisors who can tell you that, this is what's happening with your investments?
Well, definitely a lot of advisors and MFDs out there, they do this exercise. And when they create a portfolio, they definitely look at portfolio overlaps. So one, definitely, if you're not sure to do it yourself, how to do it yourself, take or seek advice or take help from MFDs. The second is you can look at the portfolio. There are certain tools available online. One of the website which usually I track is thefundu.com. You can just put 2 portfolios and see how the overlap is. If you want to do it yourself, you can compare the 2 portfolios on an Excel and simply see how many overlapping stocks are there. So these are a couple of tools that are available which can help you identify how the portfolio overlap is.
Okay, so some tools which are available easily for an investor. And see, once you've gone ahead, you've realized after using these tools that yes, there is an overlap which is more than what you should be having. How can one go ahead and reduce portfolio overlap in your holdings?
Yeah. So one, the golden rule is, of course, asset allocation. You don't put all your eggs into maybe one strategy of equity. Within equity also, you don't put everything in large cap or everything in mid cap. You can do a combination of, various categories of scheme, maybe a large cap, mid cap, small cap. So different categories of scheme will not have very high overlaps within the portfolio. Second is within the category, if you're choosing, it could be wise to choose 1 active fund and 1 passive fund instead of 2 active funds of a similar style. The third is even if you're going into 2 funds or getting into 2 funds in the same category, you can choose one which has maybe a value orientation style, one which has a growth orientation style, one which is investing based on factors or multi-factors. So these couple of things will help you reduce the overlap. Also, if it's a narrower theme or if you're investing in a sector or a thematic fund, it is wise to choose only 1 fund within that sector, because sector or thematic funds usually have a narrower universe, and having 2 funds doesn't make any sense or doesn't make any difference from a diversification point of view. So these are a couple of things which you can do to avoid the portfolio overlap within your mutual fund portfolio.
Okay, so this is what we do with portfolio overlap. But there are some challenges that one would face as well, Niranjan. It's not that easy to just go ahead and be able to remove this, right? So what are some of the challenges an investor should keep in mind which could happen because of portfolio overlap?
So one of the challenges is over diversification, and if you if you have a portfolio that is very high in terms of overlap, definitely the returns that you make will be very close to the index. For instance, if you take the average return of a large cap or maybe a flexi cap fund in the universe, even if you take top 5 and for 3 years and 5 years, the returns are very close to benchmark. It is broadly, 20 to 30 basis point above or below the benchmark. So one major challenge or a drawback of over diversification or of having overlapping portfolio is your returns are completely linked to the market. You don't generate that much of alpha. That is one. Second is, you essentially you're not reducing your risk. You're diversifying, but your risks are similar to market, and probably in many cases your returns would be lower. Also, the third challenge is, if you have 5 funds in the same category, at any given point in time, you will have maybe 2 to 3 outperforming and 2 to 3 underperforming, which will always make you unhappy. So, it's always wise to have different style. In a cricketing parlance, if you have a cricket team with all Tendulkars in your team, it won't help. While Tendulkar is a very great player, it won't help. So you need a Dravid also, you need a Kohli also, you need a Bumrah also. So that's broadly, how you should go about creating a portfolio. And this is how you can reduce your challenges of portfolio overlap.
A team with all Tendulkars would be us living in an ideal world, right, Niranjan? And we are not living in an ideal world, but it makes sense. We need a team together with different skill sets to ensure your portfolio gives you the best returns possible for you. So thank you so much for your insights today. It was a pleasure speaking with you to understand how you can avoid portfolio overlaps, something investors know about, but maybe they do not act upon it so actively. So thanks a lot for joining in.
Thanks, Sonal.
Okay, all right, so that is about portfolio overlaps, but as promised, we have to discuss about the sectors that will be in focus on the back of the Fed rate cut. IT sector could be one of them, so let's discuss this and more with Tahir Badshah, the CIO at Invesco Mutual Fund. Tahir, good afternoon. Always a pleasure speaking with you. Thank you so much for joining in today. So, finally, the Fed rate cuts, they are away and they have come by. They've come through finally. Which are the sectors you think will benefit from the same?
So I think traditionally we've always seen that, in an environment where actually interest rates start trending downwards, I think some of the duration sectors, which are the long, tenure sectors, which typically are the growth sectors, such as technology, IT services, pharmaceuticals, consumer-related products. Those typically are the ones which generally attract relatively more investor interest. That's in contrast to what we see during the period of rising interest rates, and that's what we saw in the last perhaps 2.5 years, where value-oriented, sectors such as industrials, infrastructure-related, businesses actually saw relatively better momentum. So I think what we are probably likely to see is some of these, high growth sectors, which are typically generally associated with more longevity of growth and relatively lesser cyclicality actually making a comeback.
Okay, so let's talk about specifically IT. How do the rate cuts in the US impact this space? You can explain for the viewers if this will be the one that will be in focus after this event that has happened.
I'd like to think so. We've seen that the technology sector actually just a few years ago, if you were to rewind back to pre-COVID or during the COVID times, actually the sector did very well, and that was a period when which coincided with falling interest rates and generally better liquidity conditions in the overall market. And obviously, it was also propelled by the important fundamental and underlying fact that there was rising technology adoption and adoption of IT services across the globe, given COVID conditions. And after which we've seen a reversal of that situation when interest rates have actually started to be on an upward trend over the last 2 years, and technology and IT services related businesses have actually taken a setback to some extent. I think that is once again likely to turn. So as we now sit on the cusp of a possible lower interest rate cycle or a reducing interest rate cycle, I think we should see once again a larger adoption of technology. It should lead to probably corporate budgets towards technology increasing. In any case, now the focus of the US government and the Fed in general is shifting away from inflation control to now, trying to boost growth, control labor-related conditions out there, etc. So I think we are therefore sitting on the possibility of overall technology spends once again reviving, corporate conditions essentially improving. What was probably held back by expectations that or fears that US might probably slip into a recession are no longer now on the radar, and interest rates are being looked upon. Falling interest rates are being looked upon reasonably positively. So I think we are likely to see resurgence in corporate spend towards IT. We are probably likely to see better commentaries out of Indian IT services companies, and over a period of time, I think over the next few quarters, that should manifest itself in the form of better stock performance as well.
Okay. So, Tahir, it clearly means that good times are about to come for IT space. We've already seen a lot of these stocks run up. But from a mutual fund investor's perspective, if we talk about maybe an IT-focused fund or maybe a large-cap fund which has a lot of IT contribution to it, how much should the portfolio tilt towards IT be for an investor? Do you think one can go all out even at these levels?
So typically, this sector is considered to be has been considered to be a reasonably, defensive sector. It has got characteristics which are pretty healthy from the point of view of, less cyclicality. Balance sheets are reasonably robust. It's a low capital intensive business, so it has all those, advantages and positive features to support valuations. I think what we are betting on right now is clearly two components. One is the cyclical revival of IT services globally, and therefore India obviously stands to benefit out of that. And we are also simultaneously looking for, more local technology adoption as well in the domestic context, especially from the point of view of, technology influencing consumption, technology influencing the adoption of financial services, and last but not the least, even in some of the manufacturing-oriented sectors, whether it is, manufacturing of electronic products, or probably we are talking about semiconductors. We are also talking about a lot of, new technology adoption as far as traditional sectors like power is concerned. So I think the breadth of technology services is clearly rising. We are therefore looking at it as something which is relatively likely to be probably less cyclical compared to what it was, and not necessarily only dependent upon global IT services and their cycles. And therefore, to that extent, it is something which can probably be thought by investors as a more secular opportunity with very strong fundamental characteristics. I would like to think that, many of the global indices generally have a reasonably large 20-25% representation in IT services alone. And even the Indian indices are somewhere in the vicinity of between 10 and 15% as far as the tech exposure is concerned. I would like to think that something like a 20-odd% number in terms of allocation to this sector, which is fundamentally very sound and has that long-term play and durability, should turn out to be a reasonably decent allocation.
Okay, so that is something that an investor can look at. And interestingly, you spoke about the usage of IT getting there in every aspect of life. We were speaking to JP Morgan today as well, and they spoke about how AI is seen in semiconductors. We are seeing high industrial use, and technology in general is taking over all spheres of life. So good to see the impact that it could have, the Fed rate cuts on the sector itself. But that I want to ask you about thematic funds. We have seen a big inflow coming in these sectors. Does it make sense in this case to look at thematic funds considering the flows we are seeing in a particular sector or the impact that we are seeing in a particular sector? And how does an investor decide when to get out of a thematic fund, because it is quite cyclical?
So, I think what we see is more cyclicality when there are sector specific funds, because sectors go through cycles, and we see market cycles across different kinds of sectors over different periods of time. I'm not sure whether thematic funds are as cyclical. We generally have a good number of ongoing themes in India which we believe have a reasonably large durability quotient. And typically they tend to do well over longer periods of time, especially if the promise of longer term earnings visibility and growth, which is associated with good thematic plays, manifests itself. So what we are therefore, when we are talking about technology services and technology as an asset class, it is to that extent therefore becoming, it's thematic for sure, but it, like as I said, is as it is becoming more and more widely adopted, it is influencing relatively more sectors, more businesses. I think we have better ability in terms of being able to look at a wider swath of businesses to which technology applies. And therefore, that inherently reduces the cyclicality of such strategies. They're not necessarily dependent on one particular type of business, which, if at all, were to probably turn negative, it can meaningfully affect portfolios. For example, I would say sectors like pharmaceuticals or probably even consumption-oriented sectors. They are sector-specific funds, and you typically have one common construct of these kind of strategies. But what we are talking about here is not necessarily an IT services fund. What we are talking about is a technology oriented fund, and therefore it makes it a lot more easier for us to think about something which is relatively more secular in nature. So I don't think we will have to confront investors in general will have to confront with the possibility of timing themselves in and out of this product in the short to medium term. This is something which we're thinking a lot more long term.
Okay, so long term, of course, that's how long-term investing parameters would work as well. But, at these levels, Tahir, we have seen some comeback in the IT space already. So how do valuations compare versus historical averages in this space?
So clearly, they are not cheap, but if I were to probably benchmark them to the valuation table, which is generally prevailing in the markets today at an aggregate level, I think they are at the lower end of their own valuation cycle. And generally, what we've observed is that some of these businesses, especially the IT services part of the business, typically does not require a very large delta in terms of growth for valuations to be justified out here. What we are trending at is, let's say, early single-digit kind of growth in the sector as a whole over the last 4 to 6 quarters. If this were to probably elevate itself to more closer to double-digit or higher single digits, I think that itself can probably lift valuations from where they are at current level. Look, in the height of the IT services sector boom, like as I mentioned, sometime in 2020 and 2021, we saw valuations go all the way up to plus 2.5 standard deviation. And where we are today is probably more in the vicinity of between 1.5. So expensive to some extent for sure, but not as expensive where we have seen them on earlier occasions. So I think there is room for valuations to also get re-rated. But more importantly, I think it'll be the delta of earnings, and alongside which, if you can probably construct a portfolio which is relatively more balanced between global as well as domestic opportunities, I think it should work out relatively better.
Okay, all right, Tahir, we take that point. Thank you so much for joining in today with your insights on the IT space. It's been buzzing. So good to get some expert opinion on that as well. All right, with that, we will take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
The line. How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. and award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's
The Hang Seng that's managing to hold on to gains of 2% in trade.
NTPC Green Energy a few days back had filed a DRHP with SEBI.
40 hourly exponential moving average, which is about 25,586.
The metal index is something you keep on your radar.
You know, the 5 is maybe a little bit too high, so they made a big step to get it close to what they think it might be.
China has announced a slew of measures which can be positive for the metal stocks.
25,920. 0.07% change.
We still see a very strong earnings growth story coming out of specific sectors within the Indian economy.
Just because today they are smaller, they're able to sustain some of these growth metrics as well as profitability metrics.
Obviously, our NIMS has been pretty strong at about 830 basis points.
1.8 lakh crore rupees. Now that is the cumulative loss made by individual traders.
So close to 26,000 yet so far.
Roughly 40% of our portfolio is into the broader financials.
17 points higher on the Nifty. We've seen a lot of fluctuations today.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, that is the day so far, and it has been a positive day in the green. Metals clearly are the leader, and on the downside, there is FMCG, which is sulking a little bit, but otherwise not really very much to complain at all. Markets drifting up. We're coming to you from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good afternoon.
Hi guys, afternoon. So we were almost there, I think about 6-7 points away from the mark. Now there's momentum building up again. Yeah. Europe is positive. So what do you say? Is it happening today?
It's happening today.
Prashant? I always do that. I love doing this.
It's happening today. The Nifty Financial Services Index will play out the weekly expiry. So there'll be some contracts that'll move. Then the one that's not performing as of now is the Nifty Bank. So just Nifty Bank needs to go up 100 points and we're there.
Okay, so he's saying 26,000.
Well, then it's done. It's looking up 40 right now. So 25,975 and slow drift higher. Banks are actually absolutely flat, so not very much. Will 26,000 matter in any way, even as a sort of small bit psychological resistance? We'll see. We've not really even tested that. But the pace recently, of course, has been pretty fast over the last 3 or 4 sessions specifically. That's the distance to the 26,000 level, just 30 points. Now, you've got to look at metals, which are up. The index is up about 2.5%. And that's a big talking point. Nigel will talk more about that. I can say a big thank you to what's happened in China. I think a lot of European markets and European metal stocks are also jumping on the back of what's happening in China. Just looking at some of the rates. FMCG, I think, is the only large index which is down. There are others lower as well, but nothing in size. FMCG may be just cooling it a little bit more than anything else. Surabhi.
Yeah, absolutely. I'm looking at those European screens right now, and some of the markets, like, for instance, the French market is really surging away. 1.5% up on that one. But even for us here, the mid-cap story has been strong and robust, and the mid-cap market's now tracking a gain of about 1%. The advanced decline ratio is pretty much neck to neck today, so that's an interesting aspect of trade. But yeah, I mean, metals, it's not just about a Tata Steel or Hindalco. Even if you go beyond and look at some of the other names, beyond the Nifty 50, that is, that's where the biggest chunk of the gains are really coming through on stocks like, Vedanta, 4% higher. Last I checked, even Nalco was flying around. So, the entire metal complex is very, very excited because of the measures that we've seen in China. And then beyond the metal names in the mid-cap market, we've got a lot of interesting stocks in focus. Look at Paytm, 5% higher. Look at First Source, where there's an acquisition, small 40 million pound acquisition that they've done. Stocks in news about 6% higher. There is Schneider Electric, 11% on the upside. Epigral, lots and lots of names. V2 Retail, lots of names on the upside. I think the market overall is feeling quite okay, quite optimistic. And barring this a little bit of profit taking in FMCG, like Prashant mentioned, nothing that's really to find fault with.
Even the insurance companies actually have come in for some profit taking. SBI Life, HDFC Life, and both of those companies, you have the Nifty Bank and then you have the Nifty Financial Services Index. The Nifty Financial Services Index also has these components. NBFCs, they also have the insurance companies. So the Nifty Financial Services Index is at the low point of the day. If it can try to move into the green, that's what will help the Nifty get closer. And just take a look at the broader markets. A couple of stocks just bucking the trend. Post some brokerage notes. Here's Axis Securities that came out with a note on Arvind Smart Spaces, the stock that we had covered just yesterday on Bazaar. It was seeing a fair bit of delivery-based buying. That one's up close to around 15%. I'm guessing it's on the back of that note that came in from Axis Securities. Very, very high volumes, now up close to around 19%. And the other one is SH Kelkar. You have Kotak that's come out with a note on that one. And that as well is up close to around 15%. So that's sort of a market where, these brokerage notes are making the difference. 17% now as we speak. But let's focus on the headline index because the markets were trying to make that move towards 26,000 odd and we cooled off a little bit. Mitesh Thakkar is back with us. Hi Mitesh, good afternoon. Good to see you in. What's the view on the Nifty from here on? I mean, I guess you need to just trail your stop loss and hold on to your long position. Tell us, what's the call?
I think that's the very logical way of doing it, Nigel. But, I would also suggest maybe, taking about 1/3 position off the table and add it back if we see a break beyond 26,000. See, the one reason is that obviously it's a psychologically important number. It's a round figure. Two, there's a lot of call open interest around crore shares at 26,000. So in that sense, I think, dropping some positions over here, looking for a 100-point decline and then re-entering could be a good idea. Or you buy once the spot Nifty is about 26,000, 30, 40 levels and then take it from there. But the idea is that the position should be clearly on the long side. Having said that, I think metals is a sector, which is doing extremely well and that's where the action is. Hindalco is something on my radar. I think it's just breaking into fresh highs. Disclaimer that I have some call positions over here, so there's vested interest. But a breakout into fresh highs can always see good follow through. So keep a tight stop at about 704, and we'll look for a target of 740 to begin with. Maybe eventually even higher levels can be tested. And that about, I think, Coforge is from IT Pack. It didn't correct when the IT sector was Coforge is again picking up strength. So buy here with a stop below 6910 and target of 7,200.
Got that. All right. Thanks a lot for that, Mitesh. We'll come back to you as the show progresses. But let's focus on the sector of the day, which is metals. China has announced a slew of measures which can be positive for metals companies. Well, they say that the PBOC will cut the reserve requirement ratio, which is the RRR for banks, by 50 basis points. But they've stopped short of giving the exact or the specific timeline for this cut. Also, they've hinted at another cut of around 20 to 25 basis points on the RRR before the end of this year. There were also a few more highlights that came out. They'll be cutting rates on the existing mortgage loans. They'll cut the 7-day reverse repo rate by around 20 basis points from around 1.7% to around 1.5%. And they'll also cut down the minimum down payment ratio for the second home to around 15%, which compares with around 25%. Phillip Capital, they have come out with their reading of the situation. They maintain their positive stance on metals. The top picks in the ferrous space, JSW Steel as well as JSPL. From the non-ferrous space, it's Nalco as well as Vedanta. They've also recommended accumulating NMDC as well as SAIL but both those two in a staggered manner. I was also looking at a note coming in from HSBC, and they're saying at current prices and current reckoning, well, only 5% of the Chinese producers, steel producers, are making money as of now. And as we put out this piece a couple of weeks ago, normally when there is plenty of pessimism on demand, on pricing, suddenly the cycle does turn around. It seems, at least as of now, that seems to have happened. Well, we have Sudeep Bantupadhyay, the Group Chairman, IndiTrade Capital, who joins us on the show. Hi, Sudeep. It's a tricky one. Just a short while back, I think at the start of September, everyone was saying that we're seeing too many imports coming into India. Exports are not quite picking up. Chinese steel prices were at the lowest we've seen since pre-COVID levels. And yes, the benefit of lower coking coal costs was there. But the problem was with iron ore prices falling, it wasn't giving any kind of base to steel prices. What's your view on the metals pack, and what do you like, ferrous or non-ferrous?
Well, Nigel, I think if China actually goes ahead with all these stimulus measures which have been talked about, I think this is definitely good news for the entire metal pack. US has started cutting rates, and that's a very good starting point as far as metal rally is concerned. The challenge was the problems in China, and there were big problems. And if China's stimulus measures do work, I think it'll be good news for the metals. Now, amongst ferrous and non-ferrous, I do like things like aluminium and other metals where the use case is continuously increasing with the adoption of EV and the modern gadgets. People have started using and preferring more and more aluminium and related products as opposed to iron and steel. And this is a structural change, I believe. And that's the reason why I have been recommending investment in, say, Nalco, Hindalco, even Vedanta. I think this makes tremendous sense. Yes, this particular rally, assuming Chinese, stimulus is on, will cover pretty much all the metal stocks. But if I have to focus on long term, I will focus on aluminium.
Aluminium, so that would be your pick. And you'd play that via Hindalco itself, or would you look at Nalco?
I will look at Hindalco, Nalco, as well as Vedanta. I think all three can be looked at. There's no harm.
All right, got that. Sudeep, thanks for that call. So I want to look at some stocks that are flying around in the mid-cap market as well. And one of the names that really catches the eye, Sudeep, is Paytm today. It's up around 5%, and actually it's not been a bad month. I mean, this month it's up about 10-11%. So there's some sort of, bottom fishing that's going on. But I don't know, do you see anything on the horizon here that merits a fresh entry?
Well, I'm a little cautious, Survi, here. They are talking about doing a lot of things, and they are reapplying for the payments aggregator license, which is all good news. But today, the main business is loan syndication. I think that's the principal source of revenue as well. We'll have to see what transpires and how things unfold going forward. At this stage, the valuation definitely is rich, and I don't think I will recommend entry at these levels. There are excitement based on a lot of news flows, but I would advise investors to be cautious here.
Okay, advise investors to be cautious here. Markets up 44, so just sort of holding, just under that level of 26,000, not very far away from that level though. Some of the stuff is just reversal from yesterday, so I don't think one should make too much of it. So Amber went up 13% yesterday. Today it is down 6%. It's the second biggest volume-led loser. SBFC went up 20% yesterday. It is down 7% today. I mean, this just feels like, pullbacks or reversals, maybe a little too much yesterday and then a little bit down right now. Stovecraft is something which we were talking about yesterday as well. It's down 5%, 890 on Stovecraft. Bharti Hexacom is another big mover on the downside. It's down about 5.5. Mind you, market breadth is almost nearly 1:1 in terms of advanced decline. The one which has kept going lower is Fusion Microfinance. It's down another 9%. Stocks at about 250. Remember, the last quarterly earnings it was when trouble first emerged at Fusion Microfinance, and they essentially said that NPLs had jumped, and there were a lot of talk that maybe there was sort of evergreening of loans And now, of course, there have been, and it was at that point, I remember lots of people saying that second quarter is going to be pretty bad. But I think now things seem to be a little worse off with the latest disclosures, etc. Stocks are up about 250. The high was about 600 on this one. This is a private equity-owned microfinance company, by the way. Just a quick word, Sudeep, if you track this one, ever owned it, Fusion?
Well, definitely there is a lot of bad news as far as this stock is concerned. You're absolutely right. First quarter itself was bad, but the recent announcement that the second quarter ECL expectation is significantly higher definitely has shaken the confidence of the investors here. The management and the investors in this particular company have also taken necessary steps of announcement of a fresh infusion of capital and induction of a CEO to streamline the management and other processes. So things probably will fall in place going forward. But as things stand today, I think it's a bit of an uncertain scenario. And one has to see the Q2 results, which actually comes out post the audit, sometimes towards the end of October. We'll have to see that. As far as overall microfinance industry is concerned, there's a bit of a stress as far as asset quality is concerned. But our belief is that post the Q2, the festive season is setting in, and things have started looking up in the rural economy. Rural income has started increasing. So as far as asset quality is concerned, things should start improving from Q3 onwards. That's our reading of the scenario. Of course, the fundamental issue of over leverage amongst the borrowers is definitely a genuine concern, and that has to be seen how that pans out. But otherwise, structurally, things are going to look up from Q3 onwards.
Okay, so perhaps things get better for microfinance lenders in the second half, towards the end of the year. Take that point. By the way, there's a nice move in a lot of the frontline IT stocks right now. It's something that you really can't ignore. Tech Mahindra, HCL Tech, LTI Mindtree, all these stocks had a far more modest start, but now they're building on some of the gain and the momentum. And the likes of LTI Mindtree trying very hard to actually break into the green side of the screen. Look at that build up on Tech Mahindra. Looking quite smart. There's HCL Tech, there's Infosys, Wipro, TCS. It's an across-the-board move on IT. That's LTI Mindtree trying very hard to now join its peers on the green side of the screen. So interesting take on a lot of the frontline IT names. Sudeep, how do you find the IT stocks? I mean, there's been a fair amount of move towards them already for obvious reasons. Cash rich, provide safety, and the whole portfolio churn that we've started seeing. But given that many of these stocks, the frontline ones at least, are already close to 52-week highs, would you still take a further exposure? What's the advice?
Well, if you're a long-term investor, there is absolutely no harm. I think, most sectors and most stocks, as far as Indian market is concerned, is near all-time highs or have already touched and crossed all-time highs. IT sector was subdued for a very long time on the back of a fear of US recession. But I think the US recession is not there. There is a soft landing which is happening in US. And large Indian IT companies who were, a couple of quarters back losing orders, there were postponement of orders, and all kind of unfavorable things which were happening. I think it's a matter of past. Things have started looking up from their point of view as far as US business is concerned. And remember, for most of them, US business is either 50% plus or close to that. So under the circumstances, US economy remaining robust is good news for them. And they will continue to give an decent return and reward shareholders. As far as the mid-cap and small-cap IT companies are concerned, we have been recommending investors to be very specific and focused on sectors and companies which are catering to sectors which are in an upswing. So let's say travel and tourism worldwide is an upswing. So you focus on companies which are catering to travel and tourism. So a RateGain Technologies, Proforge, I'm just giving a few names. These can be looked at. The auto industry, there is, massive technology adoption happening. So, IT companies who are assisting or a part of that process, let's say Persistent, Tata Technologies, and some of the other companies, focus on those companies because they have a long runway.
No, I got that, and good points you make there. By the way, guess what is the biggest volume-led gainer on the NSE today is First Source with that 6% pop. At number 2 position is a near 8,000 rupees stock. So, I mean, so look, and it's got the second highest amount of volume. I'm talking about AstraZeneca, 70 at 40. So stock's actually rising even more. It's up 16% now. I mean, that is a big move which is coming through. I mean, actually, and it's started now. I mean, I think almost all the gains that come in the last 4 minutes or so of trade. Yeah, look at that. I mean, it was actually absolutely flat. Stock was at about 70, not all of it, I beg your pardon. It was trading at about 7,500. Yesterday's close is 6,750. And then from 6,500, it's gone, sorry, beg your pardon, from 7,500, it's gone to 7,800 in a big move. And it's got volumes on it. We don't see this usually at all. So, yeah, I mean, quite something. We'll come back to this one and probably pose this to Sudeep for a quick view. But just a few other sort of brokerage names which we want to highlight. MK has initiated coverage with a buy call on GMR Power. Vivek is here with highlights. Vivek.
Well, that's right. A very interesting note from GMR, from MK on GMR Power. Also, they've initiated coverage on the stock. They have a buy rating and they have a target price of close to 180 rupees a share. What is it that they're saying? They're saying that number one, the core thermal business is actually doing quite well and it's nearing optimal performance. What are the key triggers there? Coal tie-ups, PPAs to the tune of 90% of the total capacity, and also improving debt metrics. Now, this is regarding the thermal power portfolio. What they are also saying is that the hydropower portfolio, that is the Bajoli Holy 1800 megawatt of power plant, that also has largely stabilized. And the third vertical is the smart metering vertical. Over there too, they believe that the 7.5 million smart metering installation contract opens up a lucrative asset-light business opportunity with Bosch. Along with that, there's improvement as far as the balance sheet is concerned. Clear focus on deleveraging on the back of strong operating cash flows. Deleveraging has also been aided by the conversion of FCCBs into equity and the handover of the Hyderabad-Vijayawada road project. So they're expecting, net debt to drop by almost 4,000 crore rupees to 9,000 crore in this year itself. And they see further upside potential from incremental smart meter contracts, monetization, as well as settlement of disputes. And they believe these provide significant and sizable optional value. No wonder then the stock pushed at the upper circuit throughout the day.
Okay, got it. That's GMR Power and Urban Infra. Some more stocks that are flying around on the back of brokerage notes. Kotak Institutional Equities has reinitiated coverage on Asset Kelkar. They have a buy rating. We have Sonal joining in with the details. Look at the stock flying in 16%. So the market really loves what Kotak is saying. Tell us what the note has, Sonal.
Well, a lot of growth levers is what Kotak likes for this particular counter. The fair value or the target price that they have on the stock is around 400 rupees a share. They see a long runway for growth given established and sticky relationships and execution possibilities that they have with the existing clients. Additionally, they are also seeing growing footprint in Europe, US and Southeast Asia as well. So export also continues to be a big pie for them in terms of growth. Now, there are high entry barriers. This belongs to flavors and fragrance industry, and that makes it a good candidate for growth going forward and to place a bet on as well. They also see potential for margin expansion, which will be driven by high margin geographies, which is Europe. Second is their operating leverage and also strong cash flows, given it is a business model light on fixed assets. So that is why the margin expansion possibilities are more. Looking at a CAGR of 12% in revenue, 17% in EBITDA and 28% in EPS over the next 3 financial years. They recently won a large order from the FMCG giant, that is Unilever. And that's what makes Kotak very confident on this name. The management has been guiding for a 12% growth rate going forward in future years. There are risks, however, because it's a discretionary segment. Any slowdown in economies is something which would hit discretionary segment first up, and that is something they're worried about. Second would be any execution problems if they have with these bigger clients that they have entered into or bigger geographies that they have entered into. So these could be the risks, but overall, considering the track record, they're quite bullish on this name.
All right, got it. So that's Kotak sounding very, very upbeat on Asset Kelkar, target price of 400 on the stock. By the way, on AstraZeneca, the stock that Prashant just picked out, which is soaring 16%, just to put the news in context as well, they have now gotten permission from the Government of India, from the central agency, which is the Central Drug Standards Organization, for the import of a pretty important cancer drug. And it seems that that drug has a sizable market, and it could be, of course, more beneficial for AstraZeneca. Now that they have the official permission for more import, sale and distribution here in India. So that's AstraZeneca as well. So lots of stocks moving around on either news or brokerage notes. So Sudeep, take your pick from SH Kelkar to AstraZeneca to some of the other names. Any thoughts in case you track any of them?
SH Kelkar Survey has been one of our favorite stocks since it's got listed. I think it's in a niche business and very strong customer relationships. And these are not something where there is somebody new can enter. So there are significant entry barriers. So this is something which one likes. And of course, with the FMCG industry expanding and getting into newer areas, the scope for the servicing by SH Kelkar in terms of the fragrances and flavors also is increasing. So I think this is a good business. But one has to remember, and I must say that this is a long-term business. So, yes, it has gone up based on one research report today. But if you are investing in it, be in it for the long term and it will reward you.
Okay. I mean, by the way, so the market hit 26,000. I mean, it went like, unnoticed. It had a big candle. I mean, actually, you'll see that. I mean, actually very unusual. It just zoomed past. The high has been made at 26,011. And just like that, I mean, very quickly, it's fallen back to exactly where it was, which is 26,970 or so. So there was this one zip higher. And then, of course, we are now back under it equally quickly where we started. So, but we are, we've touched 26,000 and that's done now. So that's in the bag in that sense, and we can look ahead at other kind of levels, etc. It'll be interesting whether, we are able to stay above it, or as Mitesh was talking, or I was saying earlier, this is something which the market wants to, around here, is where the market wants to find some amount of, wants to spend some time around that. Some of the stocks which have done very well in this last 1,000-point journey, as we always do, will come up at the bottom of the screen. And I think we'll have, our team join us with some of that stuff over the next 30-odd minutes that the markets are going to be trading for. So just before 3 o'clock, 26,000 in the bag.
So like when you don't hold your breath for it too much and don't count down too much, is when it quietly happens. We were looking at all the stocks that were flying around.
Yeah.
And just around that time, we hit that mark of 26,000. The reason we're seeing profit taking is that some of the stocks like Lever, for instance, they're playing a bit of a spoiler down to 2.5%. Some of the banks are also cooling off from the earlier levels like Kotak, IndusInd, Axis. So the banks are not exactly playing ball. It's a rally which is, but having said that, look at HDFC Bank. I mean, that's still batting for the bulls, still retaining a gain of about 0.7%, which is why you still got sort of fair amount of gain, 180 points up on the screen, and it has been looking good. And this last 1,000-point move, Prashant, has been interesting as well, right? Because in the last leg, we've finally seen some sector rotation. Otherwise, it would always be the same PSUs that we speak of, the same set of stocks. But now we've seen a little bit of that rotation, money coming back to financials, money coming back to IT stocks, which have also done well. In fact, just to talk about some of the, the better performing parts of the market, if you look at sectorally speaking, some of the sort of best performing sectors of the last 3 to 4 weeks gone by. So consumer is right up there. In the month of September, it is actually the Nifty Consumption Index, which has rallied 7%. There's a Consumer Durables Index. Realty continues its forward march. Nothing has changed on the real estate story. But financials, private banks, and the Nifty Bank itself, which have been missing from the party for so long, they've started to come back and participate. And so we have a bit of a, for what it's worth, a bit of a new leadership to this milestone of 26,000. In fact, I think we can go to Hormaz now, right? He's been churning the numbers and the data for us. So, Hormaz, take it away. Mount 26,000.
Will it, won't it? All through the day, there was this suspense building up, right? And finally, the mark of 26,000 eventually happening on the financial services expiry day. 38 sessions then, from 25 to 26,000. We hit 25 for the first time on the 1st of August. So, it's taken 38 trading sessions then. And since then, we've moved. So let's take a look at the top contributors then. And as you were mentioning, right, just a few minutes back about sector rotation taking place and the names that have come up. And this last 1,000 points, of course, have happened from the September of 11 that we have moved higher. Look at this. Bajaj Auto, Shriram Finance, Bharti Airtel, Bajaj Finserv and Hero MotoCorp. Among the top movers in percentage terms, yes, Bajaj Auto continuing to move from one high to another. And even Bharti Airtel has come up here, as has Hero MotoCorp. But take a look at the underperformers, and they are the ones that have not participated in this rally. The best performing stock on the Nifty in 2023 is the worst performing stock in this 1,000-point rally. This Tata Motors is down 16%. And the PSUs, the high-flying PSUs, have been featuring in this list of underperformers, be the likes of ONGC and SBI. But a big catalyst of this 1,000-point move has been the rush seen in the banks. The Nifty Bank has been the lead contributor here. And as of closing yesterday, the Nifty Bank was up for 8 days in a row, and 3,000 points is what the index has gained, and that shows up in the Nifty moves as well that we have seen from the 11th of September. And take a look at the big movers in the Nifty Bank as well. An underperforming Bandhan Bank is the top performer in these last 8 sessions from the 11th of September. And look at this, HDFC Bank and ICICI Bank, the two big heavyweights on the Nifty Bank, on the Nifty as well, 7% each, and that shows up on the price as well. Interestingly, it was the 1st of August when Nifty hit 25,000, and it was the 1st of August when the PSU index made a near-term top as well. And since then, the PSU index is down almost 6.5 to 7%. And take a look at the top losers here. All the top performers, REC, SAIL, Concor, BHEL, LIC, all of them seeing double-digit losses, and 17 out of the 20 index constituents since the 1st of August have delivered negative returns. The only 3 in the positives are Oil India, NTPC and HPCL. But it is not the story of the PSU underperformance. Today is the day that belongs to the Nifty, and it's been a large cap move over this last month and a half.
Almost, do you remember how many? 38 sessions you said, right?
38 sessions, yes.
What were the previous 1,000-point jumps?
The 25,000 took 24 sessions, so it was the third fastest rally. So this has taken a slightly longer time.
And before that? Was it 25? I mean, this is...
38 sounds like a nice, mature number for a change, right? It's not a mad dash, which is what the market was doing in the earlier part of the year. 38 probably... not too bad, like measured.
No, it's in percentage terms, it's 4%, right?
4%. Yeah.
You know, that's the other sort of way to put it. We must look at it like that also. I mean, to go from big difference to go from 20 to 21 as compared to go to 20, yes. 20, not that big a difference. I mean, you know, the point is that percentages become smaller and smaller as you keep going higher. But it's been a pretty good run. Sudeep, you want to weigh in? I think the market now is almost in the red.
Actually cooled off quite a bit. Yeah, 25,000.
So I hope we don't pay the price of...
Getting excited.
Sudeep, any thoughts?
No, I think it's good to be a part of this entire journey. And today I'm on screen when it touched 26,000, so I'll remember this. But you know, beyond all that, I think you know, we will keep seeing the market inching upwards. I won't be surprised if we end the year at around 27,000 plus levels. You know, the kind of sheer liquidity support which the market is getting, domestic as well as from FIIs now, I think will propel the market upwards. What we need is definitely more depth of Indian market, which all the new IPOs coming in at the pace at which they are coming does help, and that makes for a healthier market.
And we'll see lots of it. And I think you know, what's also important is to stay in the market, right? Not get stopped out, make some stupid mistakes, get excited and chase something which looks very exciting, and then kind of sort of lose your way. Because, you know, that's the nature of markets. It'll get you excited. It'll get you very worked up. And, you know, you always think the next guy is making more money. So, you know, I must get into something more exciting than what you already know, which may actually eventually be the winner. And I think that's an important sort of lesson, especially, you know, where we are right now. We're not at 10,000, 15,000. We're at 26,000. So the market's done well. Sudeep, thank you very much for joining us. Great speaking with you. Appreciate it. We have Saurabh Gupta, Senior Fund Manager of Equity at Bajaj Finserv Asset Management, who's with us. Saurabh, great to have you with us here. Thank you for your time. I got to ask you for, I don't know if you have any thoughts on a new milestone, 26,000 in the bag this afternoon. What's your sense, Saurabh? More and more opinion seems to be that large caps will now actually start to get a little bit more attention. It's so far been mid and small caps. That should shift. Your thoughts?
No, absolutely. And these milestones are coming fast and more than welcome. But clearly, our view also remains that on a relative scale, large caps are better positioned. In our portfolios also, we are tilting towards large caps. While markets are always heterogeneous, both in large caps or mid and small caps, but to find ideas of conviction at your price where you want to buy, large caps is a place where there is some comfort, a little more comfort than mid and small caps. So yes, tilt is towards large caps, valuation comfort, and we believe large caps should do better from here on compared to the broader markets.
Okay, so large caps are going to do better. That's the expectation. Saurabh got it. Good afternoon. Good to have you on the show. But what within large caps, right? I mean, I know there's been interest, of course, going back into the consumer space, but it's not been very consistent. You always have a couple of good days followed by, a round of profit taking. Is that a space you would look at now, even though maybe growth rates could be just mid-single digits, going by what most analysts say?
Oh, absolutely. Over the last 2 months, what we have seen is that there are clear changes in equity markets. While market continues to move up, the leaders have clearly changed from capex-driven businesses, government-pushed businesses, to consumer names, to pharma names, to IT. And we believe this trend will continue. Often when these type of changes happen, equity markets react first and hopefully earnings follow. If our research is correct, earnings should follow. So our tilt is also very clearly towards consumer names, especially consumer, not on the urban side, but on the rural side. We clearly see rural beneficiaries doing better than urban beneficiaries, urban consumption beneficiaries. We are also bullish on the pharma space. We are clearly increasing our exposure on the pharma space, especially on the CRAM space, which is a new big mega trend that is emerging around us. So we are kind of positioning ourselves over there. And also private banks and insurance companies is a place where we are clearly increasing our overweight exposure right now.
And it's interesting. We'll pick on some of these, especially CRAMs, etc., in terms of how to get exposure. Saurabh, stay with us, and we'll just take a quick commercial break here. We're going to come back to you and continue this conversation. I mean, if you're just joining us now, markets hitting 26,000 on the Nifty and then cooling off. We're actually down 2 points on the day. So 25,938 is where we stand at. We're back.
An award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
US has been trying to reduce its dependence on China. India has been and is expected to be a big beneficiary of it. Do you think we are sort of using that full potential right now, or there's a long distance to go?
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before, but in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation look at it and say we can't rely on someone who might one day be an adversary, that doesn't make them an adversary today, for supply. Just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like if countries are aiding and abetting industries to dominate global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. There's semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China plus one strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
we've got U.S. elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that? I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do.
Investing.
Welcome back. Well, we're still in conversation with Saurabh Gupta, Senior Fund Manager, Equity at Bajaj Finserv Asset Management. The market, by the way, continues its cool off after touching that level of 26,000 on the Nifty. Saurabh, so give us a sense of your portfolios. I mean, you're fairly diversified. You do have financials. You do have a fair play on consumer as well. And then you mentioned some specific plays on the pharma side. So, I mean, for every incremental rupee you have to put in the market now, how would you go about with the breakup? Say for every new 100 rupees you have to put in, how would you break it up across segments and themes?
Sure. So we have been increasing our exposure, as I told, on the banking, on the private banking side. There is a valuation comfort. And finally, the fear of rate cycle reversing is for the liability franchise owners was the reason that the banks were not doing well given the MCR linkage they had. Then there was a fear of kind of NIMS pressure. That is now starting to play out, and I think markets have those companies have not participated because of the margin fear. I believe now from here on, incrementally, earnings should surprise us on the positive side on the margins for banks, especially the private sector banks. So we are clearly positive on them. And second part is also important on the banking side is that there is again some uptick on unsecured lending, that is NPA, that is happening. That will ensure that the good underwriters, which were ignored for 1.5, 2 years, because the cycle was so good, they will start to get some respect again. So high quality lenders which were not getting or not participating in the rally, not getting the valuations that they used to get, I think that's the time that will reverse. So that is one positioning, one incremental exposure that we are adding for sure. Second is consumer staples. As I told, we are getting incrementally more bullish on rural consumption, and the big play on rural consumption is bottom of the pyramid consumer discretionaries or staples. So this is an incremental position that we are adding. Also, insurance companies look good to us with a lot of regulatory hurdles behind us. We believe from here on, there could be some money that can be made on the insurance segment as well. Coming to the pharma question that you had, we are extremely bullish on the mega trend or regulatory changes that are happening in US on the CRAM space, especially the Biosecure Act, which is throwing up a very large opportunity for Indian pharma companies, especially companies operating in the pharma space. Though that opportunity can be really, really large on the smaller molecule side. While it's still kind of firming up, numbers could be 1.5 years away, orders could be 1.5 years away. But incrementally, that is also one thing that we are kind of very, very optimistic about, and we are adding exposures over there right now.
You 13% of your fund, Saurabh, is in pharma, right? And
yes.
Is Divi's the single largest position for you?
Yes, in pharma, yes.
In pharma. Okay, so it's not the generics which it's more very specifically CRAMS as the story.
So
or
US,
is it US? Yeah.
US generics is a more of a cyclical uptick story where the pricing pressure is reducing. But we believe that is more of a cyclical story where we can play for some time. But if you are looking for some structural theme where things will play out for next 3-5 years, it is the CRAM space because of Biosecure Act, and it's getting more and more exciting. More and more we talk to companies, try to do channel checks. We believe it's a huge opportunity opening up. It could be potentially best case a $40 billion opportunity. Even if we get half of that over the next 5-6 years, it could be huge. Even the largest of Indian pharma company on CRAM space is $1 billion revenues. So it offers a lot of opportunity. The inquiries have been increasing as we interact with the companies. They tell us, and the order book should start to get firm up in 1.5 years. And I think that's a real structural story that we have in our hand to play around. While US generics is more of a cyclical story, which should play out in 3-6 months.
Okay, interesting, and explains your sort of stance on pharma and why that sector is one of the largest holdings in your FlexiCap fund. Got that. Saurabh, good talking to you today. Thank you very much for joining in, and we look forward to more conversations. With that, let's get back to the market, which actually has had a pretty big bout of volatility after hitting 26,000, sudden reversal. But the Nifty Bank has stopped falling. So for the bulls, they'll have to take heart from that. Look at the immediate rise and then the equally sharp drop that we had. Okay, Nifty Bank actually, down about 120 now. So let's see. We've got, I think, Nimesh with us. So let's quickly head across to him and see what the chatter from dealing rooms is like. Nimesh, this is interesting. 26,000 and then a rapid decline. What are you picking up?
I said, it's not very surprising that at record highs, you will see some bit of profit booking coming in. But again, this whole rally in the last couple of weeks has been largely backed by FI buying, and that seems to be the trend today as well. So another day of very strong FI buying, and the flows is the feedback, and within that, it's the metals which are well bid today. That explains the metal index up 3%. A lot of metal stocks are buzzing in trade. And remember, this is one sector which is relatively under-owned by the institutions. So looks like, on the back of that China stimulus, there is a bit of interest back in the metal stocks in today's market. I guess overall the sector rotation continues. So a bit of profit booking in financials after what we saw in yesterday's sales. Some of the PSUs were buzzing in trade. And on the other hand, a lot of the metal limbs are buzzing. A lot of other stocks are buzzing as well. So looks like the sector churn continues. But the broader theme seems to be that the large caps are likely to outperform the broader market stocks like. So that's been the trend. And this large cap outperformance is largely on back of institutional buying. So as I said, again, another day of very strong buy interest and largely towards the metal names today.
Okay, Nimesh, in terms of individual stock chatter, what are you picking up?
Well, Prashant, looks like before the earnings season kicks in, some last leg of blocks are likely to happen very soon. We saw a large block today, car trade, nearly 9% equity got change hands. The stock recovered from the day's low after the block deal, but in terms of buyers and sellers, looks like the PE was a seller in today's block, and then domestic mutual fund was an anchor in the block as well. So again, disclosures will be quite interesting there. The second name is 5-Star Finance. As I said, looks like some large blocks are going to happen. 5-Star Finance is a stock to watch. The stock has been consolidating off late, but I understand that could be a very large block deal in 5-Star Finance very soon. The PE investor is a likely seller there. That's the buzz. The third name is SW Solar. That's been buzzing off late. The company has been bagging large orders as well. In fact, one large international order is something which series has been anticipating. But now I understand even in SW Solar, there could be a large block. Potentially a promoter entity could be a seller in that block deal. And the last is GAIL. A bit of interest is back in the PSUs of late. We saw a big rally in the metal names today. Even some other PSUs are buzzing. But GAIL stands out largely on back of large FI buying. So the delivery volumes are going to be quite high. And looks like the FI interest is back in some select PSUs, and GAIL stands out on back of buy flows.
Nimesh, that SW Solar is interesting because you're saying a promoter entity. Shapoorji is the promoter entity, and the other one group company which is coming up with an IPO is Afcons, right?
Yes.
And there was expectation that perhaps would take care of all the sort of debt, etc. here, but this is, go on.
Yeah, so you're right, Prashant. For SW Solar, that's the indication that the promoter entity is looking to sell a small block and do a fundraising via block deal. So the promoter entity is the likely seller in that SW Solar block. And as you rightly pointed out, the other group company is also coming out with an IPO. So I think that will suffice the funding requirement for the Shapoorji group.
Okay, all right, and of course that order, the Nigerian order market's been waiting for a while, and as Nimesh said, there is still, I guess, in transit. When it comes, we don't know, but that's the material one. 664, and that's SW Solar. Markets are absolutely flat, 5-point change, 25,943. We take a break, we are back, and we'll get you more trades, and we'll kind of wrap up the day as well. Which is 10 or 15 minutes to go for market closing.
Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting. China's kind of on the other side of America in that one, so that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And I think if the war goes on, there will be contentious issues between the countries, far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough. But I don't think either side is talking about disconnecting.
They say that the proof lies in the pudding, but this SEBI study is neither the proof nor the pudding that many F&O traders would want to see, read or hear. Now, 1.8 lakh crore rupees. Now, that is the cumulative loss made by individual traders within the F&O segment between FY22 and FY24. That's the big number from this latest SEBI study. Now, a study that the market regulator released last year said that 89% F&O traders lose money. Now, that number remains where it is, as 9 out of 10 individual traders in the F&O segment continue to incur quote-unquote significant losses. Now, let's tell you more about those significant losses. Including transaction cost, the average loss of over 93% or over 1 crore individual traders stood at 2 lakh rupees each. If that is not enough, the top loss-making traders raised the bar higher. The top 3.5 loss-making traders averaged a loss of 28 lakh rupees per person, of course, including transaction costs. Again, all of these figures between FY22 and FY24. So, does anybody make a profit? Absolutely. A staggering 1% of the traders in the F&O segment made a profit over the last 3 financial years. And if there ever was a gulf between domestic and foreign traders, the upcoming graphic will show you that. Proprietary traders made a profit of 33,000 crores in FY24 before adjusting for transaction costs. FPIs made a profit of 28,000 crore, and putting these two numbers together, the individual traders made a loss of over 61,000 crore rupees in FY24. So how did these traders manage the profit? Now, most of these are generated by larger entities using algorithms. 96% of proprietary profits and 97% of FPI profits are generated through these algorithms, according to the SEBI study. Now, if you wondered that the SEBI study from last year would act as any deterrent to youngsters from venturing into this unknown
Welcome back. Well, it's been a volatile afternoon for the market, with now the Nifty struggling to hold on to the green side of the screen. Mitesh is back with us for some final calls. Mitesh, what did you, make of the roller coaster ride? Last half an hour, so much going on. What's the final advice and trades?
So, Surya was talking about this, that book some profits and this 26,000 should come into play for 2 reasons. One, it's a round number. 2, there's some 96, 97 lakh open interest on the call side over there. So, there was a chance that you will see some profit booking. As we approach the expiry, yes, we might cross it, but I think there might be a couple of hours of volatility. So, you might get fresh entry at lower levels, or you buy about today's high. I think that's the idea. On the stock side, capital goods stocks have come into focus. I have a BTST on ABB. Keep a stop below 80.55, look for targets of 81.25, and Siemens as well. That's a VTST. Keep a stop below 70.75 here, and look for targets of 71.30.
Okay, all right. Got it, Mitesh. Thank you very much for that. You have a good rest of the day, and we'll connect with you tomorrow morning with all the market action. Let's put the spotlight on one stock that's really been knocked out quite hard today, even before the market volatility hit us. And this is IEX. Stock has been down between 10 and 12%. Now, government sources are indicating that market coupling for power exchanges could actually be a reality, and it could happen. Remember, this is a mechanism by which there is sort of one uniform price across all exchanges, the way it happens in the equity segment, and the price remains the same irrespective of what exchange you're trading on. So it's something like that coming through for power exchanges as well. We have Vivek joining in with the details. Vivek, this issue has been sort of surrounding the stock and the company for a long time, for months now. So what is the latest and what's the market concern?
That's right. So, let's start off with what, Abhimanyu has picked up. Number one, like you said, he said they are looking at market coupling, and they've also said that it's going to be difficult to ascribe a timeline to market coupling. Now, let's take into account all of the developments that have happened in 2024 so far. Number one, remember, CERC actually said that there is need for more evidence-based results before market coupling implementation, and this was said in February 2024. Now, after that, the regulators directed grid operators to run a shadow pilot for 4 months with the software of Grid India. Now, after that, the next development that we heard of was the management talking about it in the Q1 conference call. And what did the management say? The simulations actually did not show any benefits of coupling, and the software is still in development. So, if in case there is an implementation, it is still quite some time away. After that, July onwards, you've actually seen a slew of brokerage upgrades coming in as far as IEX is concerned. And one of the key triggers that most of the brokerages have highlighted is that the overhang or the risk of market coupling is actually slowly fading away. Investec, in fact, upgraded the stock to a buy from hold. Axis Capital also upgraded IEX to an add from an earlier sell. UBX very recently, just on September 9th, they upgraded the stock. They raised the target price. What they said was the market coupling overhang, while it has not completely ceased, they believe the likelihood of the implementation is low, and they also see, given the possible regulatory as well as implementation risk, they believe market coupling is unlikely to pose a threat. On the back of all of that, and also aided by very strong volume growth, IEX, the stock has done quite well. 3 months, it's up almost 18%. Last 6 months, it's up 58%. And after today's development, that we put out, Investec actually says that the simulation should show that coupling will be beneficial, which in itself is not quite clear. So if coupling is implemented, will it be beneficial to the sector as a whole is one key question. Number two, they also need to see the other exchanges' reaction on the pricing, and also the ability of other exchanges to to go ahead and actually be able to cater to the higher market demand or the higher volumes. So they are quite skeptical about how exactly this will impact IEX. IFL too has come out with a note today. They are saying market coupling along expected lines could be negative for IEX. In fact, they say that FY26 EPS could see a 26% cut if implemented. But at this point of time, the timelines are still uncertain, and implementation, if it is done, is still quite some time away.
So whether it will happen or not is not clear, and when it will happen is also not clear, right? Vivek?
That's right. Both at this point of time, both are uncertain. What we do know is that shadow pilots are being run, and there have been quite a few delays in the running of these shadow pilots, and still the verdict is still not out as to whether it is beneficial or not.
It makes sense or not. Yeah, no, got that. Thank you very much for joining us, Vivek, for that. That's IEX down sharply, 12%, but as he pointed out, it ran up as well. Jay Bala is going to be with us. We'll take a break. He's, of course, with Cash the Chaos, and we talk market levels and technicals. Stay with us.
Not been the case. The number of traders below the age of 30 within this segment has now risen to 43% from 31% in FY23, and 72% of the total trader base is beyond the top 30 cities of the country. Shows you the extent of the F&O penetration in India. Now, if there would be a study that proves F&O penetration being faster than insurance, don't be surprised. We spoke to you about the losses that individual traders made that ran into lakhs of rupees. 75% of those traders had an annual income of less than 5 lakh rupees. And I'll end with possibly what is the highlight of this report, and nothing better can describe this than a famous Hindi film dialogue, and I quote, "रोज आते हैं इस उम्मीद में आज जीतेंगे, कल जीतेंगे, परसों जीतेंगे और रोज हारते हैं." Now, why do I say so? Because despite making losses for years, 75% of these F&O traders continue to trade as per this SEBI study. So there you have it. Foreign algo trades making money in F&O while the individual retail investor continues to struggle. Of course, what people do with their money is an individual choice, but these stats would definitely set alarm bells ringing for sure.
Okay, well, we have just about 3 minutes to go, so let's get some final perspective with the Jay Bala of Cash the Chaos. Jay, so milestone day for the market, 26,000, but then the sellers came in as well. Your thoughts on how we're poised now here on the Nifty?
Yeah, the Nifty is bullish as long as it stays about 25,334 to 25,285, but it does look stretched and tired. And if it were to drop below 25,334, then only the problems start to surface for the markets. Otherwise, it's okay. The next resistance comes at about 26,300 and then 26,900. But the problem that Nifty and the global markets could be facing is cross assets are at critical inflection points. If we were to see the S&P 500 cash drop below 56.15, then that will be an important trend inflection point. So that will be an important tell. Keep a watch on it. And the Nifty Bank, like I pointed out on the 3rd of September, it's come up to important long-term resistance at 54,000. And I had pointed out the breakout was 51,960 on the 3rd of September. So once it's crossed that, it's now facing a resistance at 54,000. The short-term move is that it looks a bit incomplete. So probably a pullback to about 52,700 and then fresh all-time highs for the Nifty Bank Index.
Okay, so perhaps a pause cannot be ruled out at this point in time. When we talk about the biggest of the big boys on the Nifty, say a Reliance or Lever, I mean, are you getting any clear directional indications? We've discussed banks, but the others, major IT names or Reliance or, like I said, Lever, L&T, any very clear directional cues that you're picking up on, say, the top 5, top 7 weight stocks on the Nifty?
I might be wrong, but Reliance looked weakish for me. The fact that it's come off from 3,200 and change to 2860 in a 5-step fashion, that's a signal that there could be weakness that's persisting. But there are other heavyweights like HUL which are compensating. I think there is still one more high due in some of the heavyweights like HUL. But what is clear in the frontline name is the pharma index that still continues to be bullish. And I have, in fact, one pick for today from Lupin. Lupin is along with a stop loss of about 21.38 for an objective of 24.25. And on a cross-asset basis, Sugar 11 in the US futures has had a very strong run. So I anticipate that to trickle down to the Indian markets. Probably Dalmia Bharat, which has a Sugar subsidiary, could be a beneficiary. So along there with the stop loss of about 17.94 with the price of 2,400. But most of these stocks are quite stretched and the markets are at an extreme point. Don't do leverage. Be
Okay, all right. A little bit of sort of a shorter chat today. Jay, thanks for the perspective there, but we are just running into market close, so let's just count down to what's been an interesting session, considering we touched the milestone and then the profit-taking set in. And if we talk about the Nifty, it's going to end with a gain of just about 8 to 9 points, and a lot of that had to do with the commodity-facing stocks, particularly metals. Tata Steel, Hindalco, these are among the top gainers, even ONGC for that matter, JSW Steel. So there's a fair amount of commodity written all over it. Power Grid was the other stock. Some of the positive broker notes, Motilal Oswal, for instance, on the power utility space, sounding very optimistic on this one stock as well. That worked well for it. There was Tech Mahindra, HCL Tech, Wipro, some of the IT names in short that we don't entirely collapse into the red. That was the upside of the screen. But then the downside, SBI Life, HUL, Grasim, Ultratech Cement. These are some of the poorer performers. And then you have the likes of Kotak, HDFC Life, Hero MotoCipla. So it's really, trends are all over the place. Hard to summarize. But the bank Nifty has ended with a 0.25% cut. So can't take away from that. Kind of that day, Prashant, we got to the milestone, but then the cool off.
Like a, for the lack of a better comparison, like a Mallu wedding.
How so?
It's blink and miss. You should ask me. Anyway, up 26,000 and then just kind of came off very, very quickly. So quickly, and the dash was so quick and fast that one really had to go back and see whether we hit 26, and we had hit 26. I think at about 26,011 is the day's high, the new all-time high, I should put it that way. 25,950 is the final close. It's a wrap on this edition of Closing Bell from all of us here. It's goodbye. Thank you very much for watching. Markets Forward. We'll pick up on the action next.
भारत का 5G मार्केट बताऊं? बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। आप हैरान होंगे, आज भारत का 5G मार्केट बताऊं? बुरा नहीं लगेगा ना? आज भारत का 5G मार्केट अमेरिका से भी बड़ा हो चुका है। और ये 2 साल के भीतर भीतर हुआ है। अब तो भारत मेड इन इंडिया 6G पर काम कर रहा है। ये कैसे हुआ? ये इसलिए हुआ क्योंकि हमने इस सेक्टर को आगे बढ़ाने के लिए पॉलिसीज बनाई। हमने मेड इन इंडिया टेक्नोलॉजी पर काम किया। हमने सस्ते डेटा पर मोबाइल फोन मैन्युफैक्चरिंग पर फोकस किया। आज दुनिया का करीब करीब हर बड़ा मोबाइल ब्रांड मेड इन इंडिया है।
The Wall Street falls from record highs and flat. Nifty surpasses 26,000. Midcap index posts a record close for the third straight session, but banks underperform. Nifty takes 38 sessions to climb from 25,000 to 26,000.
Metals perk up after China's central bank chief points to a 50 basis point cut in the reserve ratio and a cut in interest rates. Also promises lower rates for mortgages, even as reports suggest a recapitalization of banks is likely.
IEX slumps over 11% after government sources indicate that market coupling is perhaps on the cards. AstraZeneca Pharma rallies 16% as it gets the green signal to sell and distribute a key cancer drug. First source gains after it buys a Sensex for £42 million. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points that have transpired in the day today. And of course, we gear you up for the next trading session. I'm Surabhi Upadhyay, and with me as always, my colleague Nigel D'Souza. Hi, Nigel. So another milestone, but then some drama following it.
Well, that's right, Surabhi. Well, I'll tell you what, in the next half hour odd, we have got you covered with all the big news, the key developments on the Wall Street, the top corporate voices, and the events you need to track as well. Well, let's kickstart with what went on today. You know, Surabhi, not too long ago, in September 2005, and I was obviously not tracking the markets, we were at around 2,600 odd,
yes,
you know, on the Nifty.
Yes.
And today we went ahead and we climbed Mount 26,000 odd. Well, the number looks very, very good that we have gone up 10 times in 19 years. I'll tell you what, we compounded at just 13%. And the simple law, the power of compounding has played out, which has taken us to that 26,000 mark for just a couple of minutes, and then we did see some bit of pressure. So we slipped towards the end. It could have had an expiry-related factor that played out as well. And the outperformer, or the one that was holding one end up, is the Nifty Bank. That couldn't find its form today, and that ended with a cut of close to under 100 points after the big run that we've seen. And that explains why the Nifty couldn't hold on to the 26,000 odd mark. The other was a technical factor. The Nifty Financial Services Index, that plays out its Tuesday expiry. So that as well was all over the place. You had, the Nifty Financial Services Index actually should come up for you. That explains the volatility out there. Select insurance companies are part of that index, and they were in lower in trade as well. But otherwise, portfolios will be feeling good. For bulk of the trading session, you had way more number of stocks that were advancing. in comparison to the number of stocks that were declining. So you'll say that your portfolio is feeling quite good. I think, Surbhi, we've been calling this out, right, about some kind of consolidation in the near term. There were a couple of markers as well that were indicating that. And I guess that was the session today.
Yeah, some of it, I mean, you do have algos in the market. You have program trading as well. So you hit certain levels. It's, you know, one of the key contracts is expiring today. So those technical factors kind of weigh in at times. But otherwise, it's, you know, it's been good going for the street. Anyway, to talk about today's action, and we'll give you more highlights of this as we go along. Today, the commodity side of the market did really well. Metals were leading from the front. There was also oil, because by the time we closed, oil prices, by the way, were back up, almost a 2% rise on oil prices, finally taking note of what's happening in the Middle East. So oil and gas, metals, this was a solid side of the market. And the reason why we didn't see a wider sell-off was because of IT. Because while banks and financials got a little wobbly, IT managed to ensure that we did sort of end very close to the flat line, so not too much gone out. And that was the contours of the day on which the Nifty did conquer the milestone of 26,000, at least on an intraday basis. We have a lot of ground to cover, lots to talk about, and of course, plenty of corporate commentary to go over as well. So here's the lineup, all the movers and shakers, the individual stock action coming up with Hormuz in just a bit. And then the sector of the day has to be metals, and that's thanks to the Chinese central bank announcing a whole host of measures to sort of boost the ailing economy and to look at more monetary easing. There was SH Kelkar and Arvind Smart Spaces, both of those stocks fueled by positive brokerage notes. We'll tell you more about it as we go on. And of course, then now we get into all the key events that you need to watch out for tomorrow as well. But first up, let's go over today's roller coaster with Hormuz. Over to you, Hormuz.
Well, it was a day that belonged to the Nifty, 26,000, then drama. Of course, the broader markets got a little pushed into the background considering the landmark that we had on the Nifty. But of course, as you just mentioned, metals, the sector of the day today after those slew of measures that were announced. All the components of the Nifty metal index ending higher in today's session with gains of anywhere between 4 to 6%. Hindalco and Tata Steel among the Nifty names also featuring in this list. A slew of brokerage reports came out earlier in the day and they have had an impact on the stock prices as well. SH Kelkar 17% higher after the reinitiation by Kotak. Fusion Micro another 9% down after yesterday's 10% drop after the CLSA downgrade. And a good day, of course, for GMR Power and for Power Grid as well. A lot of news flow based names as well reacting to their respective news flow. IEX ending at the lowest point of the day, 12% lower. And as with AstraZeneca, positive development there. As Sapphire Foods after the block deal, JTL is going to mull a bonus issue and a stock split as well. And a good day for First Source Solutions as well. The rebound in the PSU stocks continues and almost all of the PSE index constituents also ended higher today with HPCL, BHEL and oil, as you mentioned, also oil sensitives doing well in today's session. And lastly, stocks that did well on the back of strong volumes. Schneider Electric was one of them, 10% surge in today's session. SBFC Finance after yesterday's 20% move, seeing some bit of profit booking ending at the low point of the day, and a good day for Godavari Power and for VIP Industries as well. Back to you guys.
All right, Hormuz, thanks a lot for that. I think grab a sip of water and then we'll come back to you. Thanks a lot for that. Well, let's welcome our guests on the show. We have Sudeep Bandyopadhyay of IndiTrade Capital as well as Jay Bala of Cash the Chaos who joins us on the show. Hi, gentlemen. Thanks a lot for joining in. Well, Jay, you go first. What's your view on the Nifty from here on? You know, we had a day of consolidation today, but we have had a very, very good run. So give us your view out there, and particularly want to ask you about HDFC Bank. Last week around, you did talk about the possibility of that giving up its underperformance.
Yeah. See, as long as Nifty can hold about 25,334 and 25,285, I think it's still bullish, but it's getting a bit long in the tooth. But no preempting the market. The trend is still strong. Keep watch on this critical support. The pressure for Nifty can come only from global cues, and as long as the US S&P futures or the S&P cash stays above 56.15, again there should not be a problem. But if it's a 15 and get taken out, it could percolate into the Indian market. So watch 56.15 on the S&P cash and 24,334, 24,285 on the Indian Nifty. HDFC Bank, I've been pointing out that ICICI Bank was the only one that was showing strength, and I wanted another bank to join to lift the banking index to give a breakout. And that happened to be HDFC Bank. And I had, sometime in June, I pointed out to volatile move for the HDFC Bank stock to record highs, and it's come down, and probably there's one last down up sequence pending for the Nifty Bank Index. That's probably is playing out. We could see a short-term pullback that holds about 52,700 for the Nifty Bank Index, and followed by fresh all-time highs. So that could be getting the lift from HFC Bank.
Okay, all right, got it. Jay, stay on. We have more questions for you. Let's address really what was the biggest headline of the day and the sector of the day, and that was metals, because we had a roaring rally across the board. Ferrous, non-ferrous, all kinds of metal stocks. So, Nigel, tell us more. China factor?
Well, China factor at play. They announced a slew of measures which could be positive for metals companies. We'll have to see how it plays out, but for the time being, the street liked it. They said that the PBOC will cut the reserve requirement ratio, or the RRR, for banks by around 50 basis points. They stopped short, though, of giving a specific timeline for the cut. They also hinted at another RRR cut of around 20 to around 25 basis points by the end of this year. Now, there were a few more highlights that were announced. They'll cut the rates on existing mortgage loans. They'll cut the 7-day reverse repo rate by around 20 basis points from around 1.7% to around 1.5%. And also, they'll cut down on the minimum payment ratio for the second home to around 15% from around 25%. So basically, they are looking to pump up the economy, which is absolutely bombed out and not showing any sign of revival. Now, with regard to metals, Phillips Capital, they said that they maintain their positive stance on metals. Their top picks from the ferrous pack, JSW as well as JSPL. But from the non-ferrous pack, it's Nalco as well as Vedanta. They've also recommended accumulating NMDC and SAIL, but in a staggered manner. Just one more data point. I was reading an HSBC note, and they mentioned that only 5% of Chinese producers of steel right now are making any kind of money. So normally when we see that sign come about, then they'll obviously not want to produce more, which will reduce the supply in the market and in turn support prices. So metals did well, and you have that China factor that's playing out in terms of a stimulus, and they can't produce at such low prices. So helping the stocks bounce up and trade. Sudeep, what's your view on the metal stocks? What do you like? I think you were hinting that aluminium is what you like in comparison to the ferrous pack. So your pick out there, and give us the order of preference. Will you go for the daring one, that's Vedanta, that has valuation support but you don't know what happens next, or the PSU company, or Hindalco, that's more of a converter?
Well, Nigel, I think very clearly the metals are in for a good time if China does go ahead with the stimulus which they are talking about. While the US interest rates are coming down, which is good for the metal pack, the China problem was holding it back. With China coming out with a stimulus, I think it's good time for metals across the board. But as I was mentioning, from a long-term perspective and from a structural angle, I do like aluminium because, look at all the new technologies coming in, the automobile transition from IC to EV. I think the use of aluminium is becoming more and more, everywhere around us. People are preferring aluminium going forward. And with that, the demand for aluminium will keep going up, which will in turn create a long-term virtuous cycle for this entire aluminium and the entire value chain of aluminium. Now, considering, we have a few companies in that space as in India. Of course, Vedanta, I like for a different reason. There is some value unlocking happen. They have aluminium, they have other metals as well. So if you want to take a basket approach and play on the value unlock principle, so in spite of whatever corporate governance issues we had in the mind about past, we can ignore that for the time being, and looking at the valuation, we can get into Vedanta. That I'm reasonably confident will reward the shareholders over a period of time. The other stocks which we can look at is both Nalco as well as Hindalco. Hindalco is a converter, Nalco is on both the sides. But I think if we are talking about a virtuous cycle in the entire value chain of aluminium, I think both will benefit. So we can, from a long-term perspective, look at both. If I have to pick one out of the two, I will go ahead with Hindalco at this stage.
Hindalco being the pick there. Got it. Just very quickly, let's get a sort of technical check as well on this. Jay, would you look at any metal stock right now, any trades, and if yes, which one?
Yeah, most of the copper names seem to be doing okay, but there's an important takeaway here. The Nifty Metals Index, which is probably seeing a breakout, is breaking out of a triangle, and we could probably see fresh 52-week highs coming through for the Nifty Metals Index itself. But triangle at the penultimate leg of a move. So it just says that there's information that we could get getting to fresh 52-week highs, but this is probably the last leg of the move that started from 2023. So be cautious. The top pick is once again Hindalco for me.
Oh, okay. Both the guests concur. Hindalco is their top pick. All right, let's quickly move on and put the spotlight on IEX. Now, shares here were down almost 11% after government sources indicated that market coupling may actually become a reality for power exchanges. Vivek is joining in with more details on why this could be so disappointing for IEX. Vivek.
Well, that's right. Like we reported earlier today, sources tell our colleague Abhimanyu that market coupling may be a reality. However, sources also have indicated that it's very difficult to go ahead and ascribe a timeline to market coupling at this point of time. So what we did is we did a deep dive, especially as far as what has been all of the developments as far as market coupling is concerned in 2024. Number one, remember, CERC came out with a document in February 2024 saying there is need for more evidence-based results before the implementation of market coupling. In fact, they went ahead and directed grid operators to run a shadow pilot for 4 months with Grid India software. Number two, remember, what is it that the management said? The management in Q1 con call said that there have been no visible benefits as far as the simulations are concerned with the implementation of market coupling. Software still in the development stage. Pilot also was getting delayed quite significantly. July 2024 onwards, a lot of brokerages, and there have been a slew of upgrades coming in as far as IEX was concerned. Investec upgraded the stock, Axis Capital upgraded the stock, UBS went ahead and raised the target price. They say market coupling overhang has not completely ceased. However, they believe the likelihood of implementation is quite low. Given the possible regulatory as well as implementation risk, what UBS believes was that market coupling is unlikely to pose a threat, at least in the near term. On the back of that, the stock has done very well. Up till today, 3 months, the stock is up almost 18%. In the last 6 months, the stock is up 58%. What is it that brokerages have said after our news break today? Investec says that simulation should show coupling would be beneficial. As of right now, that in itself is not very clear. Also, the other exchanges' reactions, whether they are able to go ahead and cater to higher demand and higher volumes, is something also that needs to be tracked. IFL, has gone ahead and done an analysis as to what could be the impact. They see almost a 25% cut to their FY26 EPS estimates in case market coupling becomes a reality.
Okay, all right. Thanks a lot for that, Vivek. But AstraZeneca bucked the trend in today's trading session. Ekta joins us to tell us why. Ekta?
Well, yes, AstraZeneca has seen good amount of price and volume action. They have got the government nod to sell and distribute another indication for their drug for cancer, Imfinzi. Now, this particular drug is already being used for both non-small cell and small cell lung cancer. In fact, it is the 6th largest oncology brand in the country at this point in time, and Imfinzi has demonstrated robust growth across lung indications in FY24 according to the AstraZeneca management, and now it has been approved for an additional indication in cancer. The value of this particular drug in FY24 stood at around 200 odd crores. Separately, remember, oncology is an important part of AstraZeneca's business. It's around 62% of their total sales. They have important drugs such as Tagrisso, which generated around 320 odd crores in terms of value in FY24. They've launched Inheritu, which is a breast cancer drug, in Jan 2024. And separately, other triggers for AstraZeneca include that they partnered with Mankind Pharma to expand access for asthma patients. They forayed into rare disease segments. They are also looking to exit their manufacturing site in Bangalore in due course.
Thanks, Ekta, for that. But the other one that was giving company on the upside was Firstsource. Vamakshi joins us to tell us why. Vamakshi.
Well, Nigel, the stock was abuzz in the trading session today on account of an acquisition that they announced. The company's arm Firstsource Solutions UK will be acquiring 100% stake in Ascensos, and this is for a consideration of nearly 42 million pounds at a valuation of nearly 0.7 times EV to sales on a calendar year 23 basis. Now, keep in mind that Ascensos is a leading customer experience outsourcing partner for retail and e-commerce businesses, and this acquisition will lead to strategic expansion expansion in the retail vertical and will also strengthen the company's nearshore as well as multilingual capabilities. This collaboration opens doors for the company in the retail as well as the CPG BPO market, which is a nearly $28 billion opportunity globally. We also had a note come in from MK on the same, and they say that this acquisition is expected to be margin dilutive initially, but the margin profile is expected to gradually improve going forward. Overall, they've got an ad rating on this counter, target price of 330, but this does not factor in this acquisition, and that is because they are awaiting certain clarity as far as the margin profile of the company is concerned. So given those factors, F&O Solutions was up in the trading session today.
Okay, all right. Got that, Vamakshi. Thank you for it. The other one that we're looking at is SH Kelkar and also Arvind Smart Spaces. And these were stocks that were reacting on the back of positive brokerage notes. We have Sonal joining in to tell us more about these notes. Sonal.
Well, yes, two brokerage notes which led to big surge in two stocks. Let me start with SH Kelkar. Kotak Institutional Equities has initiated coverage on the stock with a target price of 400 rupees a share and a buy rating. They like the long runway for growth given established and sticky relationships in the growing Indian market. Now, this is in the fragrance industry, and this is something which is seeing big footprint coming by in Europe, Southeast Asia and the US as well. There are high entry barriers in this industry, which makes SH Kelkar a good candidate for investment according to Kotak. They also see potential for margin expansion because of growth in high margin geographies, operating leverage, as well as strong cash flows given a business-light model on fixed assets. So going forward in the next three fiscals, they expect CAGR in terms of revenues at 12%, EBITDA at 17%, and EPS at 28%. Additionally, they talk about this large order that they've received from Unilever, and this is something which will propel growth for SH Kelkar, and the management has guided for a 12% revenue growth going forward. Of course, there are risks. One would be slowdown in economy because that would lead to lower discretionary spends. And second would be the execution slippage on these large orders. If they're not able to execute on time, that would be a problem. Now, the second one is Axis Securities on Arvind Smart Spaces. They have a buy recommendation with a target price of 1,085 rupees a share. The company has planned pipeline of projects spanning to around 48 million square feet, bringing its total book size to around 75.5 million square feet. Out of it, 72% of the projects actually follow asset-light model, which would mean better growth going forward. The company's unsold inventory stands at 51 million square feet, which is all completed, ongoing and planned project. They also have a gross development value of 5,000 crore rupees in FY25. Company has unutilized funds of around 600 crores from the HDFC platform. They can raise funds to the tune of 300 crore rupees via debt as well. So enough in the balance sheet as well. And their operations are also doing well according to Axis Securities. And that is what they like about the stock.
Thanks, Sonal, for that. Well, on that note, though, we'll thank both our guests, Sudeep as well as Jay, for joining us and giving us all the key market insights. But for the time being, we'll have to take that short break. Come back. We'll get you all the top corporate voices and the events to track for tomorrow's session.
आज भारत दुनिया का दूसरा सबसे बड़ा मोबाइल मैन्युफैक्चरर है। एक जमाना था मेरे आने से पहले जब हम मोबाइल इंपोर्टर थे, आज हम मोबाइल एक्सपोर्टर बन गए हैं। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। ये तीसरे टर्म में हमें बहुत बड़े लक्ष्य साधने हैं। हमें 3 गुना ताकत और 3 गुना गति।
Welcome back. You're with us on Markets Forward. Let's quickly move to all the top corporate commentary that we picked up today. First up, JK Cement. Now, the company is gearing up for a strong year, projecting a growth of 7 to 8% in FY25, well ahead of industry's 3 to 4% estimates. While cement prices remain soft at the moment, the company is optimistic about a turnaround soon. Looking ahead, JK Cement plans to scale its capacity to 50 million tons in the long term, with a near-term focus on reducing costs by 150 rupees per ton.
Well, meanwhile, Northern Arc Capital made a strong debut. The company listed at a 25% premium. The management is optimistic, stating that the company's capital to risk weighted asset ratio, or the CRAR, will rise to 20 to 24% following the capital raise. They also reaffirmed their confidence in growing the balance sheet by around 30%, as they've consistently done, and they see room for net interest margins, or NIMs, to improve further. Well, before we wrap on the show, though, let's get you all the key market events that you need to track. Ekta's with us. Ekta, take it away.
Well, yes, I'll start with the global data. France, we have the consumer confidence data. ECB, we have the non-monetary policy meeting. US, we have new home sales data. Now, in terms of back home, we have AGMs from a lot of the broader market companies such as Eris Life, Apollo Pipes, Dixon Technologies, Strides Pharma, to name a few. Now, Arihant Capital Bharat Connect conference will be held tomorrow, and we have a couple of companies which will be participating from the broader markets, especially such as Nuvoco Vistas, Vascon Engineering, Indostar, Asian Granito. GSK Pharma, they will be participating in the Bernstein Annual Pan-European Strategic Decisions Conference, and CAMS will be holding their Capital Markets Day. Z Entertainment senior management will also be convening multiple one-to-one group meetings with investors from September 25th to September 27th in Singapore.
Got that, Ekta. Thanks for that. Well, on that note, we'll wrap up on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Thank you for watching.
आगे बढ़ना है। आपको एक शब्द याद रहेगा, पुष्प। हाँ, कमल मान लीजिए, मुझे इतराज नहीं है। पुष्प, और मैं पुष्प को डिफाइन करता हूं, पी फॉर प्रोग्रेसिव भारत, यू फॉर अनस्टॉपेबल भारत, एस फॉर स्पिरिचुअल भारत, एच फॉर ह्यूमैनिटी फर्स्ट को समर्पित भारत, पी फॉर प्रोस्परस भारत, यानी पुष्प। पुष्प की 5 पंखुड़ियों को मिलाकर ही विकसित भारत बनाएंगे। साथियों, मैं भारत का पहला प्रधानमंत्री हूं जिसका जन्म आजादी के बाद हुआ। आजादी के आंदोलन में करोड़ों भारतीयों ने स्वराज के लिए जीवन खपा दिया था। उन्होंने अपना हित नहीं देखा, अपने कंफर्ट जोन की चिंता नहीं की। वो तो बस देश की आजादी के लिए सब कुछ भूलकर अंग्रेजों से लड़ने चल पड़े थे। उस सफर में किसी को फांसी का फंदा मिला, किसी के शरीर को गोलियों से भून दिया गया, कोई यातनाएं सहते हुए जेल में ही गुजर गया, कईयों की जवानी जिंदगी जेल में कब गई। साथियों, हम देश के लिए मर नहीं पाए।
Hello and welcome to Business 360. I am Ashmat Kumar and here are the headlines that we're tracking this evening. Nifty crosses the 26,000 mark for the first time in a choppy trading session. Takes 38 sessions to scale from 25,000 to 26,000. The Sensex too crossed the 85,000 mark for the first time. The Nifty Bank snapped an 8-day winning streak. China's central bank unveils its biggest stimulus measure since the pandemic to revive the Chinese economy, announces policy rate cuts and measures to ease mortgage repayment burden, among others. Asian markets perk up in trade. Indian metal stocks gain in trade. JP Morgan Chase CEO Jamie Dimon says India is doing a lot of right things and he's optimistic about growth prospects, calls China plus one a great opportunity for India, adds that India can look at reducing regulations, make it easier to get more FDI. Israel launches fresh airstrikes on southern Lebanon overnight, targets Hezbollah positions from where rockets were fired towards Israel. Thousands flee their homes in southern Lebanon for safety. Netanyahu says they were changing the security balance along the northern Israel border. Iran says it will not remain indifferent to Israel's crimes. Prime Minister Modi meets Zelensky in New York on the sidelines of a United Nations event, reiterates his support for peaceful resolution of the Ukraine-Russia conflict. Zelensky expresses gratitude for India's clear support of our sovereignty and territorial integrity. A Delaware Supreme Court rules in favor of U.S. investors, upholds previous ruling saying that Byju's defaulted on $1.5 billion loan. This will allow American lenders to take control of EdTech U.S. assets and demand full repayment. However, the company says this order will not impact the legal proceedings in India. Karnataka High Court upholds governor's decision to sanction a probe against Chief Minister Siddaramaiah in the alleged Mysore Urban Development Authority scam. The court, while dismissing Siddaramaiah's plea, says that the governor can take independent decisions in exceptional circumstances. 26 seats go to polls in Phase 2 of Jammu and Kashmir Assembly elections tomorrow. 239 candidates, including former Chief Minister Omar Abdullah, J&K's BJP Chief Ravinder Raina, and J&K Congress President Tariq Hamid Karra in the fray. Well, let's begin with a quick look at the day's market action. The benchmark Nifty touched a record high of 26,000 in trade today in what was a choppy trading session. The 1,000-point rally from 25,000 took the Nifty 38 sessions. The Sensex too crossed the 85,000 mark for the first time. Midcap index posted a record close for the third straight session. The Nifty Bank snapped an 8-day winning streak. Hormaz Fatakia is joining us now. Hormaz, take us through the Nifty's journey from 25,000 to 26,000, 38 sessions there.
There was this suspense building up, right? And it finally, the mark of 26,000 eventually happening on the financial services expiry day. 38 sessions then from 25 to 26,000. We hit 25 for the first time on the 1st of August. So it's taken 38 trading sessions then. And since then, we've moved. So let's take a look at the top contributors then. And as you were mentioning, right, just a few minutes back about sector rotation taking place and the names that have come up. And this last 1,000 points, of course, have happened from the September of 11 that we have moved higher. Look at this. Bajaj Auto, Shriram Finance, Bharti Airtel, Bajaj Finserv and Hero MotoCorp among the top movers in percentage terms. Yes, Bajaj Auto continuing to move from one high to another, and even Bharti Airtel has come up here, as has Hero MotoCorp. But take a look at the underperformers, and they are the ones that have not participated in this rally. The best performing stock on the Nifty in 2023 is the worst performing stock in this 1,000-point rally. This Tata Motors is down 16%, and the PSUs, the high-flying PSUs, have been featuring in this list of underperformers, be the likes of ONGC and SBI. But a big catalyst of this 1,000-point move has been the rush seen in the banks. The Nifty Bank has been the lead contributor here. And as of closing yesterday, the Nifty Bank was up for 8 days in a row, and 3,000 points is what the index has gained. And that shows up in the Nifty moves as well that we have seen from the 11th of September. And take a look at the big movers in the Nifty Bank as well. And underperforming Bandhan Bank is the top performer in these last 8 sessions from the 11th of September. And look at this, HDFC Bank and ICICI Bank, the two big heavyweights on the Nifty Bank, on the Nifty as well, 7% each, and that shows up on the price as well. Interestingly, it was the 1st of August when Nifty hit 25,000, and it was the 1st of August when the PSU index made a near-term top as well. And since then, the PSU index is down almost 6.5 to 7%. And take a look at the top losers here. All the top performers, REC, SAIL, Concord, BHEL, LIC, all of them seeing double-digit losses, and 17 out of the 20 index constituents since the 1st of August have delivered negative returns. The only 3 in the positives are Oil India, NTPC and HPCL. But it is not the story of the PSU underperformance. Today is the day that belongs to the Nifty, and it's been a large cap move over this last month and a half.
Right, Ramaz, thanks a lot for that. Now, here's some international news. Israel has mounted a fresh offensive against Hezbollah overnight. This comes a day after Israel attacked Lebanon, killing nearly 500 people and injuring over 1,600. The Israeli military has claimed that the airstrikes were carried out over locations with Hezbollah's defense infrastructure. They have also said that the attacks will continue in the near term and have urged Lebanese civilians to evacuate areas situated closer to Hezbollah's military infrastructure or buildings that are being used by the militia group. The Iran-backed militant group also fired a barrage of missiles at Israeli air bases in response to the attacks. Israel has claimed that over 50 projectiles were fired from Lebanon into northern Israel. World leaders and the United States have urged for a de-escalation in this matter. Pentagon has confirmed that the United States is sending a small number of additional troops to the Middle East, given escalating tensions in the region. Turkey has also warned Israel's offensive, adding that this conflict with Lebanon could drag the entire region into chaos. Thousands of civilians have started evacuating parts of southern Lebanon after reports of Hezbollah storing weapons in the region surfaced. Civilians in the region are moving towards northern Lebanon, following Israel's orders. In a televised address, Israeli Prime Minister Benjamin Netanyahu has also said that the country war is not with Lebanon, but with Hezbollah, and urged the Lebanese to get out of harm's way.
I have a message for the people of Lebanon. Israel's war is not with you. It's with Hezbollah. For too long, Hezbollah has been using you as human shields. It placed rockets in your living rooms and missiles in your garage. Those rockets and missiles are aimed directly at our cities, directly at our citizens. To defend our people against Hezbollah strikes, we must take out those weapons. Now, starting this morning, the IDF has warned you to get out of harm's way. I urge you, take this warning seriously. Don't let Hezbollah endanger your lives and the lives of your loved ones. Don't let Hezbollah endanger Lebanon. Please, get out of harm's way now.
To the parties that are firing at each other across the blue line, to all the parties involved in this conflict, is step back from the brink. Stop the escalation. We have mechanisms through which to address these issues, notably on the security issue through UNIFIL, on the broader political issues through the work of our special coordinators in the region. As we just said, there is no military solution at this point that will make anyone in either country any safer.
The escalation in Lebanon is extremely dangerous and worrying. I was in Lebanon some days before, just before the explosion of these electronic devices has been creating terror among the Lebanese population. The escalation is extremely dangerous and worrying. I can say that we are almost in a full-fledged war.
China's central bank has announced the biggest stimulus measures since the pandemic to boost the Chinese economy. The measures include a cut in its policy rate, a reduction in its required reserve ratio, and relief when it comes to mortgage repayment. The decision triggered China's 10-year bond yield to fall to 2%, which is the first time on record. Well, here's the big exclusive interview of the day. Veteran banker and JP Morgan Chase's global CEO, Jamie Dimon, has said that India is doing a lot of right things and has shown optimism about growth prospects. Speaking to Prashant Nair, Dimon said that China +1 was a huge opportunity for India and other countries. He, however, conceded that it might take years and years for companies to move away from China. He also urged the Indian government to consider reducing regulations, making it easier to attract more foreign direct investments.
America was overly reliant. That's not being angry at them. You should ask why we didn't do it before. But in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals. The second one is around disagreements around policy, like, if countries are aiding and abetting